That's nice to see, I'm sure.
Yeah, it is. One called me and told me he was now managing $100 million hedge fund, and it's fascinating to leave the legacy behind.
Hmm.
I started this because I retired early because I'd been working since the age of 9, and I was like, okay, I need a break.
Yeah.
About a year later, I'm bored out of my mind. So Howard, my partner, said, "Oh, we should teach. You're such a great teacher, and you have a passion for it." I said, "Are you nuts?" Because I didn't think anything that I was so accustomed to the professional side of the market and the buy sides and all that that I
Mhm.
didn't realize that the retail side is void of a lot of things they need to learn. So it's very rewarding for me.
Yeah. Yeah, that sounds great. Okay, it is 10 o'clock now, so um and thank you for everyone putting in where you're from. There's Olympia, Virginia, Idaho. All right, so but it is 10 o'clock now, so we're gonna get started. So Martha, you're ready, right?
Yes, I'm ready to go.
All right, I'm gonna start my recording. Oh, and in case anyone missed this on previous events, I do record each presentation individually. I also am streaming live to YouTube. So if you have to leave the Zoom room for any reason, you can still watch live on YouTube. So, all right, I'm going to start my recording, do a short introduction, and then turn it over to you. All right. All right, hi everyone. Welcome to day 2 of this big active traders playbook event on TimingResearch.com, brought to you by TradeOutLoud.com and TimingResearch.com, along with our co-sponsors, MadHedgeFundTrader.com, TradeThirsty.com, and TradingIndicators.com. So to start off the day for us, we have Martha Stokes of TechniTrader.com. So Martha, I'm going to go ahead and turn it over to you.
Thank you. Today, we're going to talk about volatility versus velocity because there's a lot of chatter around the retail news about that, and you need to understand what's going on behind the scenes. How to trade consistently in fast-changing markets, which is what we have today. As always, I'm an educational service. We have been educating for many years. I don't recommend stocks because I'm teaching you how to not have to rely on recommended stocks because each of you is an individual. There hasn't been a single student all the 27 years that I've taught that was exactly the same. There's variables about you. So not every stock that's recommended is good for you. So I am a chartered market condition, a long-term member of the CMT Association, approved by the SEC Series 86. I have a approved Series 86. This is important. This is the difference between going to a community college and learning something and going to an Ivy League university and learning something as far as what you can make in money and time and understanding. I am the CEO and co-founder of TechniTrader with Howard Johnson. 27 years of educating professionals, semi-professionals, and retail traders. I include retail traders because they should also be trading at the level of professionals. And all that time, 27 years, A plus better business rating, no complaints. I am the author of Cycle Evolution Theory. I'm considered one of the top cyclists in the country. I don't know because I don't pay attention to that. That's just what I'm told. How to identify evolutionary cycle deviations. What I did is I turned the whole world of cycle analysis upside down. Instead of trying to prove a cycle existed, I showed that there's evolutionary changes, deviations, uh, cycles that collapse and never return and that type of thing. And then I also have my thesis, Relational Technical Analysis, which has been presented to the whole member of the CMT, and that's what they are using now. I want you to stay until the end, even if this is just a fun thing for you, or if you're very serious to claim your attendees bonus as something special today just for you. Volatility versus velocity. Most information that you read, hear, or watch on YouTube or other social media is misinformation or even false information about volatility, also known as volatile price action. This is because it's coming from the retail side, the emotional side of the market. The SEC and FINRA are finding and penalizing more and more retail gurus, retail brokers, recommendation services, prop desk traders who are trying to say they'll trade for you, and small funds managers who do not believe that technical analysis is a real thing they should be studying. Many financial websites have weaponized so-called news, which is actually false information. This has been going on. There's a group of people that are using it to terrorize and scare people that are on the retail side with information that's totally false. Many firms and individuals have violated the rules and regulations governing the financial markets. It is critical that you learn how to discern the difference between fact and false statements. There is plenty of misinformation regarding the VIX volatility, implied volatility for you options traders. This is a primary cause of trading losses for retail traders because you don't understand what's going on. So you want to be careful who you listen to, because just because somebody says, I'm a professional, they may not be. Professionals usually are very reclusive. I'm one of the rare ones that surfaces to the retail side to help you out. So we have the VIX and true volatility. The VIX is primarily designed to estimate expected volatility over a 30-day period, making it inherently less precise for a 1 day or 1 week time frame. Extensive analysis of the VIX over time has proven that its efficacy as a predictor or forward realized volatility is generally between 20 and 25%. That means that 75 to 80% of the time the VIX is wrong. Now, why would that be? That is one huge reason why your trading results are often inconsistent. So you need to be careful about that. Volatility day over day, as in this daily chart of the VIX, is up and down, up and down, up and down. And this is very challenging to trade. Even the professionals will just walk away from it. Usually the VIX, as they say, it's at this higher number around 30. Then there's volatility that's going to come in the next 30 days. And it's not consistent because of a specific reason that you don't know. The inner market structure has changed. The stock markets of the world are in a massive evolutionary change due to AI. It's the technological evolution of the markets. It is imperative that you keep up with these changes. However, many of the indicators, trading tools, and strategies you are using are now outdated. They work fine, but they put you behind and you're chasing rather than being part of the momentum moving up. In order for you to succeed in the new global financial markets, and yes, it will be a global market, you must understand these changes and how they impact how you trade. Those changes continue to cause many older indicators, strategies, and trading systems to be obsolete. So you have to add to the layer. Everything you've learned has value, but you need to expand that if you're really serious. Now, some of you just enjoy trading and it doesn't matter that you lose money, but others of you out there are potentially want to learn more and actually be very consistent. So that's the difference. Beyond the basics of technical analysis, if you want to be a consistently profitable trader, you need to learn more than just the basics of technical analysis. It's the foundation. It's the ABCs and the basic math and all of that that you are learning. The basics are a good start, but in order to make the income of a professional trader, which is 6 or 7 digits, you must learn more than just candlestick continuation or reversal patterns. You need to know more than just MACD, RSI, Bollinger Band, stochastics, Fibonacci, or Elliott wave theory. These are fine, but not enough. They leave holes in your education. All professional traders incorporate far more advanced indicators called hybrid leading indicators. They were written for a more advanced market more recently. These are 1960s, 1970s, 1980s, 1950s, so on and so forth. Hybrid leading indicators incorporate far more data and far more complex formula to reveal more about dark pools activity, which I'm going to cover in a little bit. These indicators signal before price moves. These indicators signal before price moves. These indicators have to have price move first before they signal a buy entry signal. Okay? So when you use these indicators, you're getting in sooner. Why is that important? We're in a decimal pricing structure. We no longer have the fractions with those huge differentials. There's penny spreads all the time, so you have difficulty making money in a penny spread. Fact, dark pools do not move price. They do not create momentum runs. Now I'll tell you why. Dark pools are slow liquidity takers, which creates specific patterns. Implied volatility for options trading. Trading options is a highly promoted method of presumably lowering your risk and the amount of capital you need to trade stocks. Some of you just don't have a lot of capital. So options is a great way of going about it. Unfortunately, most of options traders are told that if there is a huge increase in option puts, that it means that the options market or options traders know or are predicting that the stock or stock market is about to go down. This is total fallacy. This is why most of retail traders who options contracts expire worthless. Your options contracts expire worthless, or you try to do a straddle or a spread or whatever to try to mitigate it, and you get further and further down into a trap where you're losing money. What high quantities of options futures really indicate? Professional traders are a huge, important group of active swing traders. They don't day trade anymore because they can't make any money on a penny spread. They abandoned it years ago. They don't day trade. So if somebody says, I'm a professional, I'm day trading, they're not a professional. They may be a proprietary desk trader or a floor trader for the dark pools and an independent trader or company that offers trading services to the dark pools. So these traders are trading huge lots. A pro trader will swing trade 1 million to 10 million lot order, holding for a 2 to 10 days. Average is about 5 days that they hold. You'll notice that as you get more accustomed to the charts and to relational analysis, you say, oh, this run is 4 or 5 days. Oh, this run is 5 or 6 days. Pro traders are risk averse and know that controlling risk is mandatory at all times, even if they're very confident that the stock is going to go up. They have many choices of instruments to mitigate and control their risk. There are many ways pros can mitigate the risk of a trade suddenly shifting due to retail panic or euphoria. You cause volatility, you cause velocity because you panic and you fill queues with a lot of small lot orders. The options puts are the professionals' preferred use. They call this an insurance policy and treat the transaction like an insurance policy, something they can allow to expire worthless, because an insurance policy expires worthless, or something they sell to you, the retail options trader, who thinks rising option puts means the stock market or stock is destined and predicted to go down. The opposite is true. Pros are exceptionally skilled and knowledgeable. Here's an options market maker desk, and she is a good friend of mine, Catherine Clay, and she sold LiveVol to CBOE, so now she's working under that and doing very well. She has all these fantastic indicators for options tradings, and she will be buying or selling your option puts to you based on what you feel the options market's going to do. And she says, no, it doesn't predict. So she asked me for a whole bunch of stocks one time. She wanted to see what stocks I selected and how I was teaching my students how that would work. And so I gave her a list and 5 stocks, and she comes back all excited. Oh, Martha, there's a whole bunch of option puts on this one. And I said, oh, really? And she says, yes. This was quite a few years ago. And she says, yes. And so then I went hunting for him. And I said, who? The professional trader who's has a 5 million lot order, and this was many years ago, 5 million lot order open on this, and that's why he's buying the puts. The stock is going to go up. So she set up her whole parameters for making money on this because she knew that the options trader was using, the professional trader was using the option puts as a strategy to mitigate his risk at a 5 million lot order, which would be about 20 million these days. Okay, so it was huge, and sure enough, the stock went up, and so she was very excited about our partnership. That's Catherine. That's me. We're on the New York Stock Exchange ARCA options floor where she trades and is a market maker, and she can tell me all kinds of stories about how she sees the retail side and how you react. fact, most option strategies were never intended for retail trader use. Most of the complex, exotic, and multi-leg option strategies were designed specifically for options market makers such as Catherine. Some of the multi-leg options were intended only for highly skilled professional options traders working on a trading floor. The reason why these high-risk options are available to retail traders is the requirement of the markets that access is open to everyone. So your broker is allowed to present these multi-legs and these complex and exotic orders to you because that is the requirement that there's an equal level field of anyone who participates has access to the same information. This is detrimental to retail traders who think that they can use this and who are taught that, oh, this is just really great. And when I was very, very young and I was learning from an options trader who was renowned in those days, he said, Martha, the only thing you need to learn to trade is option puts and option calls. That's all. Everything else is just too complex for the average retail trader. How volatility and velocity differ. Volatility means an unstable market condition in which can change suddenly. Velocity is the speed and direction of a stock price up or down. Velocity is the direction of the speed and direction of the stock up or down. Often when traders talk about volatility, they are mistaken as the price action is actually velocity, not volatility. Study this chart. Take a look at the chart. What do you see? Study it. What are the trends? Okay, so what do we have here? We have a bottom formation. What I don't have on the screen is the full bottom. We have dark pools buying into the bottom. They actually create the bottoms. Write it down. You should have a sticky notepad or something and write it down. Buy-side dark pools always create the bottoms. They are the bottom. They bargain hunt and they create the bottoms. Then they go sideways because the improvement is going on with the stock's price. And you can see them pinging here. And they will stay in a very tight, narrow range. Very, very, very tight penny spread. Then it pops up a little bit because HFT or somebody else has pushed it up, or pro traders. This is a pro trader nudge that pushed it up. Then it moves sideways, and dark pools are going, yes, so we're going to still accumulate because the fundamentals are way up above. So they're going to buy a little bit more. And it goes sideways. This is not volatility. This is a consolidation that is going on because dark pools are accumulating and controlling price to the penny spread. Pro traders finally get that nudge to work, and of course it starts running up and up and up. This is a velocity run. Pro traders realize that it's not going to last forever, so they start selling to take profits a little bit early, and then it runs up a little bit again, and then it starts to go down and collapse. So this is a velocity run. There's no volatility in it whatsoever. So no, there's no volatility in this chart. It is velocity. Does this chart have volatility? Study it carefully. We have action going up and down. So is this volatility? No, it is not. It is a sideways trend. A lot of you have learned uptrend and downtrend and no trend or neutral trend. There's no such thing as a neutral or no trend. There's upside trends, downside trends, and sideways trends. There are more sideways trends in our markets today than there were in the 90s or the 2000s or whatever because of the penny spreads. It makes it a situation. Now, right in the middle of this sideways trend, we can see dark pools quietly accumulating. Yeah, they really control that tight spread. And you would normally ignore those because they don't look like anything to you. You want to see big blacks if it's going down. You want to see huge whites if it's going up. And then, of course, pro traders catch the dark pool activity and they do these little nudges. And of course, then it takes off and runs up and then they take profits. And then it runs up a little bit further. So we can see the activity that's going on. And this is not volatility. This is a sideways trend that is controlled by dark pools until they decide they've accumulated all the stock they want. Then, like some other big name people, they'll go, oh, we've been accumulating this stock. And so pro traders get in if they haven't already gotten in, and they push it up, and then it gets into the retail news, and everybody goes, oh, the investors are buying this stock. Well, which investors? They already bought. Volatility or velocity. This is a daily chart. It could be an intraday chart or whatever. This is volatility. Up, down, up, up, down, up, down, up, down, up, down, up, down, up, down. It's a trading range. It's wide. And now this is velocity up, and this is panic velocity running down. Now, what you need to understand is we're dealing with the laws of physics in the stock market. We're dealing with the laws of physics. Physics exists everywhere in anything you do. In order for price to move up, what is it going to take? More and more buyers, more and more buyers. And who speculates the market? Retail and small funds who are not professionals. They keep buying because they see it going up, they don't want to miss out on the run, so they keep chasing it and chasing it. And they drive price up with their buying power. Then all of a sudden, the buyers, there's a void of buyers. All the buyers at that time are gone. So there's a void of buyers. So now the stock is going to just fall back to earth like a rocket that runs out of fuel. Propulsion is gone. The propulsion is gone. But this is not driven down. Price is not driven down immediately. Sell short floor traders of the sell side banks and other professional traders will be, and hedge funds will be selling short, and they'll put their buy to covers way down here. And so they just let it fall. It falls because it has no propulsion. Only when you get into it and you start trying to, a lot of you start pushing it, then it starts being pushed down. But the early days of a top are a fall back to by gravity. It's because there's nothing holding up. There's no propulsion. It isn't always propulsion that causes stocks to fall down. A lot of times it is simply a void of buyers. So write that down. It's important news. Bull cycle of the market participants. Buy-side institutions make the bottoms. They always make the bottoms. They're called dark pools. Wealthy and private investors are mostly CEOs of companies, and they're retired and they know everything about the stock market. So they get in also, but they're not as big of a factor because they hold long term, just like the buy side institutions are long term, long term, long term. Sell side institutions are the five, what's left of the banking system, five big giant banks and one giant financial services company, Goldman Sachs. Everybody else has gone by the wayside. They have floors and they sell short and they buy long, but they do it on a day-by-day basis. They are short-term traders. These are long-term investors. Long-term investors. We have professional traders who are on the buy side who help the buy side maintain the ROI, return on investment, for the instruments and products that they sell to 401ks and offer to 401ks and pension funds and so on, and to investors. So they're always boosting their ROI because if they do, their investors will not sell when there's a war started or whatever. They'll just hold because they know that the dark pools will take care of their money. We also have independent traders and the new traders that are a company that also provide that same service of trading to the buy-side institutions. The sell-side institutions, the buy-side institutions are enemies. They're in this locked war between them that started in 2008. That's another story. Corporations do buybacks. 486 of the Fortune 500 companies are in buyback mode right now. They're doing massive buybacks. Why? Because they got a tax cut. High frequency trading and hedge funds are a professional side, are the professionals on the professional sides, but they trade the retail. All of this is not always visible to you on your trading. Some of it is with the sell-side institution and so on. 80% of all the market activity is on the professional side. Write it down, 80%. Small funds, asset managers are classified by the SEC as non-professionals if they have less than 5 billion assets under management. $5 billion may seem like a lot of money to you, but it is not. These guys hold hundreds of trillions of dollars. Trillions. So this group, they get in late. They are not very good at what they're doing. Sovereign funds and foreign funds. Folks, the stock market of the US is the largest in the world. It will be the global market. We're moving into Europe and other areas, and we're negotiating aspects of it to make it a global market. So deal with that. Everybody trades our markets. Memes groups, retail traders, small lot investors, retail trading chat groups who wait for a recommendation service, and odd lotters. You get in about toward the high, you're chasing the stock and everything else. You account for 20% of all the market activity on the retail side, and you account for all the volatility and most of the velocity. The downside portion is, again, buy-side institutions realize that every company has a cycle from growth to market saturation, or bull to bear and bull to bear. It may be a two-year business cycle. It may be a 20-year business cycle. It doesn't matter. Professional buy-side institutions know that. They start lowering inventory by doing what's called rotation, to lower inventory of companies that are going to go into a bear or a market saturation cycle, because all of their new technologies are now everywhere, and so it's just going to slow down. They bend the curve and round it up nowadays. You'll see the bending of the trend upward, and that's when the dark pools are starting to sell. These also sell or are involved, or corporations are doing more buybacks to boost their stock to keep it from collapsing. Sell-side institutions know that these stocks are poised for correction. They can see the top forming. They can see the buy-side institutions bending of the chart trend, and they are ready to go. High-frequency traders are also huge sell-side shorters. So they all get in here at the top. And of course, when the void of buyers happens, it just plummets down, and they have their buy-to covers way down here. Sovereign funds and foreign funds believe that they should hold, and they're continuing to hold. And they're getting into a bear market without realizing it. Small funds, investment groups also are in denial. Retail traders and chat groups and memes groups get in late. But here, the dark pool buy side will see that the fundamentals are above price. So they'll start buying the stock, slowing down the trend down. They're not worried about it going down because they know it's going to go back up. They know that the company is on its recovery. Meanwhile, all of you are either selling or selling short into the buy-side institutions' dark pool bargain hunting buying, because you don't know what they look like. Impact of dark pool activity for the financial markets. Alternative trading system venues, also known as dark pools of liquidity, have been around now for over 23 years. It's nothing new. Dark pools manage the vast wealth of the U.S. middle class, and I can assure you it's huge. ATS are the peer-to-peer over-the-counter transactions that eliminate front-running of a giant lot order. So alternative trading system venues are dark pools. And it's a dark pool of liquidity because there's no market maker limit order book. HFTs evolved as the market shifted from fractions to decimal pricing. And HFTs changed everything because they once were the So's Bandits. There's a book on the So's Bandits. You can read about it. HFTs, hedge funds, retail groups, smaller funds managers try but do not front run the dark pools because they can't see what's going on. They front run each other. The most important influential market participant group trading in the financial markets today are the buy-side institutions, now commonly referred to as dark pools. So it's synonymous. Buy-side dark pool means the same thing. They control about $400 trillion of assets worldwide. Are they worried about the U.S. debt? I don't think so. They could pay it off in a New York minute. The dark pool group consists of giant buy-side institutions, which are mutual fund and pension fund companies that are private. Number two is derivative developers of ETFs, REITs, ETNs, ETPs, ETCs, crypto-based, etc., and so on, and non-fungible tokens and everything that's coming along our way. An example of a giant buy side is Vanguard or Fidelity. They're private. You do not get to see their earnings reports quarterly. And there's a reason why they stay private, because they're out of the limelight. They can do their job which is to protect the wealth of the middle class of America and the world, and to make money doing it. Derivative developers are State Street and BlackRock are the two largest. There are some private derivative developers, but State Street and BlackRock is the largest. That goes back and forth between State Street and BlackRock. And they are public. So now they have to provide all this information to the investors. Well, yeah, that makes their stock very volatile. Large buy-side institutions who qualify to trade on the alternative trading venues. So there are giant buy-side and there are large buy-side. The giant buy-sides are about 20 to 25. The large buy-side institutions, there's about 100 to 200, depending on the growth of the situation at that time. There's also mid-sized institutions and then your smaller funds, which are not considered part of this group at all. All of these companies are huge corporations or global conglomerates. They're massive in scope and they are everywhere. Banks are sell-side institutions. They do not contribute to the dark pools. They do own some ATS venues that the dark pools use, but they are not part of the dark pools. Okay, write that down. It's important. So I wanted to do a visual graph so you can kind of see what's going on. The SEC has a Midas, and they also have the CAT, Consolidated Audit Trail, and there's a lot of arguing going on about that, but it's important to have. If somebody causes the market to collapse, the SEC has the right to find out who it is and find them. And since 2010 was the last market fiasco collapse and the CAT initiated, we've not had that massive collapse that endured for a long time. Okay, so this is dark pool activity, striking the penny spread. It's very narrow. Sometimes it'll go up a little bit and then down. Sometimes it'll dip a little bit lower, but it's very consistent. Then you have your pro traders who are monitoring that and they're trying to nudge the price up because they know if they do, then they'll get an HFT gap and they'll ride the gap up. Yay! Yeah, they don't have to do anything. They just have to nudge the HFTs or other activity that's out there, hedge funds. And then we have our HFTs and our other professionals and hedge funds and all this other going on, trying to push price and get you to react to it emotionally. And this is you. Yep. So dark pools are hidden. They can delay their orders until after the market is closed, so there is no possibility that anybody has seen a dark pool order. Now, some of you will say, oh, I know somebody who says they found the whales. It's like, oh my gosh, whale. That term is from the 1950s. Yeah, we know how old that person is. So they didn't. They find small funds managers. They think 5 billion is a lot of money. It's not. These guys are trading trillions of dollars, and they trade it every day. Okay? What about AI? I just finished a course for my students about AI and how it is being used by the various professionals of the financial markets. How the professionals of the market use AI is totally different than what you hear on the retail news. Retail news is telling you a big fat lie. AI does not choose stocks for professionals to trade. Repeat, AI does not choose stocks for professionals to trade. They don't. Why? Because the SEC, as soon as AI came out in 2023, SEC said, no, you can't trade it. It's too dangerous. So they don't. And plus, professional traders have high self-esteem, if not a little ego. And they want to find their own stocks. They don't want some AI to do it for them. Rather, AI is an additional tool incorporated into their trading system, procedures, and analysis. And what do you think they do with AI? What do you think they do with AI? AI is capable, and its best task that it does efficiently is analyzing metadata in milliseconds. It is used for understanding the overall market conditions, risk factors, etc. from the retail side. So you're in a chat room and it's open, and you're in some other charting software and it's open to everybody. Anybody can follow it. And there's retail news, and there's chat groups, and there's all kinds of things going on in social media. All you guys are talking just before the couple minutes before the market opens, or something's going on like that. Yeah, and AI is going suck, 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 all that mega data, and then it instantaneously can dissect it and shoot off analysis and tell the professionals where you're going, what you're doing, what stocks you want to trade. HFTs go, oh, there's a whole lot of interest in XYZ, so we're going to fill the queues with 100 to 200 lot orders, fill it with tons and tons of orders, and we're going to gap that stock down or up or whatever. HFTs can fill the queues with 100 to 200 lot orders. It is not the size of the order. It's the quantity of the orders. Write it down. It's the quantity of orders that triggers the computers of the market to either gap up or gap down a stock based on the HFTs filling the queues with small lot orders. Okay? You got to understand this stuff or you're always going to be on the losing end of it. Functionality of the market since AI introduction. Yes. You have been told that trade wars, real wars, and tariffs are bad for the stock market. Then why has the stock market been moving up since April of this year and moved up strongly in prior years during tons of conflict over time? It's untruthful that the stock markets are seriously impacted by war. It's not truthful. New technology. There is only one thing that drives the market upward strongly. In the 1990s, we had 6 new technologies. In 2010 to 2016, we had 1 new technology, cloud technology. So it wasn't a great bull market. In the 20s, they had 10 new technologies. So it was a great bull market. In the 1990s, it was a great bull market because we had so many new technologies. Guess how many new technologies we have today? They're coming to market, emerging faster and faster because AI is that catalyst that generates new technology and advances new technology faster than anything. 20 new technologies. This is going to be the greatest bull market of all history. It's underway, and you think we're headed for a bear. No. The market ignores the war entirely. They could care less. AI and market conditions. Do you believe that AI creates volatility? Do you believe that AI can predict the future? Nobody can predict the future because as soon as a prediction is made, it changes the future. Do you understand that the stock market cycles and that there are 6 primary conditions? There are 6 primary market conditions. Do you know which market condition is a true volatile market condition? AI doesn't cause volatile conditions. The professionals of the market do not use AI for selecting, or finding stocks to trade. They're far too better. They're far more capable than an AI is capable. And it will be, if ever, the AI will be able to do it because it can't understand the language. And folks, the stock market chart is a language. They only use AI for millisecond routing to fill their orders on the millisecond scale. So they see your orders. They know what's going on. They can route an order in a millisecond or less. How many milliseconds are in a second? 60,000. No contest. You either get with the plan and get with the pro traders, or you might as well just go to a casino because you know you're going to lose money and you're going to lose money in the market. I want you to be successful. If you can't be successful and you just want to play around, that's okay, but you do more damage than good, and not just to you. So I want you to understand this in a complex thing. This is a millisecond transaction chart, okay? With their ability to trade on the penny spread, dark pools can control the movement of price up or down with minimal impact on the price while they're in accumulation mode. So they accumulate over weeks or months. Rotation also functions similarly. So when they have to lower inventory to take the money and use it elsewhere, it's a slow process. Dark pools tend to use quantitative analysis formulas to determine the price range within which they will buy or sell a stock. So, ping, 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 ping. Dark pools are busy buying a very low price stock, and pro traders catching that runs up a little bit and then it comes back down into the zone because the dark pools are continuing to buy in this zone. See this little slot, this little purple slot? That's where their buy zone is. It's very narrow. And then it pushes up a little again, and then some smaller fund decides to sell, and it causes it to go flat again. And then a little buy zone here, and then pro traders push it up and nudge it up again, more selling by smaller funds, capitulation, and then pro traders sell it up again, and then all of a sudden it catches a big order. Catches an order that's a small funds manager who's buying. But then there's no more buyers and it kind of trickles back down. This is a millisecond scale. Okay, so this is happening so fast. If this screen was actually running, you wouldn't be able to see it. You blink your eyes and this whole screen is filled. Okay, then it comes back down. Then all of a sudden, retail news gets the blast. Oh, buy this stock. And all of these orders just fly up this chart. Okay, these are all pro traders and other active going on, pushing, pushing, pushing price up. And you get in here. See these big blocks? These are you. And you get in here, and then of course it will collapse back down. They're trading on the millisecond. If you don't join the party, you're going to be left behind. The only way to join the party is to study charts in a manner where you read the chart like you would read a sheet music or a program or whatever it is that you do professionally. Okay, so dark pool buy zones and momentum surges. Dark pool buy zones are not a momentum price action. The dark pool's intent is not to move price, but to strike a penny spread to achieve a desired price within a set price range. As the dark pools buy over many weeks and months, they slowly impact the liquidity of the stock. That creates a liquidity draw that professional traders can identify with relational technical analysis. When pros find the liquidity draw, they begin buying the stock for a short-term trade. This creates more demand and volume increases slightly. Okay? Write some of this stuff down because you won't remember it. At this point, the stock is poised for a sudden huge gap or large up day by HFTs. So they know ahead of time what's going to happen. The dark pools cease their automated buy zone orders, waiting for professional traders, followed by HFTs, followed by smaller funds, and then followed by the retail crowd to start buying the stock, creating the speculative momentum runs that always follow dark pool buy zone completions. Dark pools create the bottom. They create these platforms that are very tight sideways action. Professional traders identify, start nudges. HFTs catch the nudge, and they gap the stock up. Okay? Smaller funds follow, and then you're chasing the stock. This is what you do every day. So you need to learn relational technical analysis so you can find the nudges so you can get in early. Let's talk about the market participant groups. You need to get to know these guys. Market participant group, professional traders. There are professional floor traders, proprietary desk traders working for either the buy side or the sell side, specific to something proprietary for that company. Independent professional traders. They are aware of the entire body of market participants, what each is doing, and how that market participant impacts price action. They are aware of who they are trading with and who they are trading against. Professionals use special order types and commonly trade 1 to 5 million shares or more in a single transaction. They use special indicators to identify which side of the transaction a large lot triggered. Independent professional traders hunt the dark pool buy zones. They can create candlestick patterns called nudges, which trigger HFT automated orders. Okay? So now I get to know the high frequency traders. High frequency trading systems are fully automated, the only ones in the whole market. HFTs dominate at market open. HFTs use AI interpretive algorithms to pre-program orders. So it's all set out automated. HFTs fill the queues with thousands of small lot orders milliseconds ahead of the market open. The computers of the market then adjust the stop prices up or down based on the number of buy orders versus sell orders. It's all intentional. HFTs create the huge gaps at market open. This is why your trading orders often whipsaw or may have poor fills or start up high and then collapse and you take a loss. It's fully automated. It's the only one in the whole market. What is market condition? Market condition is the cycle of the bull or bear market for the stock market and any other financial market. There's a bottoming market. Dark pools control this. Platform market, that's what we are seeing right now. Lots of platforms building because, oh, the retail traders are just sure that the market is going to go down. It's not. We have too much new technology. Moderately trending up or down, this is what the pro traders trigger and create. And it moves moderately up and moderately down. That's what we're in right now. Velocity up or down. The down, of course, is for the bear cycle. Velocity is what you create speculative action going on because you're excited or small funds are excited and buying speculatively without any reason or rationality behind it. Topping market, the buy-side institutions start it, the sell-side institutions take over, and they allow price to fall, creating their buy to cover so low. Trading range is the only one that is a volatile, unstable price action. Fortunately, they hardly ever occur. The last one was in the 70s. Individual stocks will have volatile price action, however, and you have to be careful with that. So my market condition analysis scans are like a wonderful AI I created years and years ago before AI. I had a trading floor and I realized that futures could tell me what the market would open like, but it wouldn't tell me what the market was going to do all day long. I needed my traders to know how the market was going to behave after the futures. So I created these 7 analysis scans, and they've stood the test of time. They still work beautifully. I say to the market, give me all the stocks that moved with momentum to the upside. Give me all the stocks that moved to the downside. So we can see upside, downside. I compare the two. The one that has the highest number is the bias for the next trading day. I do this in the evening after all the market analysis is through because the buy-side institutions hold and delay their orders until after the market closes, and then they send them to the National Clearinghouse. That's why you don't see it on intraday at all. So we have those. We compare that. Then I look at all the activity of the institutions. What are the institutions buying? Are the HFTs chasing the institutions? What's going on? What industries are they buying? Then I look at the bottoming activity. Give me all the stocks that are in bottom formations, long-term, short-term. I just want all of them. I want to know what's going on with those because that's where the dark pools start the next level of strong growth up. Consolidation is the next one. I check for consolidation because pro traders' nudges are very small, so they're tight consolidations, and that tells me what's going on with the pro traders. Then I say, give me all the stocks that are turning in a trading range, a volatility range, and see if this chart, this scan and this scan are very high and everything else is low. That tells me that there's going to be a correction or a bear market. Very, very reliable. Then I say, give me for the month the price improvement over time. How many stocks actually had price improvement over the month? I can tell whether we have more activity that's sideways, what's going on, and if price is improving or just flatlining. And these scans have stood the test of time. They're only available to students because it takes time to train you on how to work this. You study what I say. I have the trading journal, and you use that, and you study, and then you learn this over time. It's not something that's you can learn in a weekend. So my analysis says, who's in control of price? Which of all those market participants I showed you control price? What technical patterns are prevalent and reliable? Not every candlestick pattern is reliable in every market condition. The risk of volatility or the opportunity for velocity runs. Okay, that tells me how price will behave at resistance and support. Different market conditions have different resistance and support levels, entirely different. And don't use percentages. If you're going to use a stop loss, use the resistance and support levels. What trading styles work best? Which indicators to use? The inherent risk in trading specific styles. My students have 2 trading styles. They usually use swing or platform position. A trading style gives you the strategies to use. Day trading is not a strategy, it's a style. What trend line patterns are common? Which entry and exit signals are most reliable? Is it a springboard? Is it a pole vault? Is it a hurdle? Is it a nesting candle? A resting day candle, meaning that the pro traders are waiting for the stock to move. There's all kinds of new candlestick patterns to learn that are current in our market that are not in the older candlestick books. The strength of the price and volume patterns combined. This gives you the strength to continue to move up. The technitrader difference. Professional level education to retail traders, relational analysis, hybrid leading indicators, and so on. A professional style trading journal. You should all have journals, which provides written evidence of your activity trading as a business. All of you should be working toward getting trading as a business status from the IRS because it saves you buku amounts of money on all the expenses you pay for your trading. And also historical data to consider and compare over time. Your personal trade management planner. I walked into the office one day and Howard's working on this and I look at it and I'm going, oh, this is brilliant. He says, well, I just wanted to streamline my trading. And I looked at it and said, all my students need this. He says, really? I said, it provides a monthly plan of your monthly trading goals. Number of trades based on your capital, yeah, and your and stock price range that you should use, your risk assessment, your risk tolerance, profit potential, and over process. You plug in the numbers and it spits out the number of trades you need to do, the stock price range, the risks you should be taking, all this stuff. It's fantastic. It's amazing. And all my students come to me and they go, but Martha, it says I only have a few trades to do. And I said, yes, because in the market, trading less means more profits because you're being pickier about what you trade. You're not just trying to trade hoping you'll make some money. You're trading going, okay, well, I'm going to only pick that one because I only have to do so many trades this month to make my goals. And every month, the goals for that month is going to go up and up and up because you'll gain confidence. Everybody keeps saying, how do I discipline myself? I said, gain confidence. It's very simple. Trade calculators and other tools that streamline accuracy and execution. Also, Howard Johnson, brilliant things. The most common mistake is math that you make. Most common mistake is math. And this gets rid of that. Does all the work for you. Scans, sorts, layouts, and parameters for your trading style and market condition. I share my scans, my sorts, my layouts with my students only. Trading simulator. You must have a real simulator, not a game simulator. This is not a game. This is not a casino. It's not the casino against you. It's all these different market participant groups, different trading and different aspects. On the retail side, it seems like it's a casino because you're missing 80% of all the knowledge you need because you're not accessing that knowledge. Market condition analysis scans, which I just showed you, are part of the thing. Controlled bracketed order types. Howard created this order type, and I come back because I never watched my stocks. I went ice skating in those earlier days, and he was creating some things for our new courses. And I come back, and he's talking, he's laughing, and I said, who are you talking? He says, oh, Herzog, the market maker. I'm like, and my jaw just drops to the floor. New York Stock Exchange? Yeah, he says, and he goes on, and they talk and they laugh as if they're best buddies of all time. And of course, he gets off the phone, and I'm going, what are you doing? You're talking to a market maker from the New York Stock Exchange. They never talk to anybody. He says, I know, but I really needed to make sure that my controlled bracketed order was right for our students. And I said, and he loves it. Herzog wants to use it on his floor, and he asked my permission. And I said, yes. I said, of course you said yes. And our controlled bracketed order is still there today. And we teach you that. It's brilliant. It's absolutely brilliant. Morning market open reports and market condition reports are part of the first 30 days of your trial. Daily market educator, discussion groups and communities with executive traders, student-only campus online. What this means is AI can't find us because it's a hidden campus, because it's a closed campus. You have to be a student or you can't get in. And you get to talk and read and listen and hear what professionals and semi-professionals and students that have been around for a while, what they're doing. It's very exciting for the new students, very exciting. Tutoring and coaching for new students and answers to all your questions. We're very dedicated. My staff is often working on the weekends, and I am too. Although we should take it off, we are answering questions to students. So we're really, really involved with the students. I'm really committed. So I'm committed. I'm doing this in my retirement. This is my legacy. I could be doing anything else. And there's not a lot of money in education. I mean, look at all the universities. They need to always have sponsors and all this stuff. I'm doing this because I have a passion for it. I'm doing this because I care, and I know if you learn this stuff that you'll be able to do it. So you can come to our website and start here and see the whole library. Or you can start here. If you're a beginner, start with the introduction. If you're 2 to 5 years of experience, visit the professional trading plan and see what that does. Relational technical analysis is for those of you who have more than 5, 10, or 20 years, and you realize that if you really need to do something about fixing the problems. So these are all free mini courses. You get to experience how we teach. And if you like it, that's great. If not, you can move on. I really should have taken this course 10 years ago. Paid for the course on my first trade using your scans. Results have shown it's a bargain. Changed my family's lives. Beyond what I was expecting, gains exceed cost. I had a recent one that just came in from a student that had been very reluctant to sign up, and he's just mind boggled by all the education he's gotten, how easy it is to learn, and how it's laid out very professionally as a university would do. So this is our free 1 hour training video. You have 7 days to access it. You sign up here. You can use your little smartphone, or if David can type that in, that link into the chat box, I would appreciate it, David. So it's an introduction to relational technical analysis. It's very exciting. You're going to find all kinds of things that you're going to be learning and identifying. How to identify market control, who's in control, professional level analytics, next generation indicators, and all of this. It's very, very insightful, and everyone who watches it just loves it. So take the opportunity. Even if you say, well, I just don't want to be a student of yours, that's fine, because I'm not right for everybody, because I am committed. So I want my students to be committed to their success. Okay, I'll take any questions that you have. Any questions?
Yeah, we have a couple minutes left. If anyone has any questions, go ahead and type them in the chat.
Well, I guess I answered all the questions. David, it was a lot of fun to be here today.
You gave them a lot to think about. They're still processing.
Yeah.
All right.
So, yeah, it's a lot to process. I usually have considered a fire hose of information, but
Yeah.
think about it and come to the come to the website, look around, see what you can find, check it out. It's not a hard sell. We don't hammer you to death until you feel like you have to buy. Either I'm right for you or I'm not. And I'm looking for those students who really love education and really love the learning process and want to be successful and are tired of losing money.
All right. Sounds good. Well, everyone be sure to hit Martha's link there and check out her course and site.
Yeah, thank you, David.
Thanks, Martha. Thank you
Bye.
for being here to open the day for us on day 2 of this Active Traders Playbook event. So, in case anyone missed this before, I am recording each of the presentations individually. I'm also live streaming to YouTube, so the entire event is archived instantly to YouTube, and then separately the individual recordings are also uh, on YouTube as well. And right, so right, well, hold on just a second. All right, thank you again to Martha.
You're
And
welcome.
post
Anytime.
her link in there one more time for everyone to check out. And all right, next up is Rob. Rob, are you there?
I am here. David, good morning.
Morning. How are you?
Doing great, thanks.
All right, you should be able to share your screen and get set up now.
Great. Look good?
Okay. Yeah. Um, just double checking my setup. All right. Yeah, looks good. All right. And you're ready to start?
I am. We're
Okay.
having one heck of a storm here in the mountains, and I use Starlink, so fingers crossed that
Oh, okay.
we stay good throughout the whole presentation.
Okay. Well, um, yeah, if something happens, we'll deal with it. But hopefully it keeps going. So, all right, I'm going to start my recording again in just a second, and then you can start your presentation. So, I am recording again now.
Good morning. This is Rob Roy of LA Wave Options. Look forward to presenting for you this morning. We're going to talk about AI powered Elliott Wave. And right off the bat, if you're like, I don't know about Elliott Wave, if you're not necessarily an Elliott Wave fan, I encourage you, hang in there with me. I think you're going to be one by the time we finish this presentation, if you're not already. And if you already are, I think I'm going to show you something different that you will find quite eye-opening. I feel like it's a different take. And then on top of that, it's AI-ified. At this point, I'm going to go ahead and turn my camera off. I just wanted to show you that I am here and live. And at this point, I want to focus on the presentation rather than having distractions with the video. So what we're going to talk about during this presentation is LA wave analysis versus trading opportunities within the wave three. That's the first start of something that I'm going to do a little bit differently than what anyone with some familiarity with LA wave may know. Talking about AI, talk about we AI-ified Elliott Wave, which is what's really exciting at this point in time. You're either trading with AI or you're trading against it. So I prefer to trade with it. We'll show you actual performance, real performance, not back testing, paper trading stuff, actual alerts sent out to our subscribers. And we're going to go through a Wave 3 trading plan in detail. First, to start off with, especially when we're talking about Elliott Wave, there's two primary different ways, and I run into this all the time. I do a YouTube show on the weekends, and I get questions along these lines. There are LA Wave analysts and there are LA Wave traders. Consider myself to be more on the trader side of things. On the analysts, they're manually identifying counts, which I think is next to impossible to do. If you've ever seen the actual Elliott Wave algorithm that Ralph Nelson Elliott himself wrote, it's 20, 30 pages of actual mathematical code. If you can do that in your head, more power to you, but most people can't. So we use an algorithm and I use a software that's programmed exactly to the algorithm that Nelson Elliott wrote. Limited markets analyzed when you're an analyst. You don't have time to do the entire markets when you're going to that kind of a analyzation. And we look at wide markets. There's a deep dive that you can go as far as labeling waves, subwaves, minute waves, subminute waves. You can really go down the rabbit hole and get into the paralysis through analysis standpoint if you are a true LA wave analyst. I view it more on the high side. How does it apply to trading? What signals is it giving me as far as where an individual stock or the market itself may be going? Analysts that has a longer term focus. We have more of a short term focus, and an analyst you look at market trends, likely turning points, and things like that. I'm looking for immediate trading opportunities and as many as we can possibly find. Now, here's where things may be a little bit different, even if you have some familiarity with Elliott Wave. I was asked in this presentation to give my favorite strategy. This is my favorite directional strategy of all the different strategies that I trade. So you're going to see the top of the top here, and it involves a zigzag within a wave three. So understanding the terminology first as we go through and talk about this. A zigzag is technically referred to, and this is the way you'll look at it if you have a general LA wave analysis, as a corrective wave. I use it as a directional wave. And a lot of times people say, why do you call it a directional pattern when it's a corrective pattern. It's only labeled a corrective pattern because a zigzag is one of the three patterns that comes after a wave 5 sequence ends. So when a wave 5 pattern ends, it goes through a corrective phase, stock market, whatever you're looking at. It'll go through a flat, a zigzag, or a triangle. Those are the three corrective patterns. So a zigzag's in there, technically labeled as a corrective pattern. But as you can see on the screen, it's directional in nature. It's three segments versus five. So already, if you are more of a shorter term trading mindset, this is something you'd be interested in. Why do we want to wait for 5 waves when we can do all this in 3? And I think that's interesting on its own. They're basically the same thing, corrective pattern, directional pattern. It's just labeling that people get caught up in. When you see the illustration on your screen, the graphic is showing that the wave C moves and looks at Fibonacci numbers. We're going to talk a little bit about Fibonacci numbers here. Elliott himself, being a mathematician, I don't know if you know his history, but Elliott wave was invented 120 years ago. And Elliott was a renowned mathematician. He worked for the railroads, became physically debilitated, but still sharp in the mind. That's when he got interested in markets, and that's when he felt like he could create an algorithm that would analyze what the market had done and give a reasonable assumption of what it may do from there. That's a quick uh, history of Elliott if it's new to you. But looking at these extensions, that's where we look to go as far as where our price targets are going to be. And that's key because we're trading in the wave 3. And if you're again familiar with Elliott wave, you've probably often heard stay away from the wave 3. 1, 2, 3, 4, and 5 all form and then come in and trade the wave 5. That giving you a higher percentage chance of being accurate if the first 4 waves have followed all the rules, and then you come in and you trade the 5th wave. I disagree because it's also widely known or accepted that wave 3 is the strongest of all waves. Doesn't have to be the longest, but it's the strongest of all the Elliott wave individual segments. That's what Elliott called them, segments. And why would you want to stay away from the strongest one? That didn't make sense to me. Now, the reason people say stay away from the wave 3 is because it's difficult to figure out where it's going to end. When does the wave 4 correction start? And with that in mind, I found a way that we could give a prediction of where the wave 3 may end. And that's by finding wave 3s that have that zigzag, that ABC pattern within them. We're going to go through all the rules on how zigzags work, etc., how to look at the targets on where the wave 3 may end. So my focus is right there, trading the wave 3 and looking for a zigzag within the wave 3. That's the gist of the strategy. We're going to go way deeper into it, but that's it in a nutshell. So it provides a location to enter within a strong wave 3. So we're going to go through the rules on how to know when a wave 3 is starting. The algorithm never labels wave 1 and 2 before the 3 is labeled. So you start 1, 2, and then the 3 comes in. Zigzags provide targets for exiting as well. That's the key. That's what I was focusing on because that's why people say stay away because then that wave 4 correction's coming. Sometimes that can be rather volatile and you don't want to get caught on the wrong side of a trade if you've been bullish. So this will help give us targeting ideas on when that wave 3 may end. This is what we've done that's really exciting as far as moving through the patterns on these wave 3s within Elliott wave, AI-ifying them. To give you some background, and I'm moving rather quickly because I want to get through all of this stuff. There's a lot of information to talk about. Obviously, David told you the sessions are recorded if you want to go back and look at them. Personally, I started working with the Hub organization, hubb.com, based out of Australia, to take some searches that I've been working on. I've been trading, just to give you a little bit of my background, I've been trading for nearly 30 years now, trading Elliott Wave since 2001. My previous career was as a golf professional. I was a golf pro right out of college for almost 14 years. And then I moved into the world of trading. I was a financial advisor, registered securities principal for 2 years. Didn't really like that. And on top of that, they weren't going to let me trade options. So I said, well, okay, goodbye. And I've been trading ever since. No, that's my background. But I wanted to see if I could take the systems that I had created, and I'd gone through the thousands of hours of back testing, et cetera, to come up with a trading system that I liked, and I felt worked and felt confident in, and see if I could make it better. And that's when I started working with Hub. And their data scientists there created AI. I'm going to show you a little bit of it to help take those indicators that I looked at and supercharge them, if you will. And the calculations I started sending out in a customer alert service back in 2021. So I do think we've been in the forefront here at LA Wave Options for trading AI. This is where it's going. As I mentioned, if you're not trading with it, you're going to be trading against it. So you might as well join in early. And I think we have one of the longer published track records of actual alerts being sent out. So how do we use AI to rate the trades setups? So those data scientists provide extensive input data for the algorithms when assessing trades. And they look at price and volume, indicator values, benchmark comparisons, indicator value rankings, statistical measures, intermarket correlations, economic cycle data, and company options data. Now you could look at that and say, all right, well, I can find all that information on my own out on the internet. Why would I need to look at this algorithm? Well, if you have massive computing power and tremendous amount of time, and then you understand these models, yeah, you could. And so when I was talking to the data scientists, they were telling me, yeah, we use regression, clustering, random forest, ensemble, and neural networks, just to name a few. And I looked at that, and I consider myself a fairly intelligent person. At least my IQ score says that I am. And I was like, okay, I don't really know what you're talking about. I do know what a neural network is. Basically, that's when you give the AI a problem or a situation, and you ask the AI to solve it. That one I knew. Some of the other ones, not too familiar with. I've become familiar with over the time. But in the beginning, I was like, okay, well, can you send me pictures based on, all this testing that you go through your life, et cetera? I know that I was a visual learner. I like to see things and visualize it. And if I can visualize it, then I can interpret it and have an idea of what I'm looking at or what I'm reading if I see pictures. So they started sending me these data points. There's over 300 of them in the AI algorithm that they wrote. And we'll talk more about how AI integrates with LA Wave in a moment, but this is all separate at this point. So you can see the clustering. That's going to be key. It looks like an ultrasound to me. I think that's what it looks like. That's my first thought. And so they started sending me some of these, and every one of those, you can see the coding at the top. Every one of those is a different code for a different set of data points that they're looking at. And again, there's over 300 of them combined into the algorithm. All right, so how does that work then? Well, after going through and individually placing all of those different data points, they look for where are the correlations. You can see the groupings, the clustering in each one of those little, again, ultrasound looking diagrams. So each one of them is showing you an area where this data point looks solid, where the majority of all the data points correlate together or cluster together. Now think about how powerful it would be if you looked at over 300 of those and found where all of them agreed, all of them clustered together, all of them came together in correlation with what they were showing. Imagine the power of that. That's the power of AI. That's what we're doing moving forward. And that's what the data scientists have done to the technical system that I was already using. So when you take a look at signals, the AI then makes it easy. You don't have to be able to read an ultrasound in order to do this. They give you just a little bar up here at the top. You can see an AI confidence score. So based on where all of those different clusters and all the different data points agreed, they come up with a score. The score is from 0 to 100, just a normal scale on giving you an idea of where things may go. And in addition to giving you a target price, they also give you a fail zone. I get asked that question a lot. Well, what about a stop? That's what the fail zone is used for. It's basically a stop on where you would get out. So again, clearly far more sophisticated than an average trader can do mentally by hand. If you had extensive data computer power, ability to program, plus data science know-how, hey, maybe you're creating your own AI program. Other than that, you can access this at hub.com. www.hub.com is where the website is, and they're going to make the AI signals available a little bit later on. You can get some of them now, but I'm going to show you the best way to go through that process. All right, so how does this work? Talk to you about zigzags within a wave three. Been very general so far, but we're going to get specific on the rules that we look for. But before, when I was in attendance of a webinar, seminar, still feel that way today. I want to know, is this worth my time? Why should I be sitting here listening to this when I could be playing golf or doing something else? The track record is what speaks for itself. So when you look at our track record, and it says hypothetical portfolio, and that's because when we send out alerts, we send them out assuming that a person has a $5,000 account. And that's how our risk management is based. We don't send out alerts to customers with over 5% at risk. So $500 is the most that will send out at risk in any one position. So it's not a lot. It's not like these are swinging for the fences type things. And you can see on the graph to the right there, it's moving lower left to upper right. And there's a little bit of dips in the way. It's not a linear line moving all the way from lower left to lower right. There have been some dips, but it still moves to the upside. Then when we look over to the left, the average ROI, and I'm going to show you some examples of this towards the end here and actually give you one to follow. So we'll actually give you an alert to take a look at, follow in your own time, see how it works. But average of 22% return on investment. You're like, that's not that exciting. But it is if you can be right 84% of the time, which is what our track record shows. And again, these are documented alerts sent out to subscribers. This is not back testing or Monday morning quarterbacking, anything along those lines. These are actual alerts that were sent out. And you can see the performance down here at the bottom of the page from the different years. We started this particular strategy. I did send out AI alerts in 2021, but this particular strategy that I'm sharing with you, and again, my favorite strategy, started going to alert subscribers in 2023. So you can see the numbers are pretty strong. I'm going to step back a moment here because I can remember when I first started trading, if someone had told me that they had a system that was accurate 84% of the time, I would have turned around and walked away and thought they're crazy. That's not doable in the world of markets. But it is. This is documented from alerts that have gone out. So you can see all the different numbers and metrics. I'm not going to go through all of them. I'd like to move over to the far right-hand corner where you can see the maximum number of winners in a row and the maximum number of losers in a row. Now, these are on closed alerts. So you can see in 2023 and in 2024 had a pretty good 19 consecutive winners, 14 off to a good start this year with 17 consecutive winners in 2026. But look at the max losers. In 2023, we had 19 consecutive winners. We did have 5 consecutive losers. So it's not always right. Nothing is 100% right. This will be wrong at times. We will have losing trades. So nothing is going to get you to the point where you're right 100% of the time. So I wanted to go down and show you there's the portfolio returns and then the trade returns. And keep hitting the button. Sorry about that. So the difference there, notice on the portfolio returns, there have been a couple losing months. So going through from September of 2023 through where we are right now, and these numbers are updated through April of this year. So through April of 2026, there have been 2 losing months where the portfolio actually went lower that month. That's pretty darn impressive. I think you would agree. And then if we look down at the trade returns, yes, there's losing trades for the month, but very few along the lines. So again, not trying to say it's never wrong, not trying to say there's never a loss, but the track record is pretty darn impressive. All right, let's go deeper now into exactly how this system works. You saw the results. Now let's see how we got there. Borrowed these rules from Elliott himself. He's big on rules and guidelines. Those are two things that he likes to talk about. And I got so into Elliott Wave, I went past what's published. Started reading his individual notes because he actually has observations as well. What's published is Elliott Wave rules and guidelines, but he made observations. I'll share some of those with you as we go through as well. So when we're looking at one of these zigzags, and an important thing to remember within a zigzag, another reason why this is so powerful, every 5-wave pattern within Elliott Wave starts with a zigzag. Not every zigzag turns into a 5-wave pattern, but every 5-wave pattern starts with a zigzag. So we look for A. No way to figure out when a wave A is going to start, the A impulse. But after that, that's when we start looking for these rules and guidelines. As a rule, and just if you're wondering, well, what's the difference? If a rule is broken, then the pattern is immediately disqualified. So that's how Elliott designed it. If one of his hard, fast rules is broken, then that's a disqualified pattern. Move on to something else. But guidelines are, okay, it could be in here, it might be here. Those are things to keep an eye on, but it doesn't necessarily disqualify a pattern. So we have the A wave impulse, and then we start with the B wave correction. And when that B wave correction starts, by rule, 20% of wave A must be corrected to qualify. Now, there's a difference between qualification and confirmation. So qualify and confirmed. Qualified and confirmed are two different things, and we'll go through that. So as a rule, you have to have at least a 20% corrective move in the wave B. Then Elliott's guideline was, and one of the things that he would talk about a lot, is he would like to see the wave B go down to 30%. Now, part of that is because there is a fib level at 23.6. 23.6% is a fib level. And he didn't really trust that that was a full-on correction. He felt like that could be more of a pullback and a continuation of the previous impulsive move rather than actual pullback. So he wanted to see a pullback towards the 30% line. Ideally, we get to 38.6, which is a stronger Fibonacci number than 23.6% is. So the rule is 20%, guideline is 30%. And again, those are based on Elliott's own analogies. So if you see a B wave that moves down to 70%, Elliott would say that if it hits 70%, 61.8%, by the way, the fib level is my favorite of all Fibonacci levels. To me, it's the strongest one. So I like it when the B wave corrects right to that 61.8% level. And we're going to go through different ways of trading these zigzags based on different B wave pullbacks. So Elliott's thought was if it goes 70%, if the B wave correction is 70%, you're more likely developing a flat, one of those sideways patterns. Again, a 3-wave sideways pattern, one of those corrective phases, flat zigzags and triangles that come at the end of a wave 5. So he said that it's likely more of that, with a slight caveat that there's still that 78.6% fib level. That's the last bastion of fib support before it is fully disqualified, the pattern. But again, he would view this as if it's going to get to 70%, it's likely going past that. It's likely a flat, but not every time. So there is that small percentage of time when the B wave moves to 78.6. A quick thing, if you're a currency trader, if you're interested in trading currencies, the 78.6% level in the currency markets is as it is to 61.8% in equities markets. So just a little side note there, depending on which markets you trade in. So the wave C, again, staying with the rules, must be longer than 90% of the B wave by price. So again, we're looking at the price movement. So 90% of the B wave. So how far was the B wave? We measure that. And then we look, well, software does it for you, but it takes a measurement. And when that C wave gets to the point where it's 90% or more of the B wave corrective phase, then you now have a good qualified wave C. And then we can start looking for where it may go. So more rules. Wave C is most likely to have a price level similar to the movement of A. So again, measure the length of A. That gives you a rough idea. We're going to get a little more specific, but that gives you a rough idea of where the C wave is going to go. So already we're helping by having this information for training a zigzag within the wave 3 of an Elliott wave pattern. So oftentimes that C wave is the exact same price movement as the A wave. The second most likely is for wave C to be 61.8 of wave A. And then the third is if you go to 161.8. I'm going to talk about that for a moment too, because that's one of the things that I've discovered over time in trading in these wave threes with the zigzag is that more often than you would think, you would get an extended C wave to that 161.8% level. So continuing on, here are the three breakdowns. The most likely is that you're going to get a B wave that retraces 38.2%. The reason it's the most likely is to get to the next two levels, you got to at least go to 38.2. So if you have a B wave correction that's 38.2, so that fib level, your C wave expectation is an extension of 61.8, not that rule of or guideline that the wave C is going to be the same distance as A. So that's important. If B only corrects 38.2, C is going to extend 61.8, not 100%. If we do get a B wave that corrects 50%, it's the second most likely because, again, you had to hit 38.2% corrective level to get to 50%. So if you get a 50% B wave correction, then that does yield that 100% extension of the C wave. So again, the move from B to C is the same as the move from the starting point or what's labeled the 0 point to A. And then my favorite of all, and it says that it's the third most likely, just because you've got to hit 38.2 and 50 before you get to 61.8. But as I mentioned, 61.8 is a strong fib level. It's my favorite fib level. I love to see the zigzag set up this way. This is the one that I have the most faith in. If you get a B wave that corrects to 61.8, you're still looking for that 100% extension on the C wave. You've just bounced off of a stronger fib level at 61.8. Forgetting Elliott wave and all the Fibonacci levels, etc., when you look at the second most likely one, widely regarded, old school technical analysis, when you have a directional move, oftentimes you'll get a 50% correction. So that one's just kind of general. But the first and third, the 38.2 and 61.8 are highly correlated with Fibonacci levels. And here's a trading plan for trading these zigzags. Pretty simple plan as we go through. Look for a basic setup, which is a signal day. Qualify the trade, risk versus reward. Enter when you hit confirmation. Talk a little bit about that. That's important. And then when to exit. Justin, some could argue even more important than entering a trade is when to get out. When do I take my gains? When do I take a loss? All those kind of things. Getting in is a lot easier. I do talk about the DMI a lot. It was an indicator created by Wells Wilder. Most people look at RSI. One of the reasons that I don't is because so many people do. And Wells Wilder created the DMI with the ADX indicator in there as well. And that's my favorite confirming indicator to Elliott wave. I don't think any trader should rely on any one indicator. You create a system. That's to me giving you your best edge, your best chance to be successful is to have a trading system. And mine is comprised of some confirming indicators that then are used to complement Elliott wave. And then we took it to the next step with AI. So that's been the progression. And I really do like the DMI as a good indicator of strength and who's currently in control. So let's look at a trade setup and how it would work by applying these rules and guidelines. So we've identified the B wave correction. We know that it's gone at least 20%. So we follow that. It's extended 90%. And we look at that. And you can, the little note there on the bottom right, you can relax that 90% rule as you become really good at it. Point being, and you've probably thought of this already, is that if you let that C wave extend 90% of that move from A to B, you're like, wow, I've left a lot of money on the table there. I could have gotten in earlier. And you will get to the point where you feel more confident when we bounce off of fib level on that B wave, especially. So those three all work 38.2, 50, or 61.8. You see the B wave come down to one of those levels and bounce, then you have a opportunity to uh, get in a little bit earlier on the movement from B to C. So then the projected target levels above and beyond that. So the 90% move of the C wave, so 90% of that B wave movement in the C wave, you should say, then gives you these targets based on those Fibonacci levels and then the guidelines that I just gave you. So we're talking about the signal day. Well, we look for what the signal day is. And the signal day is when you enter, when we have closed above where that level is at 90%. So that's the signal day. Again, we're staying with the general rules, even though that note there that you could get in a little bit earlier, but you'd still want to follow the same confirmation when you see that. So when we go through, continuing with the rules, so we've had that entry threshold. We know that your risk would be back down to point B. If you saw a retracement back down to where the B is labeled, that would be your exit. Because if it gets all the way to B, then that takes away the impulsive move from the C wave is gone. So that would be your risk at this point in time. We can mitigate that even further. So there's the risk area, and then your potential reward, assuming that this is a 100% expectation, would be from that level up to the 100% C wave extension. So you would want to identify what's your risk, what's your reward. Make sure the reward's greater than the risk, obviously. Very basic money management there. I'm not telling you anything that you don't know in that point. And then this is what I was going to mention. Oftentimes, when we find one of these zigzags within a wave three, it does happen in wave five as well, but more often in wave three, and quite often, honestly, in wave threes, because the wave three is so strong. We've seen a lot of it recently with the move that the market's had. You will move past the expected target, which is the 100% fib level, and move on to the 161.8%. So you get a further extension of the C wave. So again, the target is 100% extension, but oftentimes it'll move to that next fib level, which gives you an even greater gain setup when that occurs. So it's fun when you see those, and I often use the DMI as help there to see what's the likelihood. How strong is it once we get to that 100% extension? What's the likelihood that we're going to continue up and move to that 161.8% level? The real consideration in estimating potential reward is how large is your zigzag and how far can it run before it runs into resistance at one of those Fibonacci levels. It's more obvious because you can work with a previous pivot point or swing point low. That's the general thought. But trading options rather than stock can also assist. We're not going to get too deep into the world of options here. We're here to talk about the strategy, but I like to use when I learn about the Greeks within options, learn about delta gamma acceleration. So when I'm selecting options, I utilize those that provide the best delta and gamma acceleration for being right on a directional move. And it also employs a level of risk because if you've ever seen the delta curve, it's a lazy S, and at the money options are right smack in the middle of it. But if you go out of the money and you go around a particular delta, you get greater acceleration up the curve when you're right. If you're wrong, you get slower movement against you because the curve has flattened out a little bit and the delta doesn't move down as fast. Delta, if you're not familiar, is how much an option will make or lose on the very next dollar the stock moves. So we take advantage of the math involved in how the Greeks are set up in the world of options. All right, trade confirmation, when to place your entry. So you've got the zigzag set up, and you look for the confirmation day. That's when you have a close above that entry day. So we're going to show you that here in an example over on your right-hand side of the screen. Now, that was an actual trade that was sent out. So we know the signal day has been qualified. We're right there. We're at that 90% of the B wave. You can see it labeled right there. So now we know that we have that qualified pattern. When do we get in? Confirmation day, and this is really big. I talk about this all the time when I'm doing webinars, how important it is to have a follow through or confirmation day. The market loves to give head fakes. It loves to draw in the retail public and then reverse and go the other way. So having a confirmation day or follow through day is extremely important, and it's in the rules of Elliott Wave and these zigzags. There can be one or more days between it. I like it when it's the very next day. But just going back there for a moment, that's when you get in. So at that point, you get in, and then you look for, do we go to the 100% extension or do we go to 161.8? And you can see I drew the 161.8 based on the signal that the DMI was giving me at the time that was very strong and strength was growing. That was one of those likelihoods that we're going to continue up to the next level within the wave three. Getting out. That's what people talk about a lot. When we hit the fib extension, it's done what it's supposed to do. Don't get greedy. Greed kills, as you've often heard. So if you hit your target, exit. It did what it was supposed to do. If you stay longer, then hey, where is the prudency in that? The setup did what it's supposed to do. Be happy, take it and go. There's also the potential for loss. Obviously, we're going to be wrong. Not everyone works. Some do fail. And that's where the AI comes in and helps set up where that fail zone is. In other words, even the AI says that of all the data points we've analyzed, if it hits this, the pattern's likely wrong. It's likely not going to hit its target. So, and I'm going to show you again some real life examples and then give you one to look at to follow along on your own. All right, so how can you take advantage of this before we go to the trade that I want to give you to follow, as well as go through some trade examples? We have something called Top Shot. We have 3 different portfolios at Elliott Wave Options. We actually have a 4th one, which is a speculative portfolio where I go through and if it doesn't follow within all the AI rules, but I've been around a long time, have a lot of experience, if nothing else. And if I see something that looks good but doesn't follow within those specific rules, it goes into what we call the speculative portfolio. Well, each and every week, I cherry pick from one of those portfolios. We have one that goes sideways. We have one that looks for breakouts of triangles. So it's a triangle. You're buying a call and buying a put, again, using the delta acceleration rules, delta gamma acceleration rules there. Stock breaks out, then we're mathematically going to make as much on the breakout. It still has to break out, but we know that we're in the right place math-wise. And then the AI Impulse portfolio, which is primarily focused on what I've been showing you today. That is the zigzags within a wave 3. So I cherry pick from those portfolios, one alert each week that goes out to you. You can see it's only $99 a year. That's something that you would want to really take advantage of. I'll show you the web page in just a moment. But for now, go to that link. It's ewotrader.com/top shot. It's top-shot-ST63. As you can see, it's only $99 a year. What a great way to kick the tires and get used to the way we analyze alerts utilizing this system specifically. So, and leave that. I'm going to take you to the web page and show that to you. And then I'm going to show you some actual alerts because I have some information that I want to share with you there that I think is really, really important for you to see as well. So you're going to see real examples showing you data that's or things that I look at, in my opinion, that I think are extremely important for everyone to be aware of. So, whoops, uh, bringing up the web page for you here, and just scroll down so you can see the data. Hopefully, everybody can still see my screen. Do I need to reshare it, or does everybody see that okay? Hopefully, everybody is.
I see the browser Top Shot Weekly
Yep,
in the
thank
video.
you. Yep. Thanks. And so there's the web page that'll take you to from the link. There's shots of my golf swing from Golf Pro Days, but just go to the website and it'll give you all the information in detail that we've talked about for the offer, as well as performance data that goes along through there as well. So, a great place to find out more information. There's those three strategies that I was mentioning: the time strategy, the volatility, which is triangles, and then that impulse strategy focused on those zigzags within wave three. We can find a zigzag in a wave five. We'll do that as well. And then what's most important, and we're really proud of these, are our testimonials. You've probably all heard the psychological analysis that people are 7 times more likely to post a comment when they're upset than when they're happy. And so you look at this and you can see some happy customers there. So cherry picked a trade of the week. All you have to do is enter your information, your phone number there. That is not to call you. Just want to be clear on that. That is so that we can text you because we send out the alerts via email and SMS. So put your name, email, phone number, all your details in there, and then sign up and take advantage of all of this that's included, which is the weekly trade, the daily updates on markets, the foolproof options book. So we're sending you a book. I actually wrote that book, and options education classes. We really pride ourselves on the education that we have on our website, especially if you're not familiar with Elliott Wave and you're like, okay, maybe I want to take another look at it. In my opinion, it's just my opinion. When people say that they haven't had success with Elliott Wave, they haven't gone deep enough into it. It's not easy. It's not a simple thing. I've given you a simple system today, but it's not a simple overall system. And people just look at the internet and see 1, 2, 3, 4, 5, ABC and think, oh, that's all we need. No, it's way more involved than that. And we have our education set up just as if you were taking a college course to go through and learn it. So all that's included for that $99. So, I mean, it's an absolute no-brainer. Hopefully you're filling out that form right now. Now, what I wanted to show you is I wanted to take you through the web page. Now, when we send out an alert at Evo Trader, every one of them goes on to the trade alert page that looks like this. You can see I have highlighted the impulse strategy, which is based on AI. So this is the current, the very top. These aren't moved around. These are live. I don't have access to move them around. It's all done automatically. When I send out an alert, it's pasted at the top of this page. So you can see that these are the most recent 6 alerts that are set up on the page here. ADI is actually having a good day today, so it's going to be a little better. And then we have mark-to-market graphs over here that tell you where a position stands each and every day. And then XLRE, that's green today as well. We'll see where things close. It could change between now and the close, but the most recent 3 close trades were on Shake Shack, GLNG, Tallow, and I wanted to highlight each one of these because there's some information in there that I think is important. So on this, we send out the entry alert, so you get all that information that comes out along with the chart of what we were looking at. That's included in there on why. There's that AI score. We like anything at 75 or above. I've even moved it down to I like 70 or above, so you can see how much we're putting the percentages in our favor already. And then on the exits, and that's where I wanted to focus. So on the exit, you can see this was a 3-day trade. I've got a general guideline rule myself. If I can generate 30% profit within 3 days or less, I automatically take it. It doesn't matter where the chart is, doesn't matter where or how close, or if we haven't hit the target yet. That's a rule that I follow. And so that's why this one was exited. You can see that we didn't hit the target yet. So there was when the AI signal came out. We moved higher. We got the 30% in 3 days. So it was an exit. And you can say, yeah, you should have hung around and gotten to that target price, or why didn't you? Well, maybe one of these other examples might give you a little bit better idea of why we didn't do that. And let's take a look at GLNG. I think this one has some really good information. I'm getting kind of into nitty-gritty here on trading systems and plans. So here was the setup. The alert was sent out on March 25th. For this trade setup. Again, the chart included in there, which I think is important. And then the exit. So I wanted to show you this exit. This one was a 1-day trade. See, 31.8% in 1 day. They don't all do that. I just want to be clear on that. But what the AI does is a great job of identifying when you're in a momentum run. And that's kind of what plays into some of the signals. Oftentimes it runs straight up. Other times it corrects for a little bit before it moves up to its target. And you can see an example here of that. So look what happened here. So this on GLNG, there was the entry signal and then exited. It looks like 2 days, but that's because it was less than 48 hours. So it registered as 1 day. But what I want to highlight here is down at the bottom. This software from Hub has all these indicators. You get the LA Wave for free. Again, hub.com. You look at the IV spike. That's something they include. You can see where the implied volatility is in options. When I see an implied volatility spike, to me, that's free money. It's when they juice the premiums is what they call it. So they add that in. And I'm going to take that. So you would look at it and say, well, you're nowhere near your target yet. Why wouldn't you go ahead and take it or go ahead and wait? Well, I'm going to give you the exact reasons why. So when you spike up like that, and you can see clearly on this chart here, the green line, the IV chart at the bottom, the bottom I'm looking at now, the green line is the front month options. The red line is 2 months out, and the black line is 90 days or greater. So when you see that spike, that's in the shorter term options, then you're looking for taking advantage of that, basically, to me, free money. So 30%, less than 48 hours, I'm going to take it. And this is one of those that when the signal came out, it pulled back. You can see it pulled back, and then it continued back to the upside. Now look, you can see, well, yeah, but a couple days after you got out, it was higher. But look what happened before. See, it came down after where the red arrow is on our exit date. It came down and then it went up. And even though it made a new high on that day, which was April 7th, the options that we closed out at 290 per contract were at 265. So you can see that just that little pullback pulled that volatility spike back down. And then it turned and went back up. So even though the price was higher, because it had pulled down and a few more days of time decay had gone by, you would have closed that out, even though the price was higher, at less profit than we had when we exited. And now look at it where it is. That's current as of yesterday. So it's still on its way to its target. You know, we closed it out a month ago, 3 weeks ago. It's on its way to its target. But you know where that option is right now, or at least at the close yesterday? $1.85. So again, the price is higher, but theta decay, all those Greeks matter in the world of options. So based on those 3 potential exits, where the arrow is, where we actually got out, and the volatility spike, that shows you that free money premium that they give you when they spike the volatility like that. And then you avoid even a day of time decay. So the next 2 peaks there, even though they were higher in price, the option was worth less. And I think that is extremely important for people to realize in the world of trading options. And we'll go through and teach and educate you on that along the lines. So this one was on tallow, one day, 22%. And you might think, well, I thought your rule was 3 days or less at 30%. But let me show you what happened here on why we exited on this. We were already starting to get vertical. There's an example of the DMI below it, by the way. And I don't like when things go vertical. So obviously I'm not so comfortable with where the S&P is today with that big gap and run up. Feels a little bit like blow off top, we'll see, at least temporarily, not long term. But there was a setup on the entry. And then on the exit date, we had a gap up and run, and there was one of those IV spikes. And even though it didn't quite hit that 30% rule, I like to take that free money. That's just one of the things. They're going to spike the volatility like that. Remember, you bought it when the volatility was lower. You're selling it when the volatility is higher. That's just extra premium that's been juiced into the option premium that you can take advantage of. And if you wait, which this one actually came down and hit the fail zone, so our exit looks even better there, although it has turned and moved back to the upside. But you can imagine, I didn't look up what that option's worth at this point in time. These were on July options, I believe, June or July. But with that, the option is probably a fraction of what we got. So just a little tidbit there that I thought I could add in and show you on something that you might want to take a look at for if you're an options trader, if you're trading options. If you're not trading options, this probably wasn't very interesting to you. But if you are an options trader, hopefully that was quite interesting to you. So once again, that's just the impulse page. Remember, in Top Shot, you're getting a cherry pick trade from one of 4 different portfolios. So this is what you'd be looking at on the most recent alerts. And this is live, right? Current refresh the page right now for where the trade registry is. So once again, fill out your details at the bottom of that link for Top Shot. And then I did want to go through and give you an actual potential chart to look at and that you can follow along with where we are right now. And so here's what the software looks like. There's that gap up on the S&P today that I was talking about, which I think is getting a little long in the teeth, a little vertical. I wish we would have tested that wave 3 high back in this area, but we had a sideways consolidation instead, which is a pretty powerful consolidation phase. I just feel more comfortable when what was resistance for so long gets tested as a potential support level, and then you get the move back to the upside. So we're getting a little separated from the 10-day moving average. I have another rule: no security any time frame gets too far from the 10-day moving average for long. And so when you see that, we normally come back down. You can see how all through here we were just pegged to the 10-day moving average. Then we got a little bit vertical through here, and we went sideways and allowed the 10-day moving average to catch up. So one of those two things usually happens: either go sideways, let the 10-day moving average catch up, or you might get a retracement back down, which is what I was looking for. We didn't really get it. And so we got back to where we were in concert with the 10-day, and now we're getting a little bit away from it. Again, part of the reason I think that we're a tiny bit overbought right now, at least on a short-term basis. So just to give you an idea of how these AI signals work, they come out, we click on the AI button, and the wave 3 bullish search, that's the one that we look at for these zigzags within a wave 3. So that's the primary search for within the Top Shot. And then within the AI Impulse portfolio that I just showed you. So I'm going to go back to yesterday, and you can take a look at the 1Q, ONEQ, and look where you'd be if you had followed that one yesterday. So you can see that move to the upside today. Again, I would be inclined to look to take gains, but since it's an ETF, you don't get quite the same volatility spike It does go up, but it doesn't work the same way in the options as it does, or it doesn't work as well, I should say, in the ETFs as it does in individual stocks. But still, a little bit vertical, a gap up. I might be looking to take one of those 1 day gains on there. So I'm showing you the list that showed up yesterday. And so here's another one on FTNT. And you can see that we're consolidating here right above the A wave high. I think that's pretty interesting. And there's an opportunity perhaps there for that one to move up. And you can see the score there's 80% on a potential move up to that C wave extension. So that's one I think you can keep an eye on. The 1Q1 is too late. We can take a quick look and see what's on today's search. If there's anything you want to look at, the 88 score is pretty high. I'm going to be looking at where the options are. So this is Asia ex Japan for this ETF. Again, I don't know how optionable it is. We do have options data on the platform as well, and very little open interest. So I already would not be so interested in trading options on this one. So again, you're getting a real quick crash course on what I do every day, what I look at as we go through to find these. Too overbought for me anyway. I'm not going to chase that vertical move. I can tell you that. It's just not in my DNA to chase after vertical moves like that. I will say, in fairness, that the way the AI works, it catches momentum runs, and oftentimes they will run straight to that target. But the ones that I were showing you that were 3 days or less on the gains weren't this overbought on the entry. If it's already this overbought, I'm going to stay away from it. I'm going to look for a little bit of a pullback and see if we can get that little bit of a pullback first. It worked out really well with that Shake Shack trade. That one was one where I waited a day because when the signal came out, it was overbought. The next day it pulled back. That was a good day to get in, and it worked out great. Another one of those short-term alerts. And then you can see here VTWO. That's getting a little vertical there as well. You can imagine with the way the market opened today that we were going to have a lot of these gap up moves. So just wanted to take a few minutes to run through that. I also want to leave a few minutes for any questions that may exist in the Q&A part, chat. And let me see if there's a few that I can answer for you here in the time we have left. Quantum Boris, yes, it does work on that time frame. We are getting that now on the 15-minute data feed. As of right now, today, if you went, no, they changed the rules on live data significantly. And so we went back to 4 updates throughout the day on the software program. But now we're getting back to a live data feed, I think starting next week, or the hub organization is. What do my fib levels say about AMD right now? Well, let's take a look real quick, and we'll see. I talked about this yesterday to Trade Finder, which is a show I do each and every week, based from our YouTube subscribers. And goodness, when you see that kind of a move, we'll take this off and rescale it. Now, the issue here is that's not going to be a zigzag. So that's the problem. So we have this cool zigzag tool. This was clearly the start of the impulsive move. I don't think it is. Well, it did make it right to about 30%. And so 61.8 would have been the target. We blew through that today. Way overbought based on the news. They pulled an Intel. Chart looks exactly like Intel's did. Already had a vertical move and then gapped up again. And then Intel got the news that Apple was looking for new chips, and that went even higher. Can AMD do that? I would suspect that we're going to get some backing and filling through here, but it does look like there's that C wave extension. Now, remember, that's the extended C wave, so that's not the target. It's already hit the target on the zigzag, which was 61.8. but it is in a wave three, and oftentimes we will get that extended level, which means you could see AMD up around 450. I wouldn't look for that in the next few days, though. I think some backing and filling here, consolidate this big gap move up would be warranted, and then we'll see what happens from there. So that looks like all the questions, and I think we're about out of time, David. So hopefully oh no, there's a few more. Nope, same ones. With that, David, I appreciate the opportunity to speak. I hope I showed some people something that they hadn't seen before, because to me, I always sign off my events that time's the most valuable asset any of us have. And anytime somebody devotes some of their time to what I have to say, I hope they find it an informative use of their time. So with that, I'll turn it back to you.
All right, thanks, Rob. Yeah, very interesting software and method you have there. So everyone be sure to click on that link and check out Top Shot options. And all right. Thanks, Rob.
All right. Thanks, David. Appreciate it.
All
Take
right.
care, everybody.
All right. Thanks, Rob. All right, so Rob was our second presenter today on day 2 of this 3-day Active Traders Playbook event. And Price Headley is up next, and then there will be another 6 live presentations after Price. So we have a full day of education still to go here. So, all right, Price, are
Hey,
you there?
David. Yeah, doing great. How are you doing?
I'm good. We're having a good day here. So,
It sure looks
uh,
like it. That's great. Let me see if I can share my screen here. Let's see, share. Screen 2. I've got a multi-monitor setup here, so let's make sure. Let me zoom it out as well and see if that's coming in full screen mode for you.
yes, looks good.
Fantastic.
Okay. Um,
Ready when you are.
Great. I'm just double checking everything. Okay, I'm going to start my recording again, and then you can start your presentation. So I am recording again now.
Well, thank you, David. Good afternoon, everybody. Price Headley here. Thrilled to be with you as part of this super event full of all kinds of traders and lots of different ways you can trade the markets, right? So the bottom line is that you just have to find kind of what fits your own comfort level. What I'm going to share with you today is something that's fit for kind of quicker strike opportunities, looking for in and out from one afternoon to the next right before expirations, but only looking for quick 50% gains on our favorite Nifty 50 stocks. So we call it Nifty 50 options with this both 50 stocks and 50% targets using kind of price action patterns I'll walk you through, as well as the directional movement lines, DMI indicator lines. So let's get right into it. And as we do, let me just remind you that the information provided in today's presentation is based on our proprietary research. It's intended for illustrative purposes only, should not be considered specific advisory recommendations here. As you know, stock and options trading have large potential rewards. Let's face it, they've also got large potential risk. We'll talk about how we manage both sides of the trade here today. Remember, the past performance of any trading system or method is not necessarily indicative of its future results. Future results will vary. What you don't want to vary is your consistency in following any system that you're going to implement. So be consistent. I always tell new traders coming in or new to a system traders to say trade small at first, get comfortable with both how wins work, how stop outs work, and how you can stick with it over time. As you then get comfortable, you can then scale up. Okay. Don't ever go too hot and heavy on any one trades. Here, terms of use on our bigtrends.com homepage. If you don't know me, I've been trading options for now 37 years and counting, per that kind of approach of not getting all in on any one idea, right? There's been a lot of rocket scientists, brilliant Wall Street hedge fund types that have blown up in the face of getting too heavy when they were too convinced of what they thought they saw and then missed something, right? So we don't want to be like that. I launched bigtrends.com back in November '99, now on our 27th year, serving our Big Trends community. It's all about systems. Blessed to be inductors in the Traders Hall of Fame, sponsored by Traders Library back in 2007. Joined a lot of my trading heroes. And so hopefully you can learn from something that's worked for me as well and start to put it into work in your own trading here. as we walk you through this Nifty 50 option strategy. So we're targeting a 50% gain on options purchases. Really the simplest of keep it simple, KISS principle stuff here, just buying an option and then popping it out the next trading day. So we're going to get into these trades and be out of them by the very next trading afternoon. So we won't hold it longer than 24 hours. We'll show you a bunch of success stories when it works. Also, what do you do when it's not working? We'll show you both sides there, and then more about how you can start taking advantage of this as early as tomorrow afternoon. So you know that one of the greatest crazes, and even Warren Buffett was talking about zero DTE options the other day during the Berkshire Hathaway meeting, is the zero DTE, 0 days to expiration options craze, right? That's the options that trade in their final day of their life. Now, we're not going to do that. We're going to trade them the day before, but then hop out on that last day of the expiration. So what happens is we get a lot more leverage as we trade them closer to the expiration. But you still got to keep a tight leash on whether they're working, whether they're not. Don't hang around to the bitter end. Okay. So we're going to walk you through how we do this and how we get in the day before the options expire to get that leverage, but then hop out well before the options would close on their last day of their life. So we put a focus on both quality and quantity with this system. So like I said, the quantity wise, we're looking at not just one or two ideas. We're looking at 50 key stocks that make up our Nifty 50 stock focus list. We get into these trades every Thursday at 3:30 p.m. Eastern. Why then? Well, because by then we know what our daily pattern looks like on that daily candle. And we know that also if we get in the last half hour of the trading day, we're not likely to get a target or a stop in those final 30 minutes so that we'll get out at earliest the next trading morning. So you never have a day trade with this approach. Now, how many new trades could we have? Up to 4 new trades on any given Thursday afternoon. Usually I tell my subscribers expect maybe a couple of new trade opportunities, but we could get up to 4 on any given week, any given Thursday out the next trading day, right? So you're not going to hold these very long. We always get out Fridays by 1:30 p.m. Eastern. We haven't gotten our stop or target by 1:30. Okay, so that means you still have 2.5 hours to go before these options would stop trading. So you know that you're not going to hold them to the bitter end no matter what. Okay, so we're going to be out well in advance. And we always give you real-time email alerts as well as you can get text alerts when to get in, when to get out of every trade. We never leave subscribers hanging. We guide you through on winners and losers from the beginning to the end of every trade. Okay, this is part of the real world trading game that we want to walk you through here. So like I said, less than 24 hours held here, simple options buying, using options that are a day from their expiration and then hopping out on the expiration day. Every single Friday, right, there's weekly options on all these Nifty 50 names, right? So they have every single Friday expirations out, usually at least the next 4 weeks, sometimes 6 weeks worth of weekly expirations to come, but we're just focusing on the very shortest term ones. Like I said, if we're doing up to 4 new trades a month, we've seen as many as 14 new trades in a month. I would expect more like averaging more like 10 new trades a month, but up to 14, we say. So you know about how much to expect, but knowing you'll never have more than 4 trades open at once in your Nifty 50 options portfolio. Let's look at a winning recent trade example. Here's one that we had on Airbnb. Okay, so A, B, and B is a symbol. As you know, Airbnb, that's become a hot trend instead of getting a hotel, basically renting out a house or whatnot. And so you can see, what are we looking at on this pattern? This is a pattern coming into the end of the day on a Thursday. And here you can see we're actually looking at an hourly candle here, right? So we're looking at what happens as we head into that 3:30 bars close. Because remember, in the hourly candles, you go 9:30 to 10:30, 10:30 to 11:30, etc. To 3:30, the last half hour kind of sits as its own candle, even though it's only 30 minutes on that last half hour. We're looking at the 2:30 to 3:30 candle right here. We want to see that on a bullish setup here, we're making a higher low than we were the prior hour, but we're also still making a lower high. So this would be a classic kind of a consolidation candle, right? We're sort of catching our breath after that recent pullback, but we want to see that it's coming back up and closing up. So that's what that white open body means, is that we closed up where we opened that candle. So at 3:30 there, We're trading about 137.5. So what do we recommend to our Nifty 50 option subscribers? We send out a real-time email and say, we want to buy the Airbnb 135 straight calls on that Thursday afternoon at 3:30. They're about 2.5 points in the money, right? At 137.5, you buy a right to own the stock at 135. It's already worth $2.50. That's called the intrinsic value of 2.5 points, $250 a contract. We're paying $310 a contract, right? You've got to pay a little bit of time premium still as you look at kind of where things are heading into the next trading day. You say, well, gee, paying $60 a time out of the $310 total premium, that's about 20% of the total premium is time. You say, gee, with only a day to go, that seems like a lot. But you can see it actually wasn't, because, look at what the stock did the next trading morning, right? The next trading morning, it gaps up, it trades all the way to 143 and change, right? So that's where the leverage really kicks in to say the $60 a time you paid, you ended up getting a total of about, you can see here, some nearly 6 points of movement that next trading hour and a half there, that next morning, right? So the idea here is that we're not in for that whole move, right? We're just taking the quick 50% hit soon off of the open, right? Open just over 140. We got out at 465. So just take the 50% gain and run. If it goes higher, great for whoever else has it, but we're not greedy. We like to take the bird in the hand of a 50% gain. In this case, we're saying, okay, look, if you traded up to $2,000 into each trade, that would get you how many contracts? It gets you 6 contracts at $310 a piece, $1,860 invested. You make 930 on that 1860. There's your 50% gain. $930 in one afternoon, out the next first hour of the trading day, right? So then you're out on that Friday morning and leaving the rest of the day to somebody else and say, thanks very much. In on April 16th, out April 17th, $930 in your pocket, minus your commissions, which of course would be, no more than $1 per side. So if you do a 6 lot in, 6 lot out, $12 maximum commission. No minimum ticket charges anymore on options either. So it's a great time to be an options trader. Keep the vast majority of what you earn. When you look at our sample of some of our focus list names, yes, you've got some Dow stocks in there, JP Morgan, Microsoft, McDonald's. You see some other names like, AMD, of course, that the huge earnings move today. We're not going to trade right in front of earnings. That's not our game here. But we're going to look to see how it sets up as we head into tomorrow afternoon. And we'll look for new opportunities come tomorrow afternoon on any and all of these names. Lowe's, of course, in home improvement, Shopify and internet retail, online retail, and then Philip Morris PM, Caterpillar, and Disney. Disney also having its earnings positive reaction today. But, so we've got some Dow stocks in there, but we got some other non-Dow stocks, and including Dow Chemical, which is not a Dow industrial name, but DOW is an industrial name of chemicals. We mentioned Airbnb, analog devices, and chips. NVIDIA, so now you've got the biggest stock of them all, back at a $5 trillion valuation or so today. 3M, DocuSign, American Express. So you see some real blue chip Dow names, and then other names, Qualcomm, and many more, Intuit, parent company QuickBooks. So you can see a whole lot of sectors in there as well, right? We're not just trading technology. So we try to get a diversified group, but the key is that they've worked well in this system, looking back over many years, right? We're not just trying to pick and choose, a situation here where, we're going to get, just tech. Okay. So new trades here can trigger on 3:30 p.m. on any given Thursday. And we're going to focus on just once a week scanning. So what that means is that not only are we kind of waiting for the sort of ideal leverage point, we're also minimizing the amount of time you have to follow this, right? You don't worry about it on a Monday, Tuesday, Wednesday until Thursday, late afternoon, right? So almost 4 of the 5 trading days, you said, I'm not worried about it with this system. I'm just focused on Thursday afternoon, hopefully just into Friday morning, right? So not even a full trading day of work here, but rather just looking at it in that last half hour of Thursday, seeing what we need to do by at no later than 1:30 p.m. on Fridays. So we've found it's a really big time saver that way. It's a quick swing trade, right? But not a day trade. And looking at it as low time commitment, but still high bang for your buck relative to the small amount of time you put into it. So the setups here I mentioned on the bull trades are price action contraction. For bear trades, we haven't looked at them yet. We look at the opposite. We're looking for reversal patterns. So we've seen a potential breakout turn into a fake out, flipping the other direction. We're looking at a positive historical profit factor. We're looking out over oftentimes as much as 10 years of past data. Okay, so we're not going to try to be just looking at what's happened just recently, but rather looking at essentially as much history as we can. So we're getting a really good read on exactly where we think things should be headed. Okay. And again, even when you have an edge over a system that says you've got a long history of success, you're still playing a probability game. So that means there's still going to be winners, there's still going to be losers. You're not going to ever have anything that gives you 100% win rate. It's just not part of trading, and it's not part of life, right? So the idea here is that you just say, okay, look, if it doesn't work, we've got a plan to get rid of it as well. With the 50% target that we think we should get more often than not, we do use a 50% stop. So while we can't get into the exact settings, you learn that when you become a subscriber, but we do use that 50% target, 50% stop, and then the time stop at 130. So let's get into some more trade examples so you can see more setups of how this works. So here we have C Corp, SE is the symbol. Here we have one that you see it had popped down at the start of the day on Thursday. You see it popping back up. We've got that consolidation here. So you see this little wedge pattern developing, higher, low, lower, high. And even though that's a red candle, it's actually showing us that when we sent it out there, it was actually showing us that we indeed were still net positive from where we had been the prior bar's close. So we hop in there and we hopped into the 82 strike calls. Notice where the stock's trading. Again, about 84.5. We like to buy in the monies generally. We can't always do that, but we're going to try to do that more often than not. So an 82 call means you have a right to own the stock at 82. Stock's at 84.5. It's $2.50 intrinsic. Again, we're paying about $60 extra of time on the $310. So actually the same kind of ratios as we showed you on the prior trade example, just so you can kind of get some flavor on how that has worked. So when you look at that, you say, okay, so with this understood, we're saying, okay, what's the plan here? The plan is let's try to get and look for a gain of 50%. So obviously we're trying to get that same 465 that we just showed you on the prior example. Look, the next day on Friday, we already rally into the close actually, and then on Friday it gaps up and hits our target as the stock's up above 86.5, right? 86.5 would be worth 460, right? So you can see we're hitting our 465 right off of the open. And again, taking down on the $2,000 maximum investment, you get 6 contracts for $1,860. There's another $930 profit minus your round trip, no more than $12 of commission. Okay, another bullish setup on a different name. Now we've got DocuSign. Okay, so DocuSign showing just a slightly higher low here, but a lower high, but the positive close into that bar relative to the prior bar's close. Stock's trading just under 85, maybe 84.9. So again, we're about 2.4 points in the money, maybe about 70 cents a time, just over 20% time risk. And here's the key. Look what happens. The next morning, here's one where we didn't get the gap in our favor initially. It actually opens down here. It opens at about 83.8. And you say, well, why are we not getting stopped when it had closed the prior day about a point higher? Well, because you don't typically lose point for point in these situations, especially right off an open, because it's still going to hold a decent amount of time value, even in its last day of its options life, right? Because the market knows these things can reverse quickly. You see, by the way, our DMI lines are down here. The positive DMI has got to be above the negative DMI. Positive DMI means have we been in an overall pattern of more new highs than new lows, essentially. And even with that recent pullback, it's saying yes, in the bigger picture, it's still a pullback worth buying. Okay, so that's what the DMI lines do. They kind of screen out the really weak trends on the directional movement kind of confirmation tool there. So, with that understood, okay, we say, okay, we know that we want to, find that, and then we don't get shaken out. So then when it does rally back up, you can see it gets up here near 87.5. 87.5 is worth about $5 intrinsically. We're out just under 87.5 at 465. take the money and run. So we don't get shaken out. This is why you don't want to use too tight of a stop, because a 25% stop trader is going to get whipsawed out that next morning. We were probably down 25 or 30% there, but we didn't get to 50%. And so that's the key. Give it enough wiggle room to still say uncle, but at the same time, not get shaken out in between. So that one ended up working out nicely. Of course, we were out there about 12:30 with about an hour before a time stop. Again, another $930 profit. Now, here's one where we paid a little bit more. Here's Palo Alto Networks, the internet security name. And you can see in this case, you can see that we were actually betting on a reversal back up after kind of a consolidation phase. And you can see what happens is we hopped out the very next morning. So in on a Thursday afternoon at $7, and we need now 10.50. So again, this one's a higher dollar name, right? $151. We buy the 145 strike calls. They're about $6 in the money. We pay 7. So we're still looking at something that's got very limited time risk if it just ends up chopping around and going nowhere, right? We still have price risk if we're on the wrong side of the trend. We could still pop down from 7 to 3.5 if the thing starts tanking on Friday morning. But instead, after a brief slight lower open, it flips up. We go to 156. It's worth $11 and we're out at 10.50. Okay, so we take the money and run. Quick $700 profit on just a one lot. Obviously, if you're putting in $2,000 worth, you get 2 contracts and make $1,400. But you get the idea here. Another one where we catch a consolidation on Wells Fargo on a Thursday afternoon. We think that's a good setup to have it snap back, and you can see it does on Wells Fargo go from just under $2 to $3. There's your 50% gainer. The 90 strike calls. And the stock's about 92, maybe entered bar 91.8. So we weren't paying much time premium, right? It was like $1.80, $1.85 intrinsic. We only paid 197. That's the nice thing about trading non-techs, is you'll tend to pay a lot less time premium than you would on a technology name. That one ends up making it's just over 50%, just over $1,000 on what would have been about a 10 lot in and out on a $2,000 maximum commitment. $20 round trip commission, make over $1,000. The very next morning on the first hour, popped to almost 94. So those are call trades. Let's look at the put trades now. The put trades are a different kind of a setup here. And in this case, you see that here's a case with Roblox where we've actually been down too much, right? So that in this case, we're down this much, and now the trend is changing to negative on the DMI lines here above positive. And so it's saying that when you see that you're flipping up, a lot of people say, oh, isn't that a big reversal to the upside? But our view is that we think that it's a sign that it's a little too extended. And so here it is at that 330 point, just over 57.5. So it's worth probably 240 intrinsically on a 60 strike put. We're only paying 263. Roblox, as you know, is a name RBLX. It can move a lot. And so we think that 263 can turn into about 395 to $4, and then we get out at 405 when it snaps down there to 55, right? Actually got to almost $5 intrinsically, 485 at most intrinsically. We're okay with being out at 405. You see, it then does start to snap back. By the end of the day, it's back towards only about $3 intrinsic value, right? So taking the money and run, when we get the 50% gains, that one's a 54% gain, give or take $990 or so on a maximum $2,000 investment, right? So 2,000 invested, try to make 1,000 is a great basically couple hours overall in the market, right? In on that last half hour, out on that first hour of the new trading day, right? So that's here's another example of that where we're seeing, okay, SE Corp's been down, C Corp, and you can see here ticker SE that it makes this little higher high, lower low, negatives above positive, and that's to us a sign that we think it's going even lower when the stock's about $80. We're buying an 82 strike put, about $2 in the money, only paying $231. You see, you don't have to pay a lot of time premium the day before the expiration. And then it's just a function of, okay, what's going to happen next, and can we take advantage of basically follow through in either direction per our directional movement setups with these candle by candle setups. You see C Corp went from 80 down to just about 78, 78 and a quarter. Those options on a 2-point move went up about $1.20. So you're not going to get a point for a point move because you have to pay a little bit of time premium that's kind of getting evaporated as it goes more in the money on the last day of the option's life. That's okay. We're still getting a lot of bang for our buck. some 60% delta, if you will. In a 2-point move, we make $1.20. We got about 60% of the 2-point move, right? That's called a delta of 60%. So that's pretty healthy. And so again, $950 before commissions, which again would be on a maximum $2,000 investment, would get you in for about what, 8 contracts here, about $16 round trip commission at most. So some brokers aren't even charging closing commissions now. So not every trade, of course, is going to hit his 50% profit target. Here's what we do if we don't get the profit target or the stop loss. We just hop out at 1:30 Eastern. So if you're looking at C Corp here, you see C Corp, when we do like to trade a lot, obviously it's about 126.8 when we get our consolidation signal. It's been running up here, positive directional movement in greens above negative. So that means we've been making higher highs and higher lows. And you see then we get a little pause in that late day action here, that little consolidation, lower highs and higher lows to us says it's worth getting into a 124 strike call, about $2.40 in the money, and we pay $3.12. So it's about 72 cents a time. So maybe pushing towards 25% of time risk if it doesn't go anywhere come late Friday. But you can see after chopping a little bit sideways on the open on Friday morning, it snaps back up. Doesn't though get to our target. So we get to about 128. That's worth about $4 or so. 128.4, 440. It's not quite to our target, which is about 465 to 470. So here we are at 130. Okay, we don't hang around till 4 o'clock or 3:30 on the last day. We don't want you to miss out on getting out of this thing before the markets close at 4. So we send it out at 130. We're only making 20% of this trade, only $378 on that maximum of, in this case, about 6 contracts in and out. That's okay, because this is just a cleanup at that point, right? Sometimes you just got to do a cleanup operation and say, win, lose, or draw, clean it up, move it on. It wasn't doing what we wanted it to do. So let's look at a losing trade. Okay, so here's one that got down right around our 50% stop right as we hit into the 130 time frame exit. Right, Qualcomm had been down, but we thought it was looking good for a snapback here, kind of getting that consolidation, and then we bet that bought it for $795. So if you know $1,000, you're paying $795. On $2,000, you're getting in for like $1,590. Okay, so you see it starts off popping up by Friday morning. We're up a little bit off the open, but then it reverses, right? And you say, why don't you get out earlier? Well, we're trying to give it a chance, right? There's support that's been building here. You see even the support's getting violated. So we come into that 130 area here. And we're just saying, okay, 130 is hit. We're down 47%. Didn't get to 50%. You know, time is up. Okay. Win, lose, or draw. In this case, a loss. It's going to happen at a 50% loss or before that at 130, haven't gotten there, just get out at whatever 130's time stop says. Don't play the hope game of riding it all the way to the end of the expiration day. That's just cutting it too close. So now we look for, okay, you know, how are we going to manage a trade that's got past its target for a winner that was bigger than normal? Sometimes that's a benefit of buying options. You can get some outliers in your favor. So here's one that did that on McDonald's, Mickey D's. We liked that McDonald's was one that had been looking good and was getting that nice reversal pattern here, nice consolidation right before the close. And so here we are getting in about 314.5 on Mickey D's, right? This is the beauty of options, right? If you bought 100 shares of McDonald's, it would cost you over 31 grand. We're buying the 310 calls that are about $4.50 in the money and just paying $580 for that. Right, so you're controlling $31,000 worth of stock for just $580. You start doing the math on that, and you're like, that's less than 2% of the cost of the stock. So right away, you're set up for potentially up to a 50-to-1 leverage ratio against the stock. As you can see, it has a big, quick rocket up interbar there on Friday morning. It gets as high as about 321. So you do the math on that, 310 call, 321, it's worth $11. At 321.5, it got to. So we're about 11.5. We're ringing the register before that at 11. You see, glad we did get out there, because you see what happens after the big flip up, it flips back down and it's back close to where we got in, right? So this is why you've got your order working at a 50% profit target and saying, if it gets to 50%, book them, Dano, take the profit and run, right? We're not going to be greedy. We're not going to hold and hope. The objective here is to be smart about it, and go ahead and get rid of the trade if it's up 50% and you've got another winner that you've taken advantage of there. Okay. So that's the whole principle of this game, is that by taking winners, bird in the hand, you will improve your win rate versus just holding and hoping and then seeing it slip away like that too much of the time, right? So have those orders working. Okay. Now let's talk about another example here, or another principle here, which is that everybody loves the idea of 100% winners, right? You're saying, I don't want to shoot for 50% when I can shoot for 100. Well, what happens if you stack two 50% winners, especially when we're looking at anywhere from 2 to 4 trades on a week-to-week basis? That's as good as one or two trades that double, is if we had, 2 to 4 that could go at 50%, right? So the idea is that I think it's a lot easier to get the 50% winners. Also, it's more risk managed, right? Because if you're going to target doubles, we probably have to be buying a more aggressive option that would have more risk in that same type of move. So we tend to go for the more conservative in the money choice here, and therefore give you, I think, a better risk reward ratio on trades. Even though we're cutting it close to the expiration, I acknowledge that we're offsetting some of that shorter time runway with the fact that we're buying it in the money, so it doesn't move. If it just kind of chops around, we don't just watch an at or out of the money option get completely creamed. We're able to say, no, we're going to go ahead and take this 50% gain and book them. So what we've done here is we've actually set up for you to be able to get a super special trial offer here to take advantage of Nifty 50 options, get the benefits of what a longer term subscriber would get, but try it for just the next 3 months, the next 90 days. Okay. And I'm going to come back and answer some other questions and review a couple other examples here, because I've probably gone a little bit fast here. So if you've got questions too, pop them in there. I'll make sure that I answer them for you. So 3 months of our Nifty 50 options service, but it's not just that. You're going to get the same thing that a longer term subscriber gets, which is access to understanding the entire system via getting our settings and rule sheet. So you learn all the parameters, the setups, the unique patterns that we look at, what's our settings for the DMI lines, etc. And so you get an insider's look at exactly how we're finding these trades every single Thursday afternoon. I also do weekly video training for my paid subscribers, where I share with you kind of what I'm seeing in the markets, what I'm expecting next, how you can start to further benefit in your overall portfolio and keep learning while you're earning. You also get to access and contact me and my analyst team anytime you got a question from our research department. It's not just a customer service access you get a special dedicated email to reach me and my research team too. So if you're buying this on a month-to-month basis off my bigtrends.com website, you'd be paying $197 for every 30 days. So over 3 months worth of access for the next 90 days, you'd be spending $591. But we're going to slash it for you, because David and the team there at Timing Research have been very good to me. So part of the Synergy Trader special is that we're going to give you the 3 months, the 90 days of access with the bonus educational resources for just $177. That's marking it down by more than 2/3. I like that number too, because if you think about it, 90 days of access, less than $2 a day, less than what would be $180 total, $2 a day times 90, right? $177. One-time opportunity here when you go to bigtrends.com/50. Okay. It's our Nifty 50 service. And we're going to limit it to the first 50 traders that take advantage of this offer. Okay. So one of the great things about this is that, we walk you through every aspect of what you need to do to take advantage of it. Let me answer some of the common questions that we get about our Nifty 50 options plan and program. Is that what's our strategy again? We're not doing anything complicated. We're not doing spread trades or other combinations. We're not in the game of trying to make things difficult. We want to make things as simple as possible. As I think of as Einstein, it says, keep things as simple as possible, but no simpler, right? We want to do what we need to do to make it work. But we also, and again, we know that there's risk on every trade, right? We know that there will be losers. That's part of the game of trading, right? Anybody that doesn't realize that, it's just basically fooling themselves in a hope mode, right? We cannot have fall asleep to the opium that kind of blinds us from saying, well, eventually it'll come back. It's a good quality stock. Hey, even good quality stocks go through their down cycles too, right? So the idea is that there's a window, but it's a limited time window, right? From a Thursday afternoon entry to a Friday exit at 130, right? Look at our average entry price of our Nifty 50 options program over the last 12 months. So our average entry price was 288, $288 to control each 100 shares of stock on each options contract over the last year. So like if you're whatever you're allocating, whether if you just wanted to trade a contract at a time, that would tell you, hey, you might have to spend a few $100 on average to get into each new trade. Sometimes more, sometimes less. But you saw a lot of examples around $3. We had one that was like $7 or $700 for a contract, right? I don't necessarily care about paying a little bit more for an option contract if it's the right option to get into, right? If it's a higher dollar stock, we'll probably have to pay a little higher premium. If it's lower dollar, we'll probably be able to pay a little lower dollar. It's all relative to the stock price and the volatility that's priced into those options. But we like to use the in-the-money options wherever we can. So when are we going to get into these new Nifty 50 options trades? Every Thursday at 3:30 p.m. So I wanted to tell you about it today on a Wednesday because tomorrow afternoon is going to be our first action point. So I encourage you when you go to bigtrends.com/50 to lock in that start. Don't wait till tomorrow afternoon to get in and say, I'll just wait till the very cutting it close, because we want you getting set up, not just for the real-time emails, but also for you can get set up for real-time text alerts. So you know exactly when to get in, exactly when you need to get out of every single new trade. Okay. So no day trades. We're in on a Thursday afternoon late, out no earlier than the Friday morning exit. So real-time email, and then we use the WhatsApp technology for our text alert feature here as well. So what's our maximum number of trades we could hold open on a given trading week? No more than 4 trades open at once. Okay, so we really keep it simple, really dial you in and focus you on, okay, how are we going to manage each and every one of these trades, and knowing that whether it gets to the 50% profit target, the 50% stop, or the time stop at 1:30 p.m. on Friday afternoon, Eastern time, right? Eastern time means that's 2.5 hours before the market close at 4 Eastern Wall Street time, right? So we got plenty of time to get out. So you don't have to invest much time being in these trades. You know exactly where you're going to get your new entries at 3:30 every Thursday. If you haven't seen them after a few minutes after 3:30, you can give us a call at our 800 Big Trends number or email our customer service team. Well, client care at bigtrends.com. I'll show you those here in a minute when we look at the order page. But remember, you're also going to get a lot of bonus information. And one I didn't mention before that you're getting is an extra near hour of training with me that I recorded for my Nifty 50 options new subscribers. I call it a Nifty 50 strategy session. A $97 value, yours free to watch as many times as you want. Really soak in as I go through the rule sheet, as I go through even more examples, and you start saying, okay, well, gee, you're in for $177. You're getting all this basically kind of quick start coaching that's already built into the strategy session, the strategy and rule sheet, and the weekly video training. You're getting all this support. And of course, my fellow analysts and customer service folks are also standing by to answer any questions you've got about the program. And of course, that's why you also get a dedicated email to reach our research team as well. Like we said, one trade alone could have easily covered today's offer with a whole lot more to spare, right? For $177 to start, your ROI could be multiples of this off of just one trade. Here we were using the example of hopping in late on that Thursday. We got the consolidation pattern. Our DMI line still says it's still a trade worth doing, and we hopped in there right before the close on a Thursday, 3:30 p.m., right? This is why we do want to make sure you get in before 4 o'clock, right? So when we're hopping in between 3:30 and 4 o'clock, you've got about a half hour to act. That doesn't sound like a lot of time, but actually you can use any options trading platform you like to use. You get the real-time email. It's why I do recommend you also get set up for the text alert. We send you your instructions on how to set up text alerts once you get signed up. And bottom line is that, boom, it's a matter of just a few minutes from the time you get your new email and text alert to the time you log in, say, okay, I know if I'm going to place 6 contracts on a $2,000 maximum, if you're doing $1,000 worth, that gets you 3 contracts. If you're doing a one lot, that's $310 to start. However you're doing it to start off, I'm comfortable with you saying you've got to be comfortable, right? I would rather see you trade small across a series of initial trades and start to cut your teeth on that. I know how winners look. I know how losers look. I know how time stops work. So in this case, we paid $310 a contract. We sold them out the next morning at $465 a contract, right? About $155, $155 profit per contract. In this case, we got 6 contracts. That was a $930 profit on up to $2,000 invested. If you invested 1,000, that would be over a $450 profit on the 3 contracts, right? In either of those cases, you're easily paying for your 177 bucks in just one trade opportunity, right? We can't guarantee which trades are going to win, which trades are going to lose. So we really recommend you be consistent in your capital allocation on each new trade. So you just go to bigtrends.com/50. I'm going to show you that order page here in a moment. We've already taken the discount on that page, by the way. So you don't have to put in any promo codes. No other discount codes apply here today because we're slashing that $591 usual 197 bucks a month times 3 months. We're slashing that down for you to just 177. So it's all yours today if you're one of the first 50 traders to lock it in at bigtrends.com/50. So when you go to that page, let me show you what that looks like real quick. And I'll seek to answer some other questions that we might have had and go back and look at a couple examples since I've gone a little bit quick here. You see that we've already slashed it down. The 591 has been marked down to the 177. So there's no other promo code to apply. You get our Nifty 50 options program with all the educational bonuses for the next 90 days for just 177 bucks. And you say, okay, well, is this thing what's my price after 3 months? We give all of our existing paid subscribers our best pricing for renewal rates. This is not an auto renewal. It will not rebill, right? So the idea here is that that it's just going to allow you to follow along for the next 90 days, get comfortable, kind of get in that mode of saying your first goal should not be to say how much money are you going to make on your very first trade. I know that's the temptation. I would rather that your first goal be to say, okay, can I follow this system consistently over time? And does it fit my own comfort level in trading and your own comfort level in your trading of how much you're risking, how much you're making, and watching that rinse and repeat cycle of saying, is this feeling good over a reasonable sample of trades? I tend to say that, I'd like to see you have done at least 20 trades on a smaller capital allocation. So you proved yourself you can follow each trade in and out. We never leave you hanging. And from there, you're saying, okay, now how do you allow yourself to say, okay, we're just going to go ahead and say we've proven ourselves we can follow it. Now we can start allocating more of our true position size once we have that conviction that we can follow each signal from the beginning to the end, whether it's a winner, whether it's a loser, whether it's kind of a not big mover time stop at the Friday 1:30 exit. So that's all right there, all marked in here for just 177 for the next 90 days, less than $2 a day. Now here's where we have our 1-800-BIG-TRENDS number shown in the top right of the page, where you can see that basically that's where we have our customer service folks standing by. If you've got any questions as you're getting set up, just call 800-244-8736. If you forget the number later, just remember it's 1-800-BIG-TRENDS. Which is my website, bigtrends.com. 1-800-BIG-TRENDS gets you to my customer service team, or you can email clientcare@bigtrends.com. Now, how do you pay for this? Okay. If you want to save a lot of typing, at the very bottom right of the page, there's an orangish, yellowish orange PayPal button there, and that will save you a lot of typing. Whether you're going to type in your information on the secure page or whether you're going to click through to PayPal, what you have to do is hyperlink, review our terms and conditions, click on that link. It'll show you how we've been doing business now in our 27th year serving our Big Trends community. So you click on the terms and conditions, review that, and then sign off that you agree to our terms and conditions, show you how we operate, how we're going to take care of you over your next 90 days. And I believe a lot longer once you get your first 90 days under your belt. I think you're going to want to continue. We've had a lot of happy subscribers with Nifty 50 options because it just looks to rinse and repeat that quicker strike 50% gain rather than shooting for harder to attain a multi-100 percenters, which, we have other vehicles that can do that too, but this is looking for that higher win rate, looking for winning more than you're losing, looking for doing this regularly over time. Okay, now click to the PayPal once you've clicked on that, and you'll, a few clicks later, be able to have chosen your money source and locked in the next 90 days for 177 bucks with no future rebill, right? Try it for 90 days. If you don't like it, you don't have any other commitment after the 90 days is up. Okay, if you want to type in all your information with the major credit cards up here, we take all the major credit cards, you click it in the payment info boxes. When you're doing that, make sure not only you get your billing address for your credit card in there correct, but also that you get your email in correct on this email field. We're not asking you to fill out email twice. So double check your email and basically make sure you've got it. That's your first way you'll get your welcome information, your instructions on how to set up your text alerts and everything else along the way. So either way you go there, you lock in the value, $591 value yours today for under 200 bucks, just 177, more than 2/3 off, and you get a big savings there. Okay. So let me go back since I've got another 15 minutes or so. Go back first, and let me see if I've had any other questions before I go back and look at a couple other examples with a little bit more detail here. So in the chat box here, let's see what we got. Thanks, by the way, David, for posting those links on our bigtrends.com/50. If you have questions, pop them in there. In the meantime, I'm going to go back and look at just a few more setups here that we were talking about before. So bear with me as I back it up for a moment. So like Airbnb, right? Usually in uptrends, what you want to see is a stair step, right? You want to see that you get a bigger move up and then, maybe a partial retracement. I know prior trader was talking about Fibonacci retracements. Some people talk about, retracing half of a move. Fibonacci move might be like 61.8% of a move from a low to a high. How do you do that? We're saying, well, like here, look, the stock was about 134. Now look, it popped up just over 139. We'll just, for the sake of something simple, say 134 to 139. You can do the math, right? That's a 5-point move up on that first move up. Well, look, if you were targeting about how much of a retracement you'd get, well, a 50% retracement would be 2.5 points. I would put you back at 136.5. As you can see, this move was more like a retracement to 137. So you did retrace more like about maybe 40% of the move. And that's more in line with the Fibonacci retracement, 38.2% is a Fibonacci retracement number. But again, we're not sweating all those kind of did it precisely get there or not. What we're sweating, what we're looking for is in that retracement, have you seen stabilization? Have you seen footing being gained, right? You don't want to catch a falling knife, right? When you're looking to buy a dip, you're saying, okay, our objective is to say, okay, the dip has happened. Now is the stock making a higher low versus the prior bar, right? We would not want to see lower low after lower low if we're going to buy a call, right? We want to see a higher low, and then we want to make sure we're not too late because guess what? When you're buying an option that's only got about a day left before it expires the next Friday afternoon at 4 o'clock, we're buying it at 3:30 on a Thursday. We don't want to chase too far on a massive breakout up and then have to endure a retrenchment. When you're using the power of leverage, let's face it, leverage is a double-edged sword, right? Leverage can both benefit you and it can cut you, right? It can work for you and it can work against you. So what we're looking for is to say, okay, is this the right risk reward area to get a leverage position on? We think it is when we've had that consolidation bar after a retracement and say, okay, now we think it's a time to say we think it's ready for the next leg up. And so that's why we're hopping in there. You can see where do we hop in? Right there at 3:30. Okay, so put an arrow there. The stock's trading about 137.5. Let me actually clear my screen and say, okay, you see, there's our entry point at the close of that hourly candle at 3:30, right? We're not getting in earlier. We're waiting there to say, yes, we've had about 137.5. Like we said before, the aggressive buyer is going to say, let me buy the 137.5 calls. Let me buy 140 calls. In this case, maybe they get paid off better than we did. Okay, that can happen. But what you're seeking is to say, I'm not looking for the occasional even bigger score. I'm looking to put more winners on the table for my subscribers with a more consistent 50% winner on more often than in the money option. Okay. In the money options mean that in this case, we're buying a 135 call, meaning you've got a opportunity to buy the stock at 135. Now, guess what? We are not trying to acquire the stock here. That is not our goal. Our goal here is to say we are looking to take advantage of this to say, let's go ahead and flip these by the next trading, essentially first half of the day. The first half of a Friday would be at 12:45 Eastern. We're getting out at 1:30, just after that halfway point of the power lunch hour there, right? So bottom line is that we're looking at this and saying, okay, we want to be out by 1:30. Now, ideally, though, we'd like to be out right off of the open, right? So we showed you other examples where we hopped out right off an open. Obviously, where this thing opened, yeah, it's opening about 140 or so. And yes, we're out at 465, right? So we bought it for 310. We're out at 465. I would have guessed we were out even better than that, but it looks like we got filled at 465 right off the open. And bottom line is that we took the 50% gain. Yes, could we have made more? In this example, yes, we could have. That's okay. I'm not worried about that. Again, part of the secret of being in the game, as I have for 37 years and counting, is you got to know when to hold them and when to fold them, right? Kenny Rogers, the gambler song, right? Knowing when to go ahead and book it, take the money and run, and saying, we're happy with those, put yet another winner into your portfolio. That boosts your win percentage. It boosts your confidence in the system and what you're doing, keeps you coming back for more, right? And so that's really a big part of this whole process is it's about building your confidence. You can follow the system through both winners, through stop outs, and through the time stops, right? Through the whole, any and every scenario that can happen. So that's what we're really focused on here. And so that's why we've set up such a great special just to get you started. We think by getting you started, we're going to get you hooked after 90 days of doing this with the for a song, just $177 that, hey, you could have made about fivefold of that investment on this $930 profit on just one trade, right? So that's a big part of it, right? And remember, as we go back and look, let me go back and look at a couple more since I've got a few more minutes. I'll go back and just remind you on a couple other ones here. Remember, we showed you, let's also remind you on the bearish ones too, because I think the bearish ones are kind of eye-opening as well as the bullish ones, right? So, when we were talking about, what can happen across the board here, that there's one with SE. We showed you several examples. C Corp is not a household name. So these are not going to always be the most popular optionable stocks. That's okay. If they've worked for us on both bullish and bearish opportunities in the past, more often than not, then we're going to have more confidence that we can keep coming back for more. So like you see in this case, yes, C Corp had been up, but you can see we're kind of on the verge of undercutting where it had opened that prior day, right? On Wednesday morning, it gapped open. You hear the old phrase that all gaps eventually get filled. Well, I wouldn't necessarily say they get filled in the same day. You see what's happening off the prior day's open here is it's about $80, and then that it went up to almost 83, and here it is rolling over, undercutting 80, and you see the prior day it closed at about 78 and three quarters. Well, we're kind of thinking that yes, it undercuts 80, making that sort of higher high, higher low. Remember, that's a range expansion pattern. It's been down. It had that consolidation bar. Is it finding support? No. By the end of the next hour, it's closed underneath that. Not by a lot, but it's saying, whatever bulls were hoping that it was getting ready to bounce might be ready to throw in the towel and say, yeah, maybe it's time to just sell this thing out. And so we're trying to benefit from the fact that guess what? Institutions are the ones who move markets. And the bottom line is that they're just like you and me as individuals. They want more of what's working and they're ready to pull the plug on things that are not working. And they're pretty quick to do so. But of course, they usually have more shares, more bigger positions where they can't do so all at once without risking splashing all the water out of the pool, right? They don't want to be the 800-pound gorilla that jumps into the baby pool and splashes all the water out, right? They want to tiptoe in and out, or relatively, not quite so dramatically. So the bottom line here is that that's what's happening. It's undercutting the support. We're buying the puts. Notice with the stock about 80, we're buying the 82 strike puts, right? So remember, with a put, you have a right to sell the stock at that strike price of 82. Already, if you sold it at 82, it's down at 80, you'd be pocketing $2 or $200 a contract. So that thing's worth a little bit more than that $200 a contract because whatever's over 200 is what's called the time portion. So about the $31 a contract extra is the time portion. Now, if you do $31 as a percentage of your $231 that you're investing in one option contract controlling 100 shares of stock on the downside, you see $31 out of 231, it's just over 10%, right? It's pushing into the neighborhood of about 14%, right? So that means that if C Corp went nowhere by our exit point at 130 the next trading day on Friday afternoon, sitting at 80, say it's got no time value left, it's still worth $2 at least, right? So you'd only be risking the time portion of 14% if you get no price action movement at all. Now, obviously, if you get movement against you, you've got price risk, you get movement for you. That's where we get paid, and that's where we catch that movement for us as it does fill that gap and back to the Tuesday afternoon low point there around 78 and a quarter. That's right where we get to. Guess what? 78 and a quarter is good for a 3.5 exit for us, and we're booking a 51.5% winner. Remember, if we were putting in this example, $2,000, if you're paying 231 a contract, that's getting you what? It's getting you about 8 contracts in here, and we're ringing the register for, as you can see here, $952 on those 800 contracts of profit, minus your $16 round trip commission at most, right? So that's really the whole objective of this portfolio. Rinse and repeat again and again, right? We have another example here. This is one that we had, another put example, actually, remember on Roblox. So you can see how Roblox had been positive on its DMI lines, and then it was flipping to negative, right? As it makes too many lower lows, looking backwards, right? It was kind of flatlining here, right? It wasn't really clear where it was going, but it was coming out of a prior bullish phase. But here it goes. Now it's starting to undercut hour after hour, new low after new low, lower high after lower high. And then it gets this one range expansion candle here. You say, isn't that a reversal to the upside? And we're saying the DMI lines say, no, the bears are still holding the ball over the bulls, right? What the DMI lines are showing us essentially is like, who's got the ball? Who's on offense, who's on defense. Right now the bears have the ball. They're pressing the bulls. The bulls are on their heels. Even with that one bar bounce, that 1 hour bounce, we're saying, yeah, that it's saying that the odds still favor a down move. So we're saying that first bounce is likely a fake out. And so we're buying the puts. In this case, the Roblox 60 strike puts when the stock here is trading about 57.5, maybe 57.6. Right. So we said about 57.6. If you're buying a put option that gives you a right to sell Roblox at this strike price of 60, that means at 57.6 is worth about $2.40, $240 a contract. We're paying $263 a contract. So we're paying $23 a time, give or take. So we're paying about just a hair under 10% of time. And that's on a name like Roblox, right? So to me, that really got my attention to say, yeah, not only has Roblox worked for us more than not in the past, when we look back since it IPO'd, actually was just less than 10 years ago. But the idea is that, hey, it's got enough data to say the odds are in our favor, and we're paying very little time premium. So when it rips to the downside in the very first hour on that Friday morning, it opened lower, but it just kept going, right? About $56 is where intrinsically we're worth about $4 on the option. We're out at 405. So we don't have to trade it all the way to the absolute low. We don't have to be perfect here. But we do say you want to book them into that $56 level, right? That $56 level is about here. Put a little V on that, 56 zone, and say, yeah, we're getting out about here. And before the first hour close, and we're glad we did, right? Because then it pops on back towards 57. Now it's worth about $3 intrinsically up here near 57 as we head into the expiration later that day. So the point of all this is that, yeah, you take the money and run whenever you get the chance. 53.99% gained, $994 profit on $2,000 invested in this example. It would have been, again, what, about 7 contracts. So in this case, you're saying, okay, about $14 round trip, you make $980 net after commission. So that's how this works. So again, I'm now starting to run out of time here. So again, just reminding you what I'm offering you today, again, with all these examples and this is when the time stop kicked in, right? We're going to have times where we don't make the 50%. If we don't make the 50%, we don't hit the 50% stop loss, we take it out at the 130 point, which in this case could be a winner or a loser, 20% gained on that example, right? And remember, we're going to have times where we lose, right? So that one was almost our 50% stop loss at the 130 time stop, 47% on Qualcomm. But the key is we expect to have more winners and losers, and sometimes we get the bigger than expected gap. In this case, this was McDonald's popping up for an 89% gainer. So instead of making our 50%, we made almost, not quite double that, but almost $1,500 of profit on, in this case, just a 3 lot on $2,000, right? So remember the stacking principles, everything we talked about here, if you came in late, it's kind of just summarizing as I went back. So the offer today is instead of paying $197 a month for the next 3 months and being in for $591, I'm slashing it down for you to only $177. And you're going to get all of our bonus resources, which includes the strategy session, which is almost an hour of extra training for you. So I'll give you a bunch more examples, a bunch more depth on how to apply the system settings and rule sheet that you get when you become a subscriber. Part of our terms of service on that, by the way, is that you're not going to share that with anybody, right? That we keep it private for subscribers' benefit only. Okay, so we want to keep our edge strong. So you just go to bigtrends.com/50, and the first 50 traders who lock it in get the more than $400 off of the $591, taking down more than 2/3 down to just $177. It's already been done for you on that order page. And again, remember on the order page, it has our contact info on the top right of that page. So top right of the page, there's our toll-free 800 Big Trends number. If you have questions, you can call my customer service team at 800-244-8736, or just remember 1-800 Big Trends on your phone, or you can email clientcare@bigtrends.com to reach customer service reps standing by to answer any questions you've got to lock it in before the offer goes away. So remember, you can pay through PayPal is the easiest. You just review terms and conditions, agree to it, or put all your information on that secure page and then complete my purchase in green once you've got it all in. You will get a follow-up in the email that you submit, whether through your PayPal or plugging in your email here, that you will get an email with your welcome information, including how to set up text alerts. I do recommend, since we are trading them close to the expiration, the afternoon before the expiration, I want to make sure you're in before 4 o'clock on each Thursday, right? Our next trades are going to come out tomorrow at 3:30 p.m. Eastern time. So I don't want you to miss that. And I want you to have your text alerts set up in addition to the email that you automatically get set up for initially here. So setting up the text alerts, you'll find, will really help you. I am out of time. So thanks for allowing me to walk you through all that. Go to bigtrends.com/50. If you got questions, call us at 800 Big Trends or email clientcare@bigtrends.com. Thanks for having me, David. It was a lot of fun, and I know people want to stick around for lots of more great traders to come. Keep trading well and staying well. See you again soon.
All right. Thanks, Price.
My pleasure.
Thanks for being here.
Always fun.
All right. Yeah, everyone be sure to click that link and check out that offer from Price and the team at Big Trends. All right. Yeah, so Price was our third presenter today. We have another 6 great presentations to go for day 2 of this event. And Mike Polinoff is up next. Mike, are you there? Hey, Mike, if you can hear me, you're muted. So.
Can you hear me, David?
Yeah, sounds good.
All right, good. Let me just get my share screen straightened out before you go away. And okay, so do you see the front page of my website?
Yes, looks good.
All right, so wait, before you go away, let me just make sure that
I'm not going anywhere. I'll be here.
if I change the page. So do you see now a chart?
No, I'm still seeing your site.
Oh, okay, so I guess just give me a sec here.
It's funny you said before I go away though, because I actually did run my dog around the neighborhood while Price was talking, so he was getting restless, but
All right.
he's good now. He is sleeping on his bed in the living room. So I will be here.
Now you should see a chart, I guess.
Yes, I do now. Yes.
Okay, so I'm going to go back then. So now, okay, every time I do this, I have to refamiliarize myself with the bells and whistles on Zoom. Okay, all right, I'm good to go. Thanks a lot, David. Thanks for inviting me. I must say that I usually do these webinars after the market closes. Not that these days. The action slows down after 4 p.m. Eastern time, but it is a new experience for me to do it live, real time, right in the smack in the middle of the trading day, especially on a trading day like today. Okay, hi, I'm Mike Polinoff. Let's start where we're supposed to start. I'm the chief cook and bottle washer, as they say, of mptrader.com. This is my 4th decade of market watching, chart analysis, strategic investing based on mostly technical signals overlaid on a lot of psychological market mumbo jumbo, but that is important, and overlaid also on fundamentals, meaning that I need a story to back up what I think the chart is telling me. And for the most part, the way I operate is I find a long-term situation on a chart picture that I think is telling me something special is going to happen. Whether it happens the next day or in 3 months, that's where all the finesse comes in. But that chart that's showing me something is about to or something will be happening in a big way, and I'll show you an example of that in a minute. That then allows me to work backwards and say, okay, what are the fundamentals that could be coming along that could support a story that could support the chart doing what I think it's supposed to, or it will be doing. And then I go from a monthly, weekly, daily, 4-hour, hourly, 15-minute. It's all these concentric views of the same setup to see if I can hone in on timing the move, or understanding how long I have to wait. I might have to wait in a position and get bounced around until the move emerges. Okay, so with that, let me just show you the website. So this was today, the beginning of today. I came in at, so I prepare anywhere from 6 o'clock in the morning Eastern time to 9 o'clock. And let's see, that was yesterday. So today, let's see, I came in, I must have come in at around 8 o'clock today, 8 o'clock Eastern time. And so that was, hang on a second here. So what we do on this site is, what I do is I present an outlook on various charts. And I've been doing this since about the recession of 1982. So I've seen a lot of markets and a lot of moves. Here's this morning. So my first update, and let me just, so that was at 8:06 a.m. Okay, so this is what I did this morning. I started out by the headlines that from last night, Trump's headlines that spiked the market. After a big day yesterday, it spiked it even higher. And then I go into the market reaction, crude oil. That was the obvious initial reaction to the news. So there's the picture of it. And the way I show it is, now it's starting to look like, if you can get through 86 on the downside, June crude will be looking like a big top, or this is a big distribution pattern that is putting downward pressure now on the price of crude oil. And that could be enormous for a number of reasons, which all of us and all of you know. And there was a point at which, up until a few days ago, that it looked like we were going to try to take out the top end of this between 100 and 115, and that would have been an entirely different set of circumstances for the markets to handle. So that was the first impact. Then the flip side, this is the futures market. I usually start off the day with a picture of the futures, either hourly, either S&P futures or spiders. Today is 4-hour S&P to show the entire up move from the 30th of March, the beautiful channel, and that we are now, looks like we're accelerating from the bottom, or I should say the lower channel line, due north. Now, you know, if it turns out that it goes to the top of the channel, then we will see the S&P somewhere near 7,600 at some point, probably, you know, in the next 4 to 6 weeks. It looks like, based on the way the various legs and the symmetry of the legs set up. However, of course, we've come a long way. I guess let's see. So that's actually been a higher high since this morning. So 73.75, 63.53. So we're up 16% in, you know, what, 6 weeks. So I guess we can all look at this and say, well, what are the odds that this thing keeps going? I don't know the answer to that, but I do know that it's in a powerful uptrend, and that unless weakness inflicts damage to the uptrend, I have to believe that every dip is still going to be bought, and that the news, while it's not a slam dunk by any means, it looks like the news will get better, not worse. Unless, of course, you know, of course, the way things are set up with the Iranians, it's the United States, the Trump administration makes a comment, and then it's denied by the Iranians. So it looks like, since the last week or so, the denials have provided minor weakness, and it's a buy the dip situation into every Iranian denial on anything. Now, until such time as that reverses, that is to say that they're denying and they refuse and they're forcing President Trump to go back to the battlefield. Now, that could be a real problem for the market. And that may not be a minor buy the dip. That might be a major reaction. And I would say that we're talking about to 7,000 if that happens. But anyway, so this is what I did at 8 o'clock. And then a subscriber or a member asked whether I think that commodity markets are a sale or not. And this was my response. And then I put up the agricultural ETF weekly going back to 2009. And this is a massive accumulation base formation that's not done yet by any stretch. So whatever is going on in the Strait of Hormuz, I think has compromised the flow of products around the world, and it will show up in the supply or tight supply of agricultural goods and upward pressure on price. That's how I interpret the fundamentals based on this agricultural ETF. And it's trading at the time was trading about 28, and I think it could go to 36. That's let's see. So that would be what is that? Where did I say 36? So that's almost a 30% move, and if the way this chart is set up, the symmetry is that we're going to smack into 30 to 32 right away, regardless of what happens, whether the Gulf of Hormuz is open or not. I think this agricultural ETF is going higher. So that was a way of answering his question about commodities, because this suggests to me that there's more upside pressure on commodities. And then we converse about all sorts of things during the day. I'm here to answer questions to provide my 2 cents from my experience on how charts interact with market psychology. Here's another example. Now this is an example. This is Alibaba, and Alibaba, what I wrote was President Trump scheduled to visit China to speak to President Xi in a week or so, a little more than a week. And the chart setup going into the meeting looks to me like a massive cup and handle. And if that's true, then we're about to, Baba is about to emerge from the end of the handle portion of this massive bottom pattern. And if that is true, if then means that a new up leg is emerging that will approximate this up leg, the prior up leg. So there could be an enormous up move in Baba, and Baba is considered an Amazon / technology AI type of company. And my sense is that the Xi that Baba could rally into the Xi Trump meeting summit, presuming that it takes place. If it doesn't take place and it's canceled, that would be a problem, of course. But it looks like each one of them have goodies in a summit. That's what happens. They work it out all ahead of time, what kind of goodies they're going to arrange for each other. And it looks to me like Baba, K-Web, those types of big China stocks have yet to really accelerate and participate in the bull move in U.S. equities. So this would be an example of a longer term pattern, and I'm trying to fit the last or the latest fundamentals to what could create the conditions for the next upleg. And I think the goodies, Trump is famous for saying he's got a fantastic relationship with President Xi. Well, I think that if that's the case, then Baba should benefit from it. That's pretty much the bottom line on that. So this is right up until I had to prepare for this webinar. And so then you get a gist of the website. We're all updating, we're asking and answering questions from around 8 in the morning Eastern time to 4 or 5 in the afternoon Eastern time. So there's mptrader.com. Come join us if you're interested. Most of the members have been here a long time, and the reason for that, I think, is because there are less day traders, fewer day traders than they are really retirees / individuals who have pensions that are looking for ideas to park some money that have intermediate to longer term prospects, and who want some visuals. And the patterns, the visuals, like here's Palantir, which has a different visual certainly than, say, Micron. But one wonders how much longer Palantir will stay in this range before Wall Street comes for it again. I'm thinking that this low back on April 10th was a significant multi-month correction low, and that Palantir is putting in a near-term bottom. To really get traction, though, it has to get above like 150. But if it starts to move up from here, I think we'll have an early indication that Palantir is garnering some more interest after great earnings. And I have to believe that some of the money that's coming out of these meteoric moves in Micron and AMD will rotate back into Palantir. So anyway, let's move just to some thoughts for now before I get into the chart work. Let me make sure that I can get into the chart work. So while I'm doing that, I let me go to TradeStation. Share. Okay, so you should be seeing my TradeStation chart. I use TradeStation, been using it for years. So just to back up for a minute, to be in the markets these days, you kind of have to have eyes in the back of your head and probably elsewhere because there's so much geopolitical noise, so many headlines. I mean, Trump world is just headline after headline all day long, and it's unlike anything I've ever experienced. Of course, we experienced some of it in his first term, but COVID put the kibosh on that. But now we're full steam ahead every day, many times a day. We have, we're faced with headlines from the administration. And I wanted to share something with you about that. So the news service I use is this one, is Financial Juice. You should be seeing Financial Juice. Okay, so Financial Juice is I've used it for 2 years, and I think it's excellent. And the headlines I find are very fast. It's not like you get a Wall Street Journal memo or a flash, 10 minutes after something happens. They're all over this, and you can. So when I'm sure everyone's experienced this, all of a sudden you're watching a market, and there's a spike 2 inches long from the top of the page to down towards the bottom of the page, and it's not a mistake. Someone said something about something, and the algorithms, the program traders, just put the kibosh on everything. They immediately sell, and there's no human being that could have interpreted that statement any faster than an algorithm. So something just happened. And then, of course, if it's a negative comment, if it makes it go down, then you wait for the denial and it goes back up. And that's the kind of world we're in right now. So you need eyes in the back of your head. The markets are much more complex because of it. And you have to determine what kind of market you're in beforehand. Now this is the S&P, big picture S&P E-mini, and from October 31st to now, and there's your 16%. In any case, intraday in any one of these days, even the straight up days, you get a headline, and it makes the S&P go down 30 points in 2 seconds, and you have to decide what kind of market are you in. Are you in a bull market? You have to have decided that beforehand. If you're in a bull trend, then it becomes a buy the dip or hold your breath and don't panic type of reaction. If you're not sure what kind of market we're in, then that spike could be much more meaningful. If you are long in a position, whether it's stock, ETF, or index, whatever, then you have to decide whether you should panic out because we're not in a bull market or a bull move that you think has legs. Now, right now, you can see that this is today, and for me, one of the telltale directional indicators is a 20-day MA, simple moving average. Okay, so back down here, we had rocketed to a big differential above the 20-day MA. That is the difference between where the price structure is trading and the 20-day MA is rising, stretched to as far as I've ever seen it, as wide as I've ever seen it. So I knew one of two things had to happen. Well, I didn't know, but I suspected one of two things had to happen. The market either had to pull back to towards the MA to reduce the differential, or the market had to go sideways because the moving average every day would be rising because the additions were much greater than the subtractions from the the 21st day, and then you take out the first day and to get you back to 20 days. And I knew that somehow the differential had to narrow, and there's only two ways for that to do it. Sideways, so the average catches up, or down, so it smacks into the average, tests it, and take off. In this case, it did the more bullish of the two things, which was go sideways, enabled. So 1, 2, I'm gonna call this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Could have been 2 weeks that this went sideways. Each one of these candles is a day, and the MA went from, let's say, 68.35 to 70.20. So you can see that as the average get closer to the price structure, I could get the feeling that this is make or break time. The index is going to have to take off again, off the average, because this is a real bull market, or it's going to roll over and break the average, and then you have a real warning signal. So right now, this is still very bullish, and the differential is widening, and it probably is going to keep widening because it doesn't look like we're done yet on the upside. So I wanted to do something at this point after we discussed the trend direction, and that is to look at some extremes. Boy, do we have some extremes. I'm going to use now my charts, as you might notice, are annotated all over the place because I keep notes on the charts themselves. So here are like this was Micron, and it went meteoric. I didn't update it today yet, so the high today is 667.67, and I'll put that in there. What I say was 667.67, and so here we have Micron going vertical. It gapped up 2 days ago and yesterday, and the next gap up is probably going to be the exhaustion gap. Now, I don't know that there will be a gap, but after 2 gaps, the third one is, then we're playing with the house's money, and at some point there's going to be an exhaustion reversal, gap reversal. Now, exhaustion is tricky because the pattern here suggests that this is a central, just like this move was a central move in this up leg, we are in the central move in this up leg. So I wouldn't be surprised if we went to 700, pulled back, filled the first gap, and then took off again and went to a higher high before we are exhausted. Notice that daily momentum in Micron is confirming, it's pretty overbought, but it's confirming the up move, which tells us that there's no divergences. Momentum is not waffling, and it's not near exhaustion yet. So I think that the amount of power generated by Micron is such that there's tailwinds here, even if it goes sideways. Look at the differential between its moving average, its 200-day, forget the 20-day. Let's see, the 20-day is right here. But look at the differential here. We'll call it 285. So 650, 285. So we're talking about 128% above its 200-day. Well, needless to say, that's pretty stretched, and probably historically so. So once again, we're faced with a situation where somewhere up here, Micron is going to have to take a breather or go sideways in a range, maybe for 2 or 3 weeks to enable the moving average. Now, once we get, pretty soon we're going to start 200 days, the additions to the 200-day MA and the subtractions are going to be huge. So this MA is going to start rising rapidly. So let's say that 2-3 weeks of correction, range bound before you take off again in Micron after this peak is made. And I don't know, I don't sense that it's made a peak yet today in this move itself. So that's an extreme. And all I can say is that if you haven't participated in Micron, now would probably be a pretty risky time to get involved. Well, here's another crazy one. There's a 3-time levered SOX 3-time levered semiconductor. And this is, I don't even know what to say about this. It's so stretched above its 200-day. When I updated it last, it was 180% above it. Now it's more. So this is about as stretched as it gets. I wouldn't be surprised to see this take a breather real soon, but I was surprised it took out this level actually when it did. So I don't know, it's meteoric. Unlike Micron, which confirms this up move, this SOXL is not confirming it. So it made its momentum high back here, right here at about 130 on April 27th. Now we're at 161, and which is 24% above where the price is 24% above where momentum peaked on that day in late April. So it's on borrowed time here. The question is how much borrowed time, and but I certainly wouldn't be long here. And there's fading it looked like the place to fade it was here, but right now you need a downside reversal signal to fade this right now. But it has the conditions to suggest it needs a breather for sure. Extremes. That's basically the SMH. I wanted to look at AMD. I'm going to go over to my webinar chart page though and put up AMD. All right, so here's a daily chart of AMD. I'll widen it out so you can get a sense of the candles. So this is a daily chart. The MAs, the moving averages are 20, 50, 100, 200. And you can see how far away AMD is from its 200-day. It too is telling me it needs a breather. The 20-day, in fact, is stretched as well. That is the differential between the price and 20 days. So I'd be very careful, AMD. My suspicion is, like I said to you earlier, is that I think some money is coming out of AMD and will end up here. NVIDIA. Now, NVIDIA has not participated, certainly not in the crazy MU AMD 2-3 day scenario, but it looks like it's poised to take off. So my suspicion is that NVIDIA, as long as this low remains intact, and that is from what's today, Wednesday, Monday at 194.75. As long as that low remains intact, in fact, as long as it keeps closing above the 20-day MA, 20-day MA is at 200 spot 35. I think it's this up move, today's up move is telling us it's starting an up leg that'll retest the highs. And if money comes out of AMD and MU, I think that that we'll be looking at NVIDIA up here. Sorry, up here. So that's the way NVIDIA is setting up, and I think there'll be a rotation. Not only do I think that money will come into NVIDIA, but I also think that Jensen sees what's happening to his competition, MU, or not really competition, MU, but AMD. And I think he'll let Lisa Su have her day in the sun for today, maybe tomorrow morning. And then I think Jensen's going to swing into action and take the ball down the field from her. But we'll have to see what happens. All I know is that I have a thesis and I know where I need to stop myself out if I'm wrong, or to be careful if I'm wrong, and I'll go from there. So those are some extremes, of course. It goes without saying. This one is an extreme too, QQQ, and I guess so goes MU and AMD. Will go the QQQs. All right, so let's do some extremes the other way, on the downside. Now, not everything's participating in this market, as we might. Okay, so this is Rigetti computing, quantum computing. Now, while everything is going bananas on the upside in the chip memory world, slowly, it looks like this beleaguered sector is about to finish a bottom and join the party. Oh, by the way, on my charts that are highly annotated, I put on I make sure to make a notation about when earnings are. So, you have to be careful this time of year, this time of the quarter, because these companies and their competitors will come out with earnings, and you can't just be a closet technician, as it were, and disregard earnings, because you could regret it. But in this particular case, Rigetti looks like it is getting ready to take off. Now, it went to an extreme in the opposite direction. It went from 58 to, what is that, 12 and a half, maybe 12, close to 12 at the low. And everyone, said, okay, the boom is off that rose with quantum computing. But look, over the last, I'd say, February, March, April, and part of May, 3.5 months, it has built a bottom. Looks like a bottom, and it's about to try to break out above 20 to 2010. A close above there will trigger a nice move, maybe up to as much as 30. And earnings, let's see. Do I have earnings here? Let's see when earnings come out. RGTI. Okay, Seeking Alpha says earnings are coming out on the 11th. Okay, today is the 6th. So we're talking about next Monday. Is that that's after the market closes next Monday, comes out with earnings. So it'll be interesting to see. I think it has enough power here, and the setup is such that it has enough power in this pattern to break out into earnings, before earnings, and rally into earnings. The blue average is the 200-day, which is accented or angled to the upside. When it's upsloping, it is not putting downward pressure on the price. So we can slam in here, but it's much less of a resistance plateau than if the average is moving down. And that red average was the 100 days. So today it looks like it's taking out the downsloping 100-day, which is a very good sign. And if it closes above 1899, it will close above the 100-day moving average for the first time since back in mid-December. So that's an example of an extreme on the downside that's attempting to bottom. Another one that looks like, or that could be in the running, is Oracle. Now, Oracle looks like it's bottomed also, or it is bottoming. And it is breaking out as we speak. The 200-day is sloping to the downside, but not at an acute angle. But it's at 211, which is still, $20 from higher than where Oracle is now. So Oracle looks like, it's about to accelerate out of this little bottoming situation after it had just a terrible time. But it looks like it's put in the work and the setup for it to move at least to challenge the 200-day, if not higher. Got some gaps to fill up here too, 216, 211. So that's Oracle. That's another example of an ignored name that's in a sector that should be doing a lot better, but may be the beneficiary of rotation out of the MUs of the world and into its coffers. Let's see, Oracle earnings are coming out not till June 8th, so Oracle has some time. All right, so that's Oracle. Now here's one that I'm sure everyone is sort of interested in, and this is the software ETF IGV. Now look at that. For all of the consternation and terrible price performance of the IGV and the software stocks, it too looks like it's bottoming. I mean, or putting in the work to form an accumulation period that has real potential to the upside. And the 100-day moving average, which we just saw Oracle took out, IGV is nestled and just underneath. So this is a test for the IGV. If it can close above the 100-day, that'll take you up. It'll probably fill this gap around 96, and head towards a confrontation with the 200-day. As I see it, as long as the 20-day, which is the yellow average, 84, contains any acute pullback, I think this is a buy the dip situation until it's not, and that IGV is bottoming, and that we will start to see money coming out of hardware into chips into software again. Maybe it's selective. Let's see, if we put up snow, you see snow doesn't look like IGV. So snow has some work to do. And that's a problem for snow because it's lagging. Salesforce, it looks a little better than snow, but not a lot. So you have to be selective, and probably the way to go is with the IGV. ServiceNow, the last three look pretty much similar. So IGV would be the way to go from a bullish pattern perspective. If you wanted to, I would say park some money and spend some time in software thinking it's going to recover. So those are some extremes on the downside. I'll show you one more, ASTS. So now ASTS, it may have finished a correction. I'll give it the benefit of the doubt for now, but it has so much work to do. Just to get back above the 200-day, it's going to be, to me, which is at 74 and change, well, 74. To me, this is it's got a lot of work to do. And there are easier fish to fry than this one. So my sense is that when it's done this much damage and it's below the 200-day, chances are it has to build a base first. And that base is probably will confine it, I would say between say 77 and 65. It'll probably need to mess around in here, and then if it breaks out, then we have a bottom. But until it does, it's a scary setup. Even though it looks like this is not a bear market at all in this stock. It's a bull market followed by a major correction. But after a major correction, oftentimes you need several weeks of bottoming before it can take off, like IGV. I mean, it's been bottoming arguably for, since the beginning of February. So it's put the work in. Whereas ASTS has not yet. Okay, so let's go over a couple of others that have patterns that are intriguing. Here's one that surprisingly strong for months after a major, I wouldn't even say this is a correction. I would say that Cava, which is the Mediterranean cuisine restaurant, I would say not gourmet dining, let's put it that way. But it's healthy, good food, and it went into a bear market, and it spent the time, like I was saying, it spent the time to put in a base, did so, broke out, retested the breakout point, and now is headed higher. I think it's still headed higher. Now this is a big bottom for Cava. The question is, can Cava take out $100? If it can, it's going a lot higher. On the other hand, I need it to stay above this trend line for me to stay interested. So basically, you would risk somewhere in the mid 80s to low 80s for an up move to 100 next. In terms of Cava's earnings, are on the 19th of May, so they're coming up. And my sense is that since it peaked on April 20th, by the time we get to earnings, chances are this will be a really mature pullback and ripe and ready for a bullish catalyst. And Cava seems to be in a sweet spot now. They got their act together after the tariff situation, which raised the price of avocados, whatever else, who knows. But they have their act together, which is evident by this bullish pattern, the uptrend pattern, and it looks like the catalyst should elicit a bullish reaction. So that's Cava. Another one that is schlepping along, as it were, is this one. One of these days, this is the Cathie Wood ARC genomic, like biotech ETF. Now, I view this as a massive accumulation pattern. It goes back to June of 22, so 4 years. And when it takes off, it will mimic, the up move will mimic the symmetry of the down move from here. It'll climb this wall. Now, the way I view this ETF is that it is a biotech AI-driven ETF. That is, that the companies that are moving or will move the ETF higher will be the companies that are integrating and using AI in every which way, from research to drug trials, drug discoveries, you name it. And this is the area where I think that AI is most useful or could be most impactful to society is in biotechnology and medicine. So I think it's just a matter of time before this rockets. And I would keep an eye on this one. Technically, if it breaks out, or when it breaks out, needs to get, it needs to take out the prior high, which is 32 roughly, and then it needs to take out 33, 34. And if it does that, then it's going there, and it's going to keep going. That's the way that the length of the space is so enormous that once it breaks out, it'll be a chase. The chase will be on. And I don't know what the headlines will be, but there'll be some breakthroughs in biotech and drug discovery and cures and all sorts of stuff. So this is an exciting one, although it's so far been very frustrating for anyone who's been in it. Especially since it looked like it was trying to break out twice already in the last several months and failed. So now it's working its way back up. So I'd keep an eye on that one. And we went over BABA, DBA. Okay, so those are the basic ones. All right, let's do one that's really a pain in the neck, because it's a bull market. This is ONDS. It's the drone company in a world where everyone's going to have to rearm in drones, because China's making all these drones. I heard or read yesterday that China's responsible for 90% of drone manufacturing, or the component parts. Well, that'll have to change. And this is one of the companies that will do that. So I see this as a bull market from, March of 2025, and a major correction that has carved out a coil type of formation. And the 200-day is catching up to the price structure. Now, this was one of those cases where back here, the 200-day was well, if it was at 450 and the stock was at 1530, and the 200-day was trailing 240% below the price of the stock at the highs. Well, you can see that's definitely narrowed now. So it's put up or shut up for ONDS pretty soon, because once it nestles into this moving average area, ONDS should put in a reversal day to the upside and take off. Now, ONDS, its earnings are coming up too on the 14th. And my sense is, based on the structure of this pattern, that this coil is going to be breaking out to the upside once, in reaction to or in anticipation of earnings. So that's ONDS. Let's look at Uber, which came out with earnings this morning. Now, Uber it's in a big bull market, had a major correction, and has put in the work for the last February, March, 3.5 months. It's put in the work building a bottom. Today it took out the 100-day moving average, gapped up, and Uber looks like it's headed for a confrontation with its 200-day moving average, which is at 85. It's at 80 now. This pattern argues for it to go to 90. So Uber looks pretty good, and it looks like it's completed its bear market. It's completed its correction after a completed bull leg. So that's Uber. One more. Okay, silver. Now this is the SLV version of silver. So it had, everybody knew silver had this extraordinary run up. Talk about differentials between the 200-day and the price. At the day of the high, the 200-day was at, well, the high was 92. I don't even know if this was the intraday high. This was the high after the opening. Um, so it was 110% above the 200-day, and now it's a heck of a lot closer. And it looks like it is bottoming, basing, accumulating for an up leg. Now, from what I read about the fundamentals in silver, well, there is no silver. There's scarce physical silver, and deficits expected for the next 3 years. The Chinese are restricting refining silver. So they're restricting silver that's coming out of China that the refiners need. And silver, I think, is on the president's or the United States list of metals, strategic metals, that will be subject to U.S. export restrictions. So every which way, it looks like silver it had an emotional, crazy run up. And now I think today it's right here, 69, 68. Let's see if it can get back above 75, because then I think there's just giant gaps up here to fill at 100. And who knows where silver can go. But it looks like it has finished the correction, has done the work for a new up leg, another up leg, and is poised to continue higher now. While we're at it, GDX. Now, I thought that at some point GDX would be the go-to have to own ETF or sector as the U.S. fiscal and monetary situation became more and more complicated. Now that we have some inflation in the mix, that doesn't look like it'll be going away anytime soon. It appears to me that now that it has come down to nestle under or above its 200-day moving average, that GDX is poised now to resume its dominant bull market. Obviously, if it breaks down below the 200-day, that would be a really big warning sign that it's over and out. Money is going out of this thing. My sense is, though, that GDX is going up here. And the reason for that is because I think that the gold miners who have gold assets in the ground, silver too, copper also, which we didn't do. I'll do for FCX in a second. That those assets are going to be a must-have. I'm not going to spend any time talking about the debt and the deficit, which are widening. It's almost 40 trillion now, which is I don't even know how many zeros 40 trillion is on a piece of paper. But I know that my whole career, pretty much, we've been talking about the deficit. The debt. And it just keeps widening. And I don't know when the chickens are going to come home to roost, but that day that it becomes apparent that the chickens are coming home, I hope to own GDX, because I think that is a hedge, a powerful one, because of the gold assets in the ground. All right, FCX, and then I'll jump over to FCX. On this chart, I didn't update it for a while. It's on another chart of mine, but here too, you have a bull market in FCX, made a marginal new high. It failed. has had a major correction. So let's yank this away. Put this trend line under here. And so as far as I'm concerned, as long as this level, 55 or so, contains any rollover into weakness, I think FCX will retest this high and take it out, go to 75. Certainly there's a gap here that will be filled at some point, I think sooner than later. So FCX is I think it's a copper issue, and the copper is in the same category as GDX and SLV. One last thing I want to do, if I can jump over to the chart real quick and then change the page. Okay, let me just change this page for you. There is Bitcoin. All right, Bitcoin. All right, let's see, new share. Okay, you should be looking at my Bitcoin chart, which is a 4-hour Bitcoin chart. And up until right in here, a couple of weeks ago, I was thinking that this was a counter trend rally that would break down, take out, 65, retest 60,000, and go to this level, 52 to 55, unless it managed to break out, hold, and accelerate higher, which it's doing now. And I think that the next target is 85,000, which isn't much from here. But the question is, what does it do at 85,000? My sense is that if it can hold in and around or higher than 85,000, then I can let go of the idea that this was still a counter trend rally that has some ugliness left in it. But since Bitcoin hasn't participated in a way that like Micron or the Qs or the S&Ps, I think it's under owned now. So it'll be interesting to see what happens. If it's under owned, then it rips past 85,000 and then goes to 95 or 97 to 100. And then it becomes a whole different chart. And then I think we're looking at, let me see if I can change this. My weekly chart, I haven't updated in a little while, but let's see. Whoops, I'm running out of time. So this is the long term, and look at what momentum has done on a weekly basis in Bitcoin. So Bitcoin has a challenge here at 85,000, and then I think that's kind of like the line in the sand for upside continuation or reversal.
Hey Mike,
Anyway,
yeah, sorry, I gotta cut you off there.
Yep, thanks a lot.
All right.
Thanks, David. I really appreciate it.
Thanks, Mike. All right, thank you to Mike Polinoff of mptrader.com. So check out his site. And then next up is Marina Villatoro. Marina, are you there?
Hello, I am here. How are you?
I'm good. How are you?
Great. Okay,
Uh,
I'm just fixing up my trying to figure out how to share my oh, here we go. Um, okay, are you able to see my screen?
it's loading, and yes, I see it now.
Okay, wonderful. Well, hi, David. How are you?
I'm good.
How's your dogs? You have one or two?
One. Yeah,
Oh,
he was being wild earlier, but when Price was on, I took him for a run around the neighborhood for a bit. So he's calmed down now.
release some energy.
Yeah,
It's like a little kid.
yeah, yeah. Very high maintenance.
Yeah. In a good way. All right. Well, thank you for having me. Hi, everybody. Thanks so much for sharing this time with all of us here today. I really, really love hanging out with you guys. And I'm here for you guys to learn something. That's kind of the goal. And whatever questions you have, please let me or David know. We are happy to answer anything, or David will let me know as well. So please let me know and let us begin. Hang on one second. All right, well, oops, what just happened? I am Marina, the Trader Chick. And today, what I would like to talk to you guys about is understanding, like, I want us to kind of, instead of just jumping into charts and listening to different people's strategies and not fully understanding, or looking sometimes and wondering, oh my goodness, I have no idea what's happening, but I don't feel comfortable enough asking, because that was the story of my life from the beginning. Especially, I'm now going on 14 years of trading, and I have to say the first several years pretty much was me watching a lot of other people in these types of summits, or I also paid an arm and a leg to be in many different conferences, summits, academies, mentorships, you name it. And usually the majority of them were, just kind of dropping me in the middle of a sentence. You know what I mean? I actually like to talk, the metaphor that I like to give, or the analogy is, if you want to learn how to play a musical instrument, just because you arrive to the conservatory, doesn't mean that you're going to learn just by entering. And the majority of the times, I find that with trading, especially like watching all these people talk about these really complicated, ideas, or how they've been trading for many years, and you think that you're going to be able to follow them within, like, the 5 minutes that you're watching them. It's kind of like when you enter the conservatory and you've never touched a flute, and you want to learn how to play a flute, and they throw you into the symphonic pit with all the professional musicians and expect you to keep up. And you know what happens? We end up losing a lot of money. We end up losing a lot of our time. And worst of all, we end up losing our confidence. Right. So today I kind of want to bring that back. I want to give you back the confidence, because once we fully understand what is taking place in front of us, that's when we can master any market under any condition. And that's literally the secret, to be honest with you. That's like the secret sauce. It's just understanding what is happening for us. What is that we're looking at? And this way, whenever we watch anybody else present or be in anybody's chat room, we can follow along pretty easily. So before I begin my presentation, I just want to do a really quick intro. I am Marina, the Trader Chick. I am an expat living in Barcelona, Spain. I've actually been an expat now for almost 24 years. And for 20 years, me and my family lived in Central America. And now we live here. I love Spain. It's absolutely phenomenal. I'm so grateful to be an expat living here. And the greatest thing about Europe is that the markets for me open up around 2:30, 3:30. So I have an entire day to enjoy myself, and then boom, I get to hang out with the markets for a couple of hours, and then I get to enjoy the rest of my afternoon as well. So before I became a day trader, I was actually a fitness instructor. And the reason why I bring this up is because a lot of people have this idea that they need to be math whiz, or financially, from a financial background, or from an economic background. And the reality is, none of that is true. You can come from any walk of life and become a successful day trader. That is the beauty of day trading, right? Also, we can work from anywhere in the world. There is no more excuse today. Oh, well, how's the internet? It's funny because, like I was saying, I've been now trading for almost 14 years. And even when I was living in Guatemala, that's where I began. People used to be like, oh my God, how is the internet there? Is it really working? Blah, 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 blah. And I used to say, when I used to go and visit my family in New York City, my parents are in Manhattan, sometimes the internet was worse in Manhattan than it was in Guatemala. So honestly, there's really no reason for you not to take your chart and go travel the world and trade. That's the beauty of it all. So before I jump into the presentation, because I only have less than 1 hour with you guys, I have the entire presentation for free, completely for free. You can go and get it right here. This way you could follow along. And also David puts up the replays so that you can follow along with the replay. So please go here to makingofadaytrader.com, makingofadaytrader.com. Go and get your free cheat sheet or worksheet, whatever you want to call it. You could go and pick it up right here, makingofadaytrader.com, and you'll be able to sign up and get it right away. All right, so let's jump into the good stuff. What in the world is day trading? Why is it not investing? I don't know about you guys, but whenever I used to say that, oh, hey, I'm a day trader, people are like, oh, I want to learn how to invest. Well, the thing is, investing is not like day trading. And probably the most important part of all of it is day trading, you do not want to diversify. I know that there is this massive, massive misconception that the more you trade, the more instruments you trade, the more you're going to make, which is truly the exact opposite. It's the least amount that you trade, the more you will end up making. Why? Because you don't want to diversify. Look, I'm going to go back to the musical instrument example. Okay, imagine your child comes up to you and they're saying to you, hey, I want to learn how to play a musical instrument. And you ask them, okay, what do you want to learn how to play? And they're like, well, I want to learn how to play the violin, the flute, the piano, and the drums, right? And you're looking at them and you're like, okay, all of them are so different. How about we just focus on the one instrument, and once you really master this instrument, then you can move on to the next. And honestly, in over 10 years of now being a day trading educator, I have to say, when we focus on the one instrument, whatever instrument you guys decide on, I have rarely seen many people go on to trade many more simply because they're doing so well in that one, and they have the rest of the day free to enjoy themselves versus going into another instrument. So yeah, you might make a little bit more money, but honestly, you'll be already kind of burnt out on the instrument that you were trading in the morning. Just go enjoy yourselves. But with day trading, you don't want to diversify. It is such an important thing to understand. Plus, with investors, the thing with investing is when you invest in a company, you're committed to that company, right? You could go through their ups and downs. So basically, for example, if I invest in Apple and I know that they're coming out with a new product, I'm going to sit it out, right? There's going to be days that Apple's going to move up, there's going to be days Apple moves down, but overall, I'm okay with it, right? I'm going to sit through because I wanted to see going up, up, up. Day traders, we don't care if the market's going up or if the market is tanking because we actually end up making more money when it goes down. But it doesn't matter for us because technical analysis is all that matters to us. So I want to do something really important, and I have realized this pretty much amongst everything that I've done. When you have limiting beliefs, misconceptions about certain things, you really limit yourself, right? And interestingly enough, with day trading, there are some serious myths and misconceptions that really keep us back. So the very first one is it's too risky, right? The day trading is gambling. Well, let me ask you this. If you want to fly a plane, if you want to learn how to fly a plane, are you going to just hop into a plane and go? Absolutely not. Why? First of all, it's absolutely ludicrous. You'll never even know how to turn it on. Two, if you do by any chance accidentally do turn it on, you're going to immediately be like, oh my God, this is such a massive risk, right? This is so risky. I can never take it up. Because we all know that if you want to be a pilot, you got to go to pilot school. If you want to be a day trader, you need a strategy, guys. You need a strategy. I cannot even tell you how ridiculous it is when people say, I want to trade, and just because there is no barrier to entry, they just go in and start donating their money to the market. And of course, once they lose that money, they're going to be like, oh my God, it's too risky. It's like gambling. But it's not. It's because you don't have a strategy. Once you have a strategy, your risk immediately goes down to less than 20%. Okay. The other massive thing is, and I actually thought that this was already like gone and forgotten, but just the other day, somebody brought this up to me again. So I need to explain this. You do not need $25,000 to get started. This is so like 1990s even, right? You don't need $25,000 today. You could literally begin with any size account, $100, $500, $1,000. And again, the other misconception is just because you have a lot of money does not mean you're going to make a lot of money. If anything, you're going to lose a lot more money. It's actually better to start with a small amount, a small account. You do not need $25,000 today. That is a total lie. And the only reason people are still hearing this is because brokers tell you that if you have a certain amount of money, they could then give you a margins account. And we're going to talk about margins account because margin accounts they're like loan sharks. That is something that you do not need. And I tell everybody to stay away from it. All right. Massive, massive misconception that you need to be a math whiz with a financial background. Not at all. I never look at math. I never use math when I trade. There's absolutely no reason for math. I don't even look at numbers. If I need to do any sort of arithmetic, I grab my calculator. Why? Because technical analysis is not about math. It's not about financials. It's literally about patterns and understanding what is happening in front of you. And technical analysis, once you understand how to use it, anybody could do it from anywhere in the world. And that is stressful. Well, let me tell you, if you have something like this going on, 100% stressful. Absolutely. Why? Because this can give anybody an anxiety attack, right? I have chart, one chart. That's all I use. And the other misconception is that you need to buy the latest, newest softwares, indicators, algorithms. Completely not true, guys. If you have a really strong platform, that's all you need. You need a really good platform to work with. And that platform usually has a gazillion universal indicators that you could work with. And today, quite a lot of them have different algorithms that you could play with. You do not need to be spending extra money on the softwares, indicators, or algorithms. Don't do that. The other thing is news. So many people that trade equities or pretend they want to trade equities, they have this thing that you have to wake up at 4 a.m, start to research and do all this market analysis and all this other stuff. Then once the market's open, you got to open up your charts and sit in front of your charts. I mean, it's exhausting just even talking about it. And then after the market closes, that's when they sit and study even more. Why? Because they lost. Right? Because if you win for the day, are you really going to sit around and continue studying why is the market is doing what it's doing? No, you're going to be out enjoying the money. You're going to be out enjoying your life. So take my advice. No research, no news. It is not necessary. Okay, I actually call it the telenovela of day trading. And there's also that big, big thing called buy on the rumor, sell on the news. How do we know when is the rumor and how do we know when is the real news? We don't. And chances are we won't know until it's too late anyways. So the most important thing to do, just follow the technical analysis, because following market research, you're just going to get caught in the loop of not really knowing what's going on and missing out on all the really good, solid trades. So this is another really big misconception. This has been my biggest issue when I began as well. Not only was I not sure what to do, I was trigger happy. What is trigger happy? This is a real thing, guys. And I can guarantee the majority of people sitting here today have probably gone through this particular thing. So what is being trigger happy? For instance, I used to trade for 2 hours, and within that 2 hour session, I would take about 40 to 60 trades. I mean, just the commissions alone would eat me alive. That's where I would probably lose the majority of money, even if I ended up winning, quote unquote, winning. All right. You don't. So, one thing I did recognize when I started to really become more and more a trader and really become more with a strategy, I realized that the professional traders, they're like big game hunters. They go for the big game. They go for the big trade. So what does that mean? It means big game hunters, they don't shoot at every little prairie mouse and field mouse that goes by. They sit and they wait for the big kill, right? The same thing with pro traders. They maybe take two, at most three trades per day. Okay, at very most three trades per day. Because the reality is, the most radical way to trade is conservatively. You don't want to go too crazy. You don't want to go for the super big trades because the chances of you losing bigger than winning bigger is much higher. Also, the more you make, the smaller profits daily, they add up to those big profits yearly because you're conservative, you're strategic, you are consistent, and most of all, you are profitable because that's what we want. We want to be profitable. Profitability leads to confidence, and confidence leads to more profitability. Okay. The other thing is FOMAT. I think I've coined this term FOMAT, which is fear of missing a trade. I'm sure you guys have heard of the term FOMO, fear of missing out. So the majority of people have this thing called FOMAT. They look at the market and then they got distracted or they had to go to the bathroom and come back and they see that a good trade just passed. So instead of just letting it go, knowing there's going to be a million other trades, they start to chase it, right? They start to run after that trade. By the time they catch up with the trade is already turned around and now they're just sitting on massive losses. Think of yourself as a surfer, right? If you go out surfing and you are just paddling out, and all of a sudden there's this beautiful wave that was out in the distance, you can't catch it because you're not close enough to it. So what do if you're a surfer? Are you going to cry about it or try to figure out how to catch that one wave? No, you're going to be like, you know what? I know there's going to be many other waves coming. And guess what? There's always another trade, another wave coming. So get past this FOMAT, the fear of missing a trade, and just let it go because there's more coming your way. All right, I want to talk about what to trade because this is a biggie. A lot of people have this total misconception that they need to be trading all these instruments. And a lot of times people don't even know what they want to trade. And it's really important to know what you want to trade because this is what you're going to be committing your money to. So let's just kind of go over the markets really quickly. We all know what Forex is, right? The foreign exchange market where you are trading pairs of currencies. Obviously, the big one is always US versus Euro, right? It's always like that. But there's many others that you could trade as well. Look, the thing is, if you are going to go for these pairs, don't do more than two. I actually don't even recommend more than the one pair because it's just too much work and it's too erratic because the money, it's not about what's happening in the market. It's about leadership. And one leader could be in a fight with another leader without you knowing. And then you wake up and all of a sudden your pair is really struggling and it had nothing to do with the decision you made. But if you have too many, you can't keep up with them. So stick to the one. And equities. Oh, I love this. There's a lot of times I go to people, who say that they're trading or they want to trade, and I'm like, okay, well, what do you trade? Or what do you want to trade? Oh, I want to trade stocks. I'm like, there's like 5,000 stocks in the United States alone, right? So what do the professionals do who trade stocks? They do either sectors, let's say pharmaceuticals, technology, entertainment, then they could really focus on those sectors. Or they go for just the big caps, the small caps. There is definitely a lot of people that love to pretend that they are trading penny stocks. That is without a doubt the most manipulative market out there. And I highly recommend not to touch penny stocks. However, what a lot of people do really well with are individual stocks, especially the mega ones, right? We have Meta, Tesla, Microsoft, Amazon. These stocks move with so much volatility, every day that you could do really, really well just trading those stocks alone. The point is, niche it down, guys. Don't tell me you're trading stocks because you sound like an amateur. Chances are you are an amateur. And when you do that, you take action like an amateur, and that always leads to losses. All right, the futures market. This is my personal favorite because I trade mainly the E-minis, which is the S&P 500 index on the futures or the commodities market. But when I hear people say to me, "Oh, I trade futures," so I ask them, I'm like, "So are you trading soy, wheat, crude? What are you trading? Indexes?" Again, if you are a pro, you'll tell me exactly what you're trading. I trade the E-minis. That is my thing. What is your thing? Find out before you start to just do a general thing, because then automatically your actions are going to be speaking as you are saying. They're not going to be professional. They're going to be generalistic, and they're going to end up losing money. Options, same thing, guys. Are you focusing on the options? Learn the options market, understand what they all are about versus just saying that, oh, I'm going to do options as well. Do one thing first and then move on. And my other favorite thing is crypto, right? Obviously, the biggest one with crypto is Bitcoin. There's also Ethereum. But overall, there's like 6,000 altcoins and projects out there. So if you're going to be doing anything with crypto, again, learn your market. But one thing I will tell you not to do is ever leverage crypto. Okay? Not a single person I know who has leverage has ever won because it is such an erratic market and it is still not flowing properly. It could stop you out in 1 second and give you hundreds of percentage in another second. But with leveraging, you will lose and you have to pay back what you lost. Okay. And this brings me to brokers and exchanges. So people have this idea that when you want to start to trade, you need a brokerage account. I actually get so many people that want to trade. They come to me before signing up and they're like, okay, I just signed up with a broker. And I'm like, well, what are you going to be trading? I'm not sure, but I already signed up with a broker. I'm like, but if you're going to be trading futures markets, you don't want to be with an equities broker. Why? Because of commissions. Okay. So an equities broker might have some futures instruments on there, but they're going to charge you extra because you want to be with a special market that you want to be with, right? So if I'm going to be doing crypto, I want to make sure that I'm with a crypto exchange. If I'm going to be doing equities, I want to be with an equities broker. If I'm going to be doing futures, I want to be with a futures broker, right? So you need to first know what you want to trade versus getting a brokerage account because that doesn't work like that. Now, I want to talk about margin accounts because margin accounts is a really great perk kind of a way for a broker to tell you they're going to be lending you money. That's literally all it is. And they're going to say to you, oh, you could do a margin account. Never is it obligatory or mandatory. But for instance, if they tell you that, so what happens? So here you are with a certain amount of money and you just spent all that money on buying certain positions. And now the broker's like, well, hey, you could also do a margin account. Basically, we'll lend you more money for you to pay to buy more stuff. And we don't care if you win or lose because you have to pay us back and you have to pay us back with a percentage of interest. So be smart. Say no to margin accounts. Okay, be smart, guys. Don't get margin accounts. The other thing that's really important for you to understand when you are starting to trade, why is it important to know what you're trading? Because you could be spending so much money on commissions simply because you are not with the correct type of a broker, right? So if I am going to be trading futures, I want to make sure that I am with a futures broker and a futures platform because then my commissions are much lower. Also, my live feed is very much directed to what I want to look at, and so are the quotes, right? You never want to be in delayed because delayed feed is literally, it's just a death sentence for your money, right? It's like that is a guarantee that you will lose all of your money because you are not in real time. You need to have real time data. Okay. And all of this can be done really well from a platform. This is probably the only thing that I really recommend spending your time and energy and money on is finding the best trading platform. You cannot be a Formula One driver in a minivan. You need the proper vehicle, and a good platform is that vehicle. So be smart about it. And usually, like I said earlier, good platforms, they all have softwares and indicators that you can use, okay, already installed. And they're usually are able to attach to a really strong, good broker that you could trade right off the interface of the platform. So, one thing in life, no matter what you do, it could be a janitor, a doctor, a day trader, a pilot, there's going to be a lingo that is used within your field, right? Nothing's different when it comes to the financial markets. And yet, because there is no barrier to entry, people start to put in their hard earned money simply because they think that if I have money, I'm going to make money. They start to enter the market without understanding what the market is saying. Okay, so let's begin with intraday trading. Why is this even important to understand? Intraday trading, you're literally in and out of your positions in the same day. Why does that matter? Because then you could focus on the correct time frame, right? If you are going to be trading, if you're swing trading, do you want to look at a 1 minute chart? But if you're day trading, do you want to look at a 4 day chart? So when you understand what you're doing, then you are able to look at the correct chart. Then we'll talk about bull market. I mean, bull market, the market's going up. We kind of know this bear market going down. If you don't know these terms, guys, do not put your money anywhere near the live market because this is kind of like literally understanding green light, red light when you're sitting at a traffic light. All right. The other really important thing is that there's actually 3 trends to a market, not 2. 3. And the third one, the least likely one that you probably think of, that's the one that usually eats up all of your profits. So the 3 trends is the upward trend, the downward trend is the next one, and the really important one, the sideways trend. What is the sideways trend? This is the channeling market, the consolidation market, the exhaustion pattern, the chop, the channel. I don't care what you want to call it, the indecision zone. This is where a lot of people have this belief that they need to be putting in money because the market is going to do what they think it's going to do. And meanwhile, it's doing nothing because that section, that area is literally nothing. So when it just bounces in between 2 areas, that means there's no direction. You got to understand that this is a sideways market, and this is when you stay out entirely. All right. Another really important thing, and a lot of people don't understand how important it is the profit target and the risk management. They are mirrors of one another. The profit target, why is it important to have a profit target in place? Because your deadly sins are going to come and get you. The ego is always going to be like, wait, it's going to continue in your direction. Remove your profit and just go. Take the profit because it always turns around and goes the opposite direction and then stops you out. That is, if you are even smart enough to have a risk management in place, because again, the ego is going to tell you, you know what, let's just put a mental stop in place. And what is a mental stop? It's a lie. It's a mental seatbelt. It's literally like saying you're going to put your baby in the car and you're going to put on a mental seatbelt, right? That you're going to save your child if there's an accident. Guys, ego, greed, these are nasty things that come and attack you. So make sure you put in the profit target that the greed does not get the better of you, and then put in a risk management that your ego does not tell you that it's going to continue, it's going to turn around and save you. Save yourselves beforehand. I guarantee you, you will thank me later. All right. And again, all this can be done from a really good chart instantly. It's called automated trading. Once you enter a trade, it's a boom, you have a profit in place and you have a stop in place right away. And indicators. Indicators. So the other misconception is that you need to have a ton of indicators, right? So when I began, I used to follow all these different gurus and I had over 10 indicators and I was in constant analysis paralysis. Constant. You guys have to monitor and figure out which is the best indicator for you. After I lost way too much, quit, came back, I decided to completely strip my charts. And some of the big gurus used to use Bollinger Bands, Kettler Bands, Fibonacci's, right? When I removed those three, I felt the biggest load lift off of me. Why? Because I never connected with those indicators. I never connected with them. And once I found the indicators that I connected with, that's when the real money started to come in. Okay, we talked about the trending markets, guys. Stay away from that sideways market. It will kill you. All right, let's look at the super basic stuff. Buy, going long. I'm actually a bit surprised when I hear people who are entering the market and they don't even realize that they're in a long position or that they are buying. They just are in, only to find out that they're actually in a short and selling, right? So what's a buy? A buy is when you enter low, exit high, and take the money in between. What is a sell or shorting the market? It's literally the opposite. When you enter high, exit low. And that means you're taking the profit in between. You're shorting the market. You're selling. This is all that means. Now, the other big difference between a professional and an amateur is market entry. I am pretty sure a lot of us here are entering at market. What does that mean? It means that you're looking at a chart and you're saying, "Oh, this looks like a good idea." Means you don't have a strategy, and then you put in a market entry. The market knows that you are an amateur because if you actually were a pro, you would have put in a limit order. What is the limit order? It's telling the market where you want it to fill you, the exact price that you want it to fill you. And that is really, really important. Okay, that is the most important thing, is to understand that when you are putting in a limit order, you're in control. When you're doing a market entry, you're telling the market that it is in control. And actually what it does, it fines you for it. It gives you slippage. You end up losing money because the market knows you are not a real trader. And this goes for the stop limit. Exiting at a market exit is another sure way to say you really don't know what you're doing, and the market again charges you 20 to 25%. So if you see the market, if you see that the loss is at 1 point, it will actually stop you at a 1.25. So you end up losing more because you're showing the market that you don't really know when you want to enter or exit. So put in a stop limit and also put in a limit order when you are entering, and a profit target as well. All right, so let's talk about technical analysis, because technical analysis is really the magic pill. Once you understand technical analysis, and the cool thing about technical analysis is that it's free. It is on any market, any chart, and you could read it with technical analysis. And it is the beautiful part of it because it's not hard. So what are technical analysis? First of all, areas, right? Resistance and support areas. Resistance is literally the ceiling of a market. It's when the market is hitting a ceiling 3 or 4 or more times, and the market respects that. And the support area is when the market's been going down and all of a sudden it starts to hit a floor that is hitting 3 or more times. That means, okay, this is where I have to stop because the market is respecting this area, and I don't want to risk my money on that because it might not actually break through these areas and it could bounce off, and then I could really lose big. Then we have reversal patterns. This is my absolute favorite. Why? because this is so simple to spot, and yet they are probably 90% really powerful technical analysis signs. So reversal patterns is a double top, double bottom, triple bottom, head and shoulders. And once you can recognize them, the aha moments is going to be absolutely amazing. And my personal favorite is divergence. So I use two indicators. I use the EMA and I use the MACDs. As you can see right here, the MACDs are below. There are my red dots and the price action. So you can see that my price action is moving upward. Meanwhile, my MACDs are moving downward. What does that mean? It's just divergence, right? What does divergence means? It means that the market is slowing down. That's what it means. It literally means the market is getting weak, it's slowing down, and you need to slow down and take your money out until the market is telling you that it is back on track. And which direction is it going to even be back on track with, right? So, this is a beautiful way to understand that right now is not the time to enter, or if you're already in it, get out fast and you can still make some money, right? So let's put all of this together. Like I said earlier, you can get the entire presentation for free, makingofadaytrader.com. All right. So once you understand technical analysis, you are able to apply it to check to find probably the most powerful trades out there. And most powerful trade in my mind is the breakout trade. Once you're able to spot the breakout trade, you'll be able to start taking it over and over again. So what is the breakout trade? It's literally when the market is going in one direction and then it flatlines, right? It just has this moment of indecision. It's not sure what it's going to do. It's channeling. It's just blah. But then all of a sudden, boom, it breaks out in the same direction. That's the breakout trade. So if you don't have your resistance, or it could be support area, drawn in there, how are you going to be able to spot it? And on top of that, you can see here, I have my resistance area drawn in. And now look at my MACDs, right? It's the lines below the little red dots, and you could see here a dashed black line. The black line is the zero line. That means that is where there is absolutely no strength in the market. And you can see with this resistance area, the majority of the dots are kind of circling this dashed line, right? Until boom, it breaks out. It's a massive, beautiful breakout. Look at that. It broke out with my MACDs. It broke out with my price action. That's the breakout, but I have my technical analysis in place as well, right? I have my resistance area there. I'm spotting when things are coming out. So when you are able to recognize these things, guys, you are able to take the trades, and simply having a really strong foundation of the language of what is happening in front of you, that's what's going to actually make all the difference in the world. Because the reality is, we have everything that we need to take action, right? Everything we have, for instance, we have YouTubers, we have gurus, we have incredible books, we have mentors, we have these presentations, right? But at the end of the day, how do you know that you are doing it right? How do you know that you are doing it right? Because all of this is great, but the real question really is, you're asking yourself, how do I get started? Right? Like, how do I even get started? And this is not from beginners. As a matter of fact, I get these questions a lot more from people who have trading for a while and still are not consistent. And I constantly ask, what can I do to turn this around to be profitable consistently? Like regularly, how can I get a strategy that I can truly sink my teeth into and become consistent and profitable with? And honestly, it's usually lacking the understanding of the basics. That's all it is. It's really that simple. It's lacking the understanding of the basics. For instance, when you got into a car for the very first time, right? Everything was new to you. You didn't know where the accelerator was, you didn't know where the clutch was, you didn't really know where the brake was. And then, when somebody took it the next level by saying, all right, when you want to bring your gear into first. You have to release the clutch and the brake at the same time. Meanwhile, you don't even know how to work the clutch and the brake, right? Today, when you hop in the car, it is such a basic movement. It's like turning on a blinker, right? Oh, by the way, you might not even know where the blinkers are, right? So these are the basics that we forget that we at one point learned. Now, I want you guys to imagine even more like a really much more, because get creative here. Imagine somebody got into your car, have never ever been in a car before, and you're telling them, all right, can you please buckle up? It's going to save your life. And they don't know what you are talking about. Buckle up. What are you talking about? Well, what am I buckling up? Right? So once you tell them it's right here, the seatbelt, everything changes. They are now confident in the car. So a lot of times we don't get these basics when we are learning to trade. And this was my own personal sad truth, right? First of all, I spent over $20,000 on different trainings, and yet I struggled for years because nobody ever talked about the basics. And every time I ask any sort of a question, hey, can you please explain to me, what do you mean by divergence? What do you mean by reversal patterns? What they would be, people would either be saying to me, well, you're supposed to like just know it, like I'm supposed to be born with this information, or the majority of the times I was completely ignored. And because of that, I was following what people were saying. I didn't understand what they were talking about, right? Just like how you were looking at the different charts before me, like with the different people talking about all these different movements. And you're probably wondering to yourself, I know I should know what they're talking about, but I really don't. Because if you're not learning how to do this, if you don't understand what you're looking at, you're not going to know what it is. And this happened to me, and I ended up losing over almost $4,000 in 5 minutes. And that's when I decided to quit. At this point, though, I was already trying to trade for 2 years. I was constantly losing. I wasn't understanding what was going on. And I quit. I ended up quitting, right? Because I just felt defeated. But here's the thing. We are all bit by the trading bug, right? All of us are bit by the trading bug, and it never stops itching. And I'll be honest with you, you know why that is? Mainly because we know deep down inside we can do this. We can do this, guys. That's the thing. And when I quit for about 4 months. I was still watching other people, and I'm saying to myself all the time, I'm like, if they could do this, so could I. What is the difference between me and them? And you know what it boiled down to? The basics, literally. So what I ended up doing was I cleared out my charts. First of all, I had like 10 indicators going on. I had 3 charts going on. I gave away 2 beautiful high definition monitors, removed all my indicators, and I started to study the basics. And I studied them for years. For years, I was learning the basics. And a few years back, one of my students says to me, no, Marina, your philosophy is really similar to Coach John Wooden. And I never heard of Coach John Wooden. So of course I went and checked him online. And this guy was a legendary coach, legendary. And his entire philosophy was, when in doubt, get back to the basics. And this guy, I mean, he has taken his basketball team to 10 NCAAs, 88 national championships. He trained with A-list players, but it didn't matter. When the season began, every season, he would go back to the basics. How to tie your shoe, how to dribble a ball, how to roll up your sock. Why? Because ego is going to tell you that you are the best. Meanwhile, you're going to forget to tie your shoe, get on the court, sprain your ankle, get a blister, whatever, and be sitting out, right? You don't want that. You need to have your basics in place. And once you have your basics, then you can do the real magic. So today I have for you guys, only for the participants here, because I don't offer this price to anyone else unless you are live. It is my introductory course, bootcamp for day trading, and you can do it on any apparatus. on laptop, desktop, tablets, phones, any of them. All of this is $97. $97. So before I continue, let's all go here to bootcampfordaytrading.com. You can put this into your navigator, into a URL, bootcampfordaytrading.com. This way you can follow along with me and you can see exactly what I will be talking about. So please go here right now, bootcampfordaytrading.com. bootcampfordaytrading.com. So what do you guys get for $97 today that could bring you a similar return on investment? Do you like to play golf? Because today, golf, I don't even think there's anything less than $197 per person, right? And that's for one day, and you just get a golf game. Or do you want to go out to lunch or dinner with your family? I don't know. Today, $97 barely covers the price of a meal for me and my husband, and maybe a glass of wine. That's the honest truth, right? So $97, what I'm offering here is 100x your investment. So let's break this down. What are you guys going to be getting with this? First of all, you're going to get the Simplifying Day Trading package, and you're going to get a 30-minute platform setup tutorial. Why? Because the tutorial, once you have it, you can go right into your trading. A lot of people have this issue with understanding how to set up their platforms, and then it takes them a really long time. They get discouraged. We get past that. So I help you. Since I've been doing this for so long, I pretty much know all of the platforms, and they're all very similar. And that's exactly what I help you with. Then we get into dissecting the markets, right? The market anatomy and understanding the trends and its movements, the upward trend, the sideways trend, which we really, really dive into, the downward trend, and understanding the reversals and divergences. Because once you guys have this down, then it just becomes really fun. All right. And we learn about the support and resistance areas. And I'm really going to talk about divergences. Divergences to me is my holy grail. The way I trade with divergences has changed my entire trading. And because of that, I'm able to take so many more profitable trades. And it's really simple once you know what you're looking for. And then you can put it all together and master the breakout trade. Because once you understand the breakout trade, first of all, you'll be able to spot them really easily. But the best part is you'll be able to stay out, fake out breakouts, right? I call it the phobos. You'll be able to avoid them entirely. And they happen a lot. But once you know what you're looking for, you can stay out as well. And that's the beauty of it, right? And you get access to the curriculum for life. All of this is valued at $1,600. You get all of this for $1,600 a value, right? But for you guys, it's at $97. So here's what some of my students have to say. And like I mentioned earlier, because day trading can be done anywhere in the world, this is the coolest thing of all, right? You could literally do it anywhere in the world. So here's Michelle, best money I ever spent. I just finished the boot camp. You are the only mentor that truly checks the work. Thank you so much. I am enjoying your boot camp every day. I am learning more and more. Hang on 1 second. I need some water. So I want to share something really, really important with you. Like I asked you before, how do you know you are doing it right? How do you know that you are doing it right? The thing is, you really don't. So what I am including in this 1 month is one-on-one mentorship with me. You get unlimited feedback, questions, we chat, chart, everything. One-on-one mentorship for 1 month with me. Because having a mentor can truly take you to that next level. And that is exactly what I will be doing with you guys. And on top of that, I have a live trade chat room where everything we are learning, we will be in the live market implementing together. So you can see how to apply everything that we are learning together. And it's me, it is not some moderator or some admin. It's me doing it. All of this is valued at $2,600. You guys get it for $97. Bootcampfordaytrading.com. So let's go here. Bootcampfordaytrading.com. So here is the order form. And you can see right here, there's that $197 payment. That's all. It's one time. If you want to do a payment plan, I have 2 times you can pay 59, but you automatically get access to absolutely everything. So this is right here, bootcamp for daytrading.com. Oops. Hang on a second here. Okay, bootcamp for day trading. So here's everything you get for $97. Everything in the course. 30 days, one-on-one unlimited mentorship with me, and the live chat room where you could sit in with the membership as well. This course is less than one price of a normal trade. I don't know about you guys. My normal trades are between $200 and $400. This is $97, and you could 10x your return on investment and go to 100 of these dinners and have a blast. I just want to say one thing though. Because of my mentorship, I can only take on a certain amount of students. So I'm just letting you know that because of my mentorship, I don't take on that many people. And I usually sell out pretty quickly, specifically because of the mentorship. So I'm just letting you know the sooner you get, the easier it is. And it's $97. Here is right here the order form. Guys, I know that you are sitting here because you're still probably losing. For $97, you will get an education that will definitely help you succeed, and you'll have me as your mentor. So I'm going to just leave it at that because it's kind of a no-brainer. So bootcamp for day trading. I hope to see you guys in the course. I am always available for all your questions, anything you need. And thank you so much, David, for having me here. And thank you, everybody, so much for taking your time to be here together with me today. Thank you. See you in the class.
All right. Thanks, Marina.
Thanks, everybody. Have a really great evening. Thanks, David.
All right. Yeah, thank you to Marina Viatora for being our 5th presenter today. Let me post her links there again. Everyone to check out. All right, so in case you did not hear this earlier, I am recording each of the presentations individually, and I'm working on getting these processed here behind the scenes while we're doing the event. Also, I am live streaming the event to YouTube, so it archives there instantly the full unedited day is being archived instantly to YouTube. So if you have to leave the Zoom room for any reason, you can still listen or watch live. And I see there are several people on YouTube listening right now, so welcome to them as well. So we have 4 more live presentations to go today, and Daniel Sinish is up next. Daniel, are you there?
Yes. Hey guys. How's it going?
Hey, Daniel. How are you?
What's up? Yes. Very good. Greeting from Montreal. How are you,
Oh,
David?
okay.
How's the event going
Good.
so far? Is
Oh,
everybody
it's
having
great.
fun? Yeah? Nice. Perfect.
We're having a
Great.
good week. So,
I hope I can keep the high momentum up.
yeah.
Perfect.
And yeah, also for anyone who didn't hear this, we do after today we do have a full day again tomorrow. Starting again at 10 a.m. Eastern time. So but now Daniel's gonna share some information with us.
Perfect.
So Daniel, you should be
Okay, let's go ahead. Okay, so I'm gonna go ahead and share my screen. There we go.
I can talk.
And you should be able to see my PowerPoint now to start.
Yeah, it's loading. Yeah, okay.
And then we're going to go over to the charts in just a bit. All right.
Okay.
Good. Good to go. Let's do it.
Yeah, I'm just double checking my setup. Everything looks good. So I'm going to start my recording again. and then you can start your presentation. So I am recording again now.
Perfect. Yeah, thanks, David. And welcome everyone also from my side to this very special event with David. And thanks, David, once again for inviting us. I don't know how many times we've been on your show, probably maybe 10 times already, maybe a bit less, but quite a few
yeah, I'd have to
times.
go back and count. Quite a few.
But it's always fun
Great
to
having you
be
here.
here. It's always a great event, great speakers every day, and great education for everyone. So thanks, David, for putting this together once again. All right, so what I'm going to talk about today is something I haven't talked about yet. It's the first time I'm going to give away something that's very special to me and dear to my heart. It is my market edge, the market edge, which I am using every single day in my own trading. Not just for day trading, even though the focus of today's talk will be on day trading, but also for longer term trading. It's so special to me because it works for everything. It works for the shorter time frames, it works for the longer time frames, and even for the really, really long time frames. And what this market edge is, I'm going to share it with you for the very first time today at this event that David has put together. So look no further, let's get started. Now, as mentioned today, I will share with you my trading edge and for the scope of this presentation, my day trading edge. Now, let me go back a little bit before I reveal what I have in store for you. Back in the day, when I first started off trading, that's many, many years ago, I thought trading should be something like this. So this is from a YouTube video I saw on YouTube, called Day Trading Insanity. And there's actually a friend of mine, it's Stephen Kalajian, and this is his setup. And it looks a bit like insanity. Would you agree with me? Look at all the screens here, trying to track every single thing of the markets using multiple time frames, multiple screens, various indicators on it. And I thought back in the day, hey, this is how day trading needs to be like. This is what I need to replicate to become a successful day trader. So I went through all the equipment or steps that I needed to do. So I bought all these screens. I tried to put together all the setups. I had multiple charts open, and then I tried to make sense of it. And guess what? I was completely overwhelmed. This may work for Stephen here, but it did not work for me. It's extremely complex. You probably would agree with me. It's extremely expensive. Imagine buying all these screens, putting them all together, making them all work together, maintaining them. That's extremely expensive. And to me, worst of all, it's absolutely not portable. Imagine traveling and bringing your equipment with you. Well, good luck with this kind of setup. So this did not work for me. And I stepped away from day trading for a while. But I came back. And I came back for one reason. I have found a revelation I'm going to share it with you today, which helped me to transform my trading completely from something like this to something like this. Because now when I day trade, all I need is my laptop, one screen, and one chart and two indicators. That's all I need for my trading. So what these two indicators are, what my setup is, and what the market edge is that I have discovered, I'm going to share with you today. Now, before we get into all of this, a quick introduction of who I am. You may ask, hey, who's this guy talking about a market edge and transforming trading and sharing secrets? Well, my name is Daniel Sinek, as you can see here on the right-hand side, and I'm one of the founders of TradingIndicators.com. So we've been in the business for many, many years. And over the years, we have specialized on creating innovative trading indicators, as our name may suggest. We have clients all over the world, in the US, in Canada, where we are headquarters, in Europe and Germany, where I am originally from, really all over the world. And over the years, we've built more than 1,000 trading indicators for all major platforms, for TradingView, which I'm going to be using today, for NinjaTrader, Thinkorswim, ModifWave, MetaStock, MetaTrader, TradeStation, and so forth. So we've seen it all, and the good, the bad, and the ugly. Now, but perhaps what is maybe a bit special, which makes us stand out a bit from perhaps the other speakers in this conference, and of course I can't speak for the others, but what we think is our edge is that my background originally is not in finance. It's not in trading. In fact, For the longest time in my professional career, I wanted to become a professor in software engineering. I loved research and I really liked the domain. So that was my career objective. So I went through all the levels. I did my master's, I did my PhD, I did my postdoc. I started doing research and started to teach at various universities in and around Montreal, which is where we're headquartered. But you know what? In all these years, I was also fascinated by the world of trading. So I decided, hey, let's start trading on the side. And perhaps this sounds familiar with some of you. You know, you have a regular job, but you want to perhaps supplement your income on the side. So I had the same idea many, many years ago. So I started trading on the side. But I quickly realized, oh boy, trading is not as straightforward as I thought. Because I tend to make all kinds of mistakes. I overtraded. I took too many trades. I took too much risk because my position size was way too big. I revenge traded because I didn't have my emotions in check. And after donating quite a bit of money to the markets, I came to the hard realization, oh boy, trading is not as straightforward and I need help. And for me, as a software engineer, needing help meant I need better tools, better indicators, which will help me make better trading decisions. So I rolled up my sleeves and I started coding. And the very first indicators which I have ever written were exclusively for my own purpose. But once I realized, these are actually helping me. These are actually helping me making better trading decisions. I thought perhaps others could benefit from these indicators as well. And this is really how the story and the history behind TradingIndicators.com started. Now, this was 10 years ago. We've come a long way since those initial indicators. What I'm going to show you today are two of our flagship indicators. Two indicators which are on every single chart I open, no exception. It could be for day trading, it could be for swing trading, it doesn't matter. On every single chart, these indicators will be there because they've become so essential for my trading. And what these two indicators are, I'm going to show you in a second. Now, a quick reminder. Of course, when you trade FX, futures, stocks, and so forth, keep in mind that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you can actually afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and setups discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so with this out of the way, let me share with you what my market edge is. Now, before we get to the market edge, I need to do a bit of theory, about 5 minutes. I promise, very short, very brief, but it's important to see where I am coming from and what the foundation of all these things I'm going to use today. So landmarks on every chart, that's about the theory. Then I'm going to discuss my market edge. I'm going to reveal the trade setup, which I trade every single day. I've traded today, I've traded yesterday, I've traded last week, last month for swing trading and day trading alike. Then I'm going to introduce the two indicators which will help me identify this market edge. Then we're going to look at charts, many different examples, and of course, at the end, there will be time for Q&A as well. But let's start easy. Let's ease into the topic. And by the way, guys, if you do have questions, don't be shy. Put your questions into the Q&A box or the chat box in your Zoom tool or your YouTube comment section. I'll be happy to address those questions as I proceed with this presentation. Now, landmarks on every chart. So what we have, what everybody probably has suffered from. I'm sure you've done it. I've done it. Everybody's done it. Let's face it. Charts, when viewed with the naked eye, without any help, they tend to be quite unpredictable, even chaotic, one may say. You can see it here on this chart where an uptrend is quickly reversing into a downtrend, only then to reverse once again into an uptrend. Seemingly no pattern on this chart, which could help us forecast what may happen in the future. It's completely erratic. And to make matters worse, as a day trader, things tend to be even worse. Look at this 5-minute chart here. Down, up, down, up, down, up, sideways, down again. Boy, who can predict what may happen in the future? It seems impossible, honestly, especially as a day trader. But, and here's our first revelation and your first takeaway. Once we zoom out, once we go to higher time frames, let's say we go from the 5-minute time frame here on the left-hand side to, let's say, the 50-minute time frame, the 1-hour time frame, or even the 4-hour time frame, things tend to become a bit clearer, a bit less chaotic, a bit more systematic. Contrast these two charts. It's the exact same symbol, just viewed from a bigger lens. Things tend to become a bit more clearer, a bit more structured. You probably would agree with this. So this is our first revelation. And what we'll show you today will take advantage of this observation, that things tend to become a bit clearer on higher time frames. All right. Now, but back to our landmarks idea. So we discovered, and this was about 3-4 years ago, that every single chart, it doesn't matter what it is. It could be a 5-minute chart, it could be a 1-hour chart, a daily chart, it could be a stock chart, a futures chart, an FX chart, a crypto chart. It really doesn't matter what it is. Every single chart has certain levels of price, certain landmarks of price, to which price will react in the future in a certain way. And the key word here is in the future. Because let's face it, in trading, it's all about forecasting where and when price may be in the future. The history doesn't matter so much. We need to be able to predict how price will react to certain levels in the future. And if we are able to find these landmarks on the chart, then we might be able to make these predictions about the future once price approaches these landmarks. And this is exactly where my market edge takes place. Now, I know this sounds very theoretical right now. It's going to become very practical in just a bit, so please bear with me. One more thing. Now, let's have a quick discussion of what may create these landmarks. What kind of events may create these special areas of price which have future relevant properties to which price may react in the future in a certain way. One example, and this is oversimplified, but just to give you the idea, one example of such an event which happened in the past, but which has a relevant going into the future could be an historical high. Like this high point here, price came all the way up. This might be an all-time high. And then, so you can see it here, our price went down, and perhaps many months, maybe years later, we don't have a time frame on here, many years later, price comes back towards this level, which was created a long time ago. It comes to it like a magnet and then bounces off this level towards lower price levels. You can see it here. All right. So there's something about this landmark, about this event here, which has this, a relevance going into the future. Here another example. Look at this series of swing lows. The price came down, swung up again, came down, swung up, came down, swung up over and over again. And then later on, in the future, look what happened. Price came back to this level, couldn't penetrate to the downside, and bounced off this level towards higher price levels. Once again, an event which happened in the past, but which has relevance moving into the future. And this is really important in trading because, we want to focus on these events which have the potential of having an effect in the future. Because once again, trading is about forecasting what may happen in the future with price. All right, so real quick, 2 more minutes about theory. What are these landmarks? And I'm sure in your trading career, in your trading journey, you have came across them. I guarantee you, because they have different names. I just called them landmarks, but they may be called support levels or resistance levels or liquidity levels. They may have different names. Different names for the same concept. Now, who is responsible of this behavior? Because it may sound like magic. Certain levels of price which have an relevance into the future. Why is this happening? Well, who's responsible for this? Well, I'll tell you one thing. It's not us retail traders or the small traders that we are. No, we don't have the buying power to do these kind of market swings and to influence and change the market in this way. The parties who have this power are the big ones, the culprits, the big money traders, the institutions, the ones that have the buying power to move the market in the way. But you know what? While the big guys, they're calling the shots, what we can do as retail traders, we can follow the patterns and profit in the process. But of course, this entire system works or fails if we can spot these levels, these landmarks in a reliable fashion. And we have spent years of research on optimization and trial and error to come up with a system which allows us to spot these levels of price which have forward-looking properties, to which price may react in the future in a certain way. All right, so this was the theory part. Now let's see what is my market edge based on this concept. I'm going to share this with you. I haven't shared this before in the presentation. For the first time, what is my market edge that I'm trading every single day? I traded it today. I traded it yesterday. I traded it last week, last month, last year, and so forth. So this is my go-to market edge. I have most of my trading setup centered around this particular setup. All right, and best of all, this works for day trading. Today's focus will be on day trading, but it works also for swing trading. And of course, like every good setup, it works for the long direction and for the short direction equally. Now, let's start with the long direction. And I call this setup, by the way, the power bounce setup. That's a funny name. Name is not so important. What's important is what are the constituents? What are the ingredients of this setup? So what do we see on this chart here? And once again, you may say, hey, this looks kind of chaotic, but there is a system, a logic to this madness. What is this? So let's have a look what's happening here. So, and let's focus on this area of the chart here for now. So price is coming down. You can see it here. It's coming down, 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 and it's coming down towards this red line here. And this red line has been identified by one of our indicators on the chart. It happens to be, in this case, a support level. So price is coming down to support. And, you know, support is named support for a reason. Sometimes it may prevent price from moving further down. It's supporting price. Price will find a bottom here, and instead price will bounce. That's where the name comes from. Bounce off this level towards higher price levels. And guess what? Price approaching a support level is ingredient number one for my special setup, the one I'm trading all the time for this long power bounce setup. Ingredient number one. And you may say, hey, Daniel, that's pretty obvious. Price is coming down to support. What's the big secret here? Well, I'll let you know. Ingredient number two for my power bounce setup is what you can see here a little bit on the chart, is this little shaded area. I'm not sure if you can see it clearly on the screen share, but it's there. Do you see this little shaded area here? And it's here and also here. These are special events which may happen. Sometimes they don't happen, and oftentimes they don't happen, but which may happen when price approaches a key level. And these events are triggered when price is close to a key level, in this case, a support level. It didn't completely penetrate it. You can see it here, this candle, which this red candle here came into the level, couldn't completely penetrate it or break it. And this candle, and that's the kicker, this candle has abnormally high volume. And this is important, because oftentimes an increase in volume can be a sign that other traders might be interested in this price level as well. Perhaps other traders will see this as a good opportunity, potentially to also enter into a potential long trade. This is a bullish setup. We call this event a liquidity capture event. And in our books, in our view, and in our experience, this event will increase the chance of having a bounce of this level rather than a break below the level. In this case, we're looking for a bounce, a bullish bounce. This is ingredient number two. And ingredient number three, that perhaps is the most obvious one, but it's still important to consider it. It's what you see here. This label here, bull. What is the overarching trend? In this case, the overarching trend is bullish. And in my trading, I always want to trade with the trend than against the trend. I want to trade with the trend. In this case, I would be looking for bullish setups. The trend is your friend. The chances that a trend will resume are simply higher than the chances that a trend will reverse. Now, I want to take advantage of this market axiom. So what is coming together here? Three things, in fact. Price is coming down to support. We have this liquidity capture event. I'm going to expand on this concept a bit later in this presentation, which increases the chance of having a bounce rather than a break. And we are trading with the trend. The trend is bullish to begin with. Three things are coming together predicting the same future price move, which is a bullish move. In trading, this is called confluence. This is my market edge for long trades. And of course, the same thing works also for short trades. How would this work? So let's check it out. I'm going to switch over my slide now. And now let's have a quick look at the bearish case. So perhaps you can spot it already. Where is it? Perhaps let's have a look at this chart. What are these three ingredients? Well, let's have a look. So here, price is coming up, and approaching this green level here. Do you see this green line here? This green line is a resistance level. And once again, resistance is named resistance for a reason. It may prevent price from moving further up, and instead price may bounce off this level towards lower price levels. And once again, this is called the power bounce setup. And we're trying to bounce off something. In this case, for the bearish case, we're trying to bounce off a resistance level. All right, ingredient number one, price approaches resistance. Ingredient number two, this little shaded area here. See this one here? Shaded area. Once again, you may remember the name, a liquidity capture event. And the candle approaches resistance, it approaches a key level, it cannot fully or cannot penetrate it, and it has abnormally high volume. Once again, in our view, because there are no guarantees in trading, but that's our edge. In our view, this increases the chance of having a bounce off this level rather than a break above the level. Of course, here what we want is a bounce off the level. This is a bearish setup. We want to bounce off this level towards lower price levels. And ingredient number three, who can spot it on the chart? It's this one here. Bearish trend. We are bearish trending. Does this bearish trend support the setup? Of course it does. The trend is your friend. Once again, the idea is the chances are that the chances are greater that the trend will continue. In this case, the bearish trend will continue down rather than the trend reversing. So once again, three things are coming together. Price is coming close to resistance. There is a liquidity capture event, and the trend is bearish. This is our bearish power bounce setup. And as I mentioned before, a setup which I trade day in and day out every single day. This is my market edge. All right. Now, you may say, okay, great, Daniel. Thanks for sharing this great market edge, but, show me some examples, some real examples, not just these small snippets. Well, I will. Let's do it. This is from yesterday. I didn't have time to put these slides together for today's setup. Also today, the market conditions were a bit more interesting to say. It was very trendy today, the entire market. But from yesterday's trading, here is what this setup gave me. Micro natural gas, and this is for day trading. So all the examples I'm going to give you right now are from the day trading space. But in case you're a longer term trader, these will work exactly the same way for longer time frames. So if you're a swing trader or perhaps a longer term investor, no problem. You can use these setups on the bigger time frames as well, on the daily time frame, on the 4-hour time frame, or whatever this may be. But these are smaller time frames here for day trading. So micro natural gas. And by the way, guys, as you'll see, I am quite adventurous in the futures contracts that I'm trading for day trading. So it's not just the MNQ, like the NASDAQ futures, or the E-mini futures, like the standard ones, or gold or crude oil. No, I trade basically every single liquid futures contract. And there's a reason for this, because this setup, the bearish power bounce and the bullish power bounce, these two setups, these are quite rare. They don't happen every 5 minutes. You have to wait for things coming together. You have to wait for the stars basically aligning to come together, and then you execute. Now you want to be very selective in your trading. And this is why I like to be, very open to what I trade. And you can see it here, micro natural gas. And natural gas is commonly referred to as the widow maker. It's so erratic. But for me, it's not, because I have my indicators. I want to talk about these indicators in a second to help me make sense of it. So what do we see here? I actually traded this yesterday. Price came down to this key support level. The overarching trend was bullish. You can't see it here, but you can take my word for it. It was bullish. You can see price moving up here. And we had a liquidity capture event. Beautiful bounce off this level. Winner. Another trade from yesterday. Micro silver. That's a setup which is a bit more symbol, which is a bit more, I guess, ordinary, so to say. Beautiful trade. Beck, who can spot it? This is from yesterday. Bullish trend. Trust me on this. It is bullish. You just can't see the label here because it dates further back. Price came down to support and the shaded area here, a liquidity capture event. And look at this huge bounce that we got. Beautiful. Another example. Micro Ethereum. I told you, I don't discriminate. I trade all liquid futures. So Ethereum is reasonably liquid. Tough word, but this trading approach is not tough. Where do we see, who can spot the setup? And for me, it's obvious where it is. Of course, also I've traded this, but who can spot the setup here? First of all, let me ask you guys, if you look at a chart like this, do you think I'll be looking for short setups or for long setups? What do you think the overarching trend is? Well, it's a bit hard to see because the label is not here. It's further back. But I'll give you a hint. The overarching trend is bullish. So what kind of setup would I be looking for here on this chart? A long setup. Where do we see long setups here? Well, when price comes down to support somewhere. We need to find support somewhere. Yeah, exactly here. So bullish trend, price came down to support and the shaded area, a liquidity capture event. And look at this beautiful bounce yesterday on the 1 minute chart on Ethereum. Yes, I'm also quite, adventurous, if you want to use that word, for my time frame. I trade off the 1 minute time frame, the 5 minute time frame, and the 15-minute time frame when it comes to day trading. In fact, I have set up alerts and my charts on all 3 time frames. I'll talk about my trading process in a bit because you'll see it's very convenient for everyone who has another activity to do during the day, who doesn't have the luxury to stare at charts all day long. You're going to get to this in a bit. Okay, another example. Now it gets really exotic. Wheat futures. What do we see here? Well, here it's a bit harder to spot, but once again, you have to take my word for it. The trend was still bullish when price came down here to this red line. Okay, price came down there to this red line. I took the trade, a long trade off this red line, and wheat futures are quite expensive. This was a fairly big trade. We saw a bounce off this level, and then it went further down. But here's another kicker. If you, this is where a bit of subjectivity comes in. If you feel, okay, perhaps the momentum is about to change. So we were in an uptrend. It didn't change yet as per our indicator. We were still in an uptrend, but you can see things are coming down fairly quickly here. Perhaps the momentum may change. I use this as another kind of subjective ingredient to my trading, and I will put my profit target a bit closer if that's the case. So in this case, you can see it here. I just took the small little bounce here, and I was quickly out of this trade. There and there. Done. Took a bit of money out of the market to be conservative. Why? Because I felt, hey, the momentum is about to change. You can see it here, rightfully so. Later on, we broke below this level towards lower price levels. But let me show you one more thing. And this is really where something is, it's just so magical. So do you see this little shaded area here? And we saw this bounce here. This is our liquidity capture event. Price went up a little bit afterwards. Then price came down once again down to this red line here, this support level. Do you see this shaded area? This big box here is not the same thing, that's something else. Do you see this shaded area here? No, you don't see it. It's not there. And this is why I was not surprised to see a break of the level here. Because I personally, most of the time, of course, sometimes I'm a human being, I make exceptions, but most of the time, I patiently wait for this liquidity capture event to arise because I want to trade when everything is lining up. And here it didn't show up, and we had a break of the level. All right. And one more example, corn futures, also an exotic one. What happened here? Bullish trend, take my word for it. We came down to this red line here, a bunch of liquidity capture events. You can see all these shade areas here, and a beautiful bounce of it. In fact, this trade actually went up all the way to here. Would have been a massive trade. I closed it out way too early. I was a bit annoyed by this yesterday, but a huge trade. You can see it right there. All right. So these were some examples. All of these from yesterday, May 5th. I traded them yesterday. Well, it was an amazing day. Yeah. And it says here long power bounce. You can see it here. This brings me to the second thing I wanted to talk about today. The entire system works or fails if we can identify these levels reliably. If these levels are at different spots, the entire thing will not work anymore. We need to be able to find these levels reliably exactly where they're supposed to be. And we have spent years of research, trial and error, optimization, and putting our money where our mouth is, trading with these indicators to refine this approach. And we have come up with 2 indicators which will allow you to do exactly this. All it takes are 2 indicators on your chart. And as I mentioned in the very beginning, these are the only 2 indicators which are on every single chart I open. Could be a day trading chart, could be a futures chart, a stock chart, it could be an FX chart, a crypto chart, a swing trading chart, a daily chart, it doesn't matter. These 2 indicators are on every single chart because they allow me to identify exactly this market edge. Now, for the very first time, what are these indicators? Well, indicator number 1 is called, and don't get stuck by the names, indicator number 1 is called liquidity IQ. An indicator designed to find these key levels on your chart. I just mentioned to you, knowing where these levels are is the number 1 ingredient for everything in my trading. I cannot trade without having knowledge about these levels. Because these levels, in my view, oftentimes have forward-looking properties. They have relevance for going into the future. Price may react to these levels in the future. And this is my market edge. So I need to know where these levels are. And this is where this indicator comes in. It's called liquidity IQ. The reason why we called it liquidity IQ is because it finds these levels, and we call these levels internally liquidity levels. I'm going to expand on this a bit later, what that means. So liquidity IQ for finding these levels. It will also find you these liquidity capture events. Look at this one here, this little label, the shaded area. That's what the indicator does. It will find you these liquidity capture events as well. So we know where the levels are. And secondly, we have knowledge of when these events occur. That's ingredient number 1 and ingredient number 2 for the market edge setup, for the long bounce setup. And what's the third one? Who remembers? The trend. Yeah, we need to know where the trend is. Is it bearish or is it bullish? And this is where this indicator comes in. It's called MA Rush. Once again, the name is not so important. This is how we call it historically speaking. MA Rush for identifying what is the prevailing trend direction. Are we currently bearish or are we currently bullish? And then my approach, I want to trade with the trend. I don't want to trade against the trend. The trend is your friend. This indicator allows me to identify what is the prevailing trend direction. Is it bearish or is it bullish? All right. Now, with this, let me switch over to the chart. I have some additional information about these 2 indicators in a second. Let's go to the chart. Let's check out how these 2 indicators work. So I'm switching over to TradingView. And by the way, not sure if I mentioned this before, but if there are any questions, guys, please, let me know, or symbol requests. We can check those out. So switching over to the chart, I'm going to start with Bitcoin futures. And what you see here, I'm going to ease you into this a little bit. I'm going to hide one of these indicators here. The first thing we're going to see is our liquidity IQ indicator. This is a 1-minute chart, by the way, a very small time frame. And you can see here, okay, the indicator finds you these levels on the chart. These red levels here, these are support levels, and these greenish ones are resistance levels. All right, so you can see all these. You can also see these little shaded areas. Look what it says here, liquidity capture. Liquidity capture, these shaded areas here, these ones here. So as mentioned before, this indicator is designed to find you exactly this. And by the way, one thing we also have with this indicator, something called mentor mode. But for those of you who are using these indicators for the very first time, it will annotate exactly what's happening on the chart. Just give it 1 second to reload. And once mentor mode is enabled, you can see you can get all these cool labels here on your chart, helping you to make sense of it, especially when you just start using this indicator. I'm going to take this off at this mentor mode, but it's available. You can see that's a resistance level up here, liquidity capture event here, and so forth. So I'm going to switch it off just to keep it clean. So I prefer to have a clean chart, which doesn't overwhelm me. Okay, so mentor mode off. Okay, So that's the first indicator. I mean, we can already see some pretty cool reactions of price when price comes close to these levels. But let's push it one step further. Let's have a look at our trend indicator. It's called MA Rush. So I unhide this one here. And you can see here, this is a 1 minute chart, by the way. I'm just going to hide the other one. What this indicator does. It will show you, hey, are we currently bearish or bullish? Right now, Bitcoin on the 1 minute time frame. This is a very small time frame. We went bearish. We went bearish here at 12 o'clock, 12:30 New York time. And you can see price nicely came down afterwards. And we actually have some users, I have some examples later on of this as well, who exclusively trade in a stop and reverse fashion according to these labels here. You can see, they work quite nicely. Bullish, bearish. I'm going to go back here. Bullish, you stay in the trend, bullish all the way until, you get a bearish signal, then you reverse. It goes down, somewhat sideways here. Then bullish again, beautiful move up, now bearish again. That's possible. That's not how I trade, but we have some traders in our group who just use these labels. They just like to simplify things quite a bit. Okay, but now let's put both things together. So we have now our trend indicator and we have our levels indicator, liquidity IQ. So what do we see? I'm going to start here. What do we see here? Let's start here. Yesterday evening, trend went bearish. You can see it here by this bearish label here. And from this, once I see a bearish label, in fact, in my head, there's only one possible trade happening right now. Because we are bearish, the momentum is bearish. What is the only possible trade I could now have in my mind? Well, it's a bearish trade, a bearish bounce trade. Okay, so I'm waiting for this. Okay, I'm waiting. Price comes down here to this red line. Potentially a bounce to the upside, but would I consider this? We're coming down to support. No, I would not, because we would go against the trend. I'm pacing myself. I'm being patient. I'm sitting on my hands. I wait and wait and wait. And what happens then? Price eventually comes close to this green line here, a resistance level. We also have a liquidity capture event. Ooh, interesting. So now our setup has come together. Bearish trend, we're coming close to resistance, and a liquidity capture event. These are the 3 ingredients of my bearish bounce setup. And look how beautiful this would have worked out. Okay, let's continue. All right, price comes down again. We are nowhere near level. I'm sitting on my hands. No problem. I told you this setup is quite rare. So you have to have some patience with this one here. But if you trade like me, every single liquid futures contract that's available, you will have setups every single day, probably 20 of them every day. That's plenty for day trading. You should actually be more selective than this even. But nonetheless, let's continue. So price eventually went bullish. What is my prevailing setup once the trend goes bullish? Well, the answer is easy. Only long setups. Okay, so price comes up here to this resistance level. Would I short it here? No, I don't want to short it when I go against the trend. I skip it for good reason. Price powers to this level here, goes up, goes all the way down, and then it approaches here this support level with a liquidity capture event. Look at this beautiful bounce afterwards. All right? Now price comes up again. It goes to this support level here, but we're still bullish. Actually, would have skipped this trade here. I didn't trade it. This nice bounce trade. It would have worked out, but it's not according to my market edge. I'm skipping these trades, and I don't feel bad about this. That's just how it is. Now we're bearish again. You can see it here. We're coming down to this support level. Would I play it to the long side here? Probably not. Actually, no, definitely not. Not according to my market edge. Sometimes, I don't have the willpower to wait for it. I'm also just a human being. But according to my market edge, and sometimes I just want to also force trades, which is not a good habit. According to my market edge, I should not take a long trade here. And the conditions for a long setup here are not satisfied. The only condition which is satisfied, in fact, right now, is that we're close to the support level, this reddish area here. That's the only condition that is satisfied. We don't see a liquidity capture event, at least not yet, and our overarching trend is bearish. It doesn't support a bounce to the upside. All right. Okay. Now, I need to show you one more thing, because actually, And this indicator seems simplistic, what you see on the chart here, but it's actually highly sophisticated. Remember, in the beginning, when I said things tend to become a bit clearer once we zoom out, once we go to the higher time frames, this indicator does exactly this. It will identify these key levels based on the series of higher time frames. By default, depending on what your chart time frame is. So in this case, we are on the 1 minute time frame. The indicator will know this. Hey, we are on the 1 minute time frame. It will then go to the 5 minute time frame, the 50-minute time frame, and higher to identify these levels. But we thought, hey, maybe we can even push it one step further. That's something you can enable depending on your preference. What if you could push this one step further? What if you could tell the indicator, hey, indicator, instead of thinking, hey, let's start with the 1 minute time frame to find our higher time frames, what if you tell the indicator, hey, start, let's say, with the 50-minute time frame as your base reference time frame, and then do your analysis and see what happens now. Once the indicator finishes calculating, all these levels are going to be different. Now, bang. Now it's updated. And now what you see on the chart are the levels as if we had applied this indicator on the 50-minute time frame, even though we're still on the 1 minute time frame. Do you see how cool this is? This has eliminated the need for having multiple charts open, because I can simply tell my indicator, hey, I want to trade off the 1 minute time frame, but get your levels from a much higher time frame, starting with the 50-minute time frame. We have a whole boot camp on this. So if this goes fast, don't worry. There's a boot camp coming. We have a boot camp on this in case you are interested. Let me switch this back to the chart time frame, just to keep it simple. All right, there we go. Okay, so let's switch it up a little bit. Let's go to another symbol. And today, I should tell you, the markets were a bit interesting. We didn't get many setups. We got a handful, but not as many as I thought. Let's have a look at Canadian dollar futures. Let's be adventurous. 6C. I'm not sure if anyone of you has traded this futures contract yet, but I trade everything as long as the setup is valid. What do we see here? Let's have a look. Okay, because this shows a bit of a variance. And variance are important in trading too. And in the end, it's all about making sense of looking at the markets and the levels of a logical mindset. So what do we see? And let's only focus on the most recent price action. So price became bearish here around 8 o'clock, 7:45 New York time. You can see it here. We were bearish. Price came down here to this green level here. Would we play this one to the upside, even though we had a liquidity capture event? No, we would not. Bearish goes against it. We break the level. Price comes below, but then look what happens. Price comes up to the level. We're bearish, and we have a liquidity capture event. Beautiful. We could short it, and we had a nice follow through afterwards. Okay, we short this trade. We probably booked our profits. Let's see what happens next. Price comes down further and further. Now comes down to this red line here with a liquidity capture event. Would I have played to the long side here? I personally would not have, under most circumstances, because not all ingredients are coming together. Once again, trying to bounce off here to the upside, but the overarching trend is bearish. Eventually, we break the level. We go below support here. And this is what I wanted to mention. We come below support, and then we're coming back up here. And maybe you've heard this before. Support can become resistance when one thing happens. Support can become resistance when it is broken. And this is exactly what happened here. This support level, this reddish line here, is broken here at 12 o'clock at noon today. To the downside, price initially goes down, but then comes up again. And where does it stop? Almost to the cent, exactly at this red line here, and then it continues further down. And this was possible because this support level now is acting as resistance. Preventing price from going further up, and price bounces off this resistance level, formerly support, to the downside. Once again, a nice setup, especially if the overarching trend is bearish. Okay, moving on. What else do we have? Let's move on the line here. 6L. Okay, I'm pretty sure very few of you have heard about this contract. Brazilian Real Futures. And this is just an exception. I'm going to go to a higher time frame here. Actually, let me open this here on the 5-minute time frame. 6L, just to show you that sometimes, it makes sense to wait for some, or to be experimental a little bit. What do we see here? Let me go here. Okay. Okay, so let's check out what do we see here. Okay. All right, let's start here. Bearish trend. We're coming down to support. I probably would have skipped this trade here because we're bearish at the same time. Not everything comes up. Then up to resistance here. A bunch of liquidity captures in a bearish trend. Beautiful bounce to the downside. Eventually, the trend changes to bullish. We're coming up here to resistance. Would I short it here? No, I would not. Once again, not everything is coming together. Trend is bullish. I don't want to short. I'm staying in this trade and see price retraces back to this level, bounces off it, and then here, once again, we're coming down to this red level here with a liquidity capture event within a bullish trend. That's a long trade with a nice follow through afterwards. Yeah, this works on every single symbol. Let's go a bit more mainstream. Gold. Gold on the 5-minute time frame. MGC. What do we see here? Okay. Now, here is something, here's something where a bit of nuance comes in. And we're teaching you this in our trading room. Okay, what's the nuance here? Let's just look at the recent price action here on gold on the 5-minute time frame. We are bullish. The trend is bullish. We're coming up to this resistance level. We even have a liquidity capture event. Would I short it? Nope, there's no way. I don't go against the trend. One of my ground rules. Okay, all good. Price eventually breaks this level. And once we, you see our education material, even a zone break by itself is somewhat tradable as well to the long direction. But we don't talk about this today. So we break the level here. Price initially comes up. In this case, resistance is broken. Price initially goes up, then holds back, then corrects down. And where does it stop? Almost to the T, to the cent. Do you see it here? This wick here? It stops exactly at this former resistance level, which, however, is now acting as, you may guess it, it's acting as support. And this is exactly what's happening here. This is tradable. We don't have a liquidity capture event here, which is missing in the perfect setup. But sometimes I told you, I trade the nuances as well. So overarching trend is bullish. We're coming down to a former resistance level now acting as support, and price bounces off beautifully off the setup to the long side. And one more example, soy beans futures on the 5-minute, actually on the 1-minute time frame. Give me 1 second here. Something I saw earlier today. Another example of exactly what you saw right now. Let's have a look once this loads. Here. Yeah. Okay, a little bit back here. This is the 1-minute time frame. I told you I trade this on all kinds of time frames, and I'm going to explain to you in a second how I find these setups, because I don't stare at charts all the time. I don't have time for this. I have other things to do, but I'm going to show you in a second how this works. Bearish trend. Price comes down to the support level. Do I go long here? Nope. Skipping it. I don't go against the trend. We eventually break the level. You can see it here. Breaking support. Price initially goes down. This is tradable, but we don't talk about this today. Price then goes up. And where does it stop? Once again, almost to the T, exactly at this level here. Nice follow through afterwards. Price comes again up to this broken support level, now acting as resistance, bounces again, comes up again, and bounces again. It's like magic sometimes. And you probably can see now why these two indicators are indispensable for my trading. Now, I'm going to get to your chart requests in just a bit, but I need to tell you first how you guys can take advantage of a very special offer. And you see, this is going to be, you may say, hey, Daniel, are you crazy? Why are you making such an offer for these two amazing indicators? You'll see in a second why, because I want to say thank you for being here today, and also thanks for David for putting all these events together. So let me go to my slides just for 1 second. So what have we seen so far? We have seen our liquidity IQ indicator. We call the charting assistant, because it does most of the technical analysis that you would normally do manually automatically for you. And of course, it specializes in identifying these key levels on the chart, key resistance levels and key support levels, along with these liquidity capture events. All right. So that's indicator number 1, liquidity IQ. Indispensable for us. Indicator number 2 is MA rush, which prints these bearish and bullish labels on your chart, basically telling you what is the prevailing trend direction. Are we currently bearish or are we currently bullish? And as I mentioned before, I personally only trade with the trend. I don't want to go against the trend. But the beautiful thing is, even identifying what is the current trend direction, that can be quite subjective, especially if you're emotionally involved. You may say, hey, Danny, this kind of looks still bullish to me, even though it's bearish. Let's take a long trade anyways, even though we're bearish. That's subjective. This indicator will take out all the subjectivity of your trading because it tells you black and white, or white on red and black on green, what is the prevailing trend direction. No questions, no second guessing. It's right there. It's clear. Yeah. All right. So these are the 2 indicators. Now, I should mention that these indicators, I mentioned this before, I see these charting requests coming in, so don't worry, we're going to get there. These 2 indicators have completely transformed the way I trade. I'm going to show you once again where I came from. I came from this, from Steven here, Steven Kalajian. He's a friend of mine. I programmed back in the day some of these indicators he has on the chart. He knows me very well. This is how he trades. Maybe it's also his responsibility why I wanted to start off like this when I first started off day trading. I wanted to replicate the setup. It didn't work for me for various reasons. Too complicated, too complex, too expensive, not portable. Now, with these 2 indicators I've shown you, this is how I trade. It's a difference of night and day, from this to this. And this was possible by having these 2 indicators on the chart, which will help me do actually do most of the heavy lifting in the background. Now, before I get to the special offer and the chart request, here is how I trade now. And I make it very simple. I like my life to be simple. I don't like to stare at charts all day long. It's, I believe, counterintuitive. You get, kind of messed up in your head because you're trying to see things. You're starting to see things if you stare at charts all the time. I don't want to stare at charts all the time. How is that possible? How can I still spot these setups? Well, the answer to this is in the number 1 step here. I set up alerts, which will notify me when something happens. And once I get notified, I open up the chart. And if I like what I see, I always like to double check with my own eyes what I see. Then I take the trade. So how does this work on TradingView? And this works for all major platforms, but on TradingView, it's super simple. So what you can do in TradingView is you can simply define your alerts, for example, for, let's say, a liquidity capture event, all these events which you saw on the chart, like these shaded areas. This chart doesn't have one, but you get the point. 1 second. Oh, this is a special chart. Let me go to Bitcoin here, where we had some of these events previously. Just 1 second. Until the indicator loads. Just give me 1 second. There we go. Okay. Yeah, these events here, liquidity capture events, which only can happen near support or near resistance. I want to get notified when these events are happening. That's my alert mechanism. If you go to my alerts here in TradingView, you can see all the alerts I've defined. These are power bounce alerts based on what I've told you. So I get my alert. Once something is triggered, they will show up here in my alert history. And you can see there are a bunch of alerts coming in every single day. So not too many of those on the mainstream futures today, even though we had this Dow Jones futures alert. We're going to check this out in a second. But this is what I do. The alert comes in. I click on it. I check out the chart. We can maybe check out this chart here on the 50-minute time frame. Just 1 second. On the Dow, resistance liquidity capture. Let's check it out. What do we see here? Give it a second. So I get this alert on Dow futures. That's a major futures contract. It's very liquid. What do we see here? Well, price came up to this key resistance level with a liquidity capture event. And, but would I trade this right now? Probably not. Why? It's right here. Bullish trend. It goes against this. I rather wait for the perfect storm where everything comes together. Have I traded these setups where I would short it here? Of course I have. I'm just a human being. I go against my rules every once in a while. But oftentimes, it was a bad decision. I like to wait for the perfect storm, where everything comes together. Okay. I still want to be notified when these events by themselves happen, but not everything needs to line up. Because I like to still double check it. Maybe, the trend was only very short-lived, or maybe the really long-term trend is bearish to begin with. Sometimes I still take this trade. But more often than not, it's not such a good idea. I like to wait for the perfect storm. All right. So this is how I trade now. I set up my alerts, I get notified, I open up the chart, and if I like what I see, I take the trade, and I move on with my life. It's quite simple. And this allows me to have a regular job. My regular job is in trading, I get that, but prepare presentation, educational material, answer questions from our users. This is my day-to-day job. Trading is there too, but it's not the only thing I do. And this approach, where I get notified when something happens, allows me to do this. Now, I need to tell you, these indicators, which I've shown you, they are available for TradingView. You've seen this. For NinjaTrader, for ModifWave, and for MT4 and MT5, MetaTrader 4 and 5. Now, we have put together a very special offer for you, which is, I know, I had to talk with my business partner for a long time to offer this to you. So it's called the Market Edge Super Package. It includes our Liquidity IQ and MA Rush indicators, of course. And the link for this is in the chat. It's tradingindicators.com/edge. It includes these two indicators, but it also comes with bonus offers. And bonus offer number 1 is an invitation to tomorrow's live trading workshop. So it's very timely. It's tomorrow on Thursday at 10 a.m. Eastern time. We're going to live trade with these two indicators with our own money account, our real money account. You can follow along, you can see the steps that we take, you can see all the alerts that we're taking, and you can learn just by observing. You will be invited to tomorrow's workshop. Secondly, you will also be invited to our weekly member session, which take place every single Tuesday at 12 p.m. Eastern time. And by the way, these are all recorded. So if you miss it, no problem. You're gonna get the recording afterwards. There's also an ebook on MA Rush and 2 video guides, which we will throw in. But it doesn't stop there. And this is where the insanity comes in. To celebrate David's accomplishment of this conference, and thank you for all you guys being here, we have decided for a limited number of users to slash down the price from $197 a month to only $47 a month for these two indicators. And if you are hurrying up and you're part, this is perpetually, this will not change. Actually, I should take this out real quick, guys, because the insanity comes in. This will stay where it is if you are one of the first 10 orders. My apologies for this. This was a little mishap. So $47 a month, perpetually locked in for the first 10 orders. Normally it would go up to $197 after 3 months, but for the first 10 orders, it will be locked in at this price. And if you want to take advantage of this offer, all you need to do is go to tradingindicators.com/edge and sign up for our Market Edge Super Package with all these bonuses that we're going to throw in as well. And if you hurry, don't wait too long, you will be invited to tomorrow morning's live trading workshop, where we live trade with these two indicators, our real money account. We're going to do live day trading. It's always fun for 2 hours straight. I guarantee you many trades will be taken in that period or tomorrow at 10 a.m. Eastern time. All right, so real quick, get our Liquidity IQ indicator, our MA Rush indicator for trend direction, an invitation to tomorrow's workshop, our live trading workshop at 10 a.m. Eastern time, and you'll also be invited to our trading sessions, which happen every Tuesday at 12 p.m. Eastern time. And of course, there's also a Discord channel, I forgot to mention this, to which you will be invited to. So if you want to come on board, it's tradingindicators.com/edge to take advantage of this amazing package. Now, I did see a question coming in, one shot request, 1 second. It's from, it's for ES, the E-minis chart. So check it out. All right. So I'm going to go over here. Let's go to the 5-minute time frame just to see where we at with the E-minis. Today is a super bullish day. Now, how would we trade at this today in such a bullish environment? Well, I'll tell you, it would not be so straightforward for this one because we are bullish for sure. We came up. Well, actually, let's look at it. So bullish since this morning. No, since yesterday, actually. This is yesterday. So bullish. We approach resistance here with a liquidity capture. Would I personally have shorted it? I would not have done it. Even though prices came down a little bit. You can see it here. It came down. But I would not short this. I don't like to go against the trend. I'd rather skip a trade than feeling bad that I haven't taken it. So I wouldn't have shorted it. We eventually broke above this level. Great. Prices came up and then they retraced down. And where did they go down to? Almost to the T. Once again, look at this. Down to this broken resistance level, which is now acting as support. And prices grinding up higher afterwards. Afterwards, we're approaching once again resistance. See, this is resistance level here. Would I short it here? Of course not. We're in a bullish trend. So I don't short here. I stay in. Prices go up. They come back down. Even almost immediately afterwards, where did they come down to? To this broken resistance level, now acting as support. Rinse and repeat. This is a long setup. And prices go up again, come down again. This time not exactly to the level, but into the proximity of it. Another bounce setup here of this former resistance level, now acting as support. And then afterwards, we're just too far away from this level here. So for me, there would not be many trades up here in the ozone layer. It's too far up. So I would wait now for some kind of correction, potentially down to this level here, to think about a new long bounce trade. Up here, I mean, that's not much that can be done right now. We're just too far away. Would I short it here? I would not. I have no level nearby. There's no reason for me to short it. Would I go long? Also no, because, again, I don't trade off a key level, a technical level here. I like to trade when things are near a key technical level. This is where my market edge comes from. And this is exactly what I wanted to share with you today. These two indicators, Liquidity IQ and Mirage, are the reason why I have these two. Well, why they're the reason for the way I trade right now. I basically center my trading for day trading, but also for swing trading based on these two indicators because they have become indispensable for me. And to me, at least, they're giving me my market edge. And perhaps for you, they will do you the same. So for this, guys, if you're interested, tradingindicators.com/edge. David has put this link into the chat. And with this, David, I'm going to hand it back to you, I believe. This is all I had to say. Maybe David fell asleep during my oh, he did there. Okay.
I just have to, turn off all my mute buttons. But well, thank you for being here. Great presentation.
Yep. Great, yeah. Thanks, David. Thanks for having me. It's been fun as always, and hopefully see you guys on board. And otherwise, see you guys at a different presentation with David in the future.
Yeah, definitely.
Bye. Have a great day. Bye, guys.
Thanks, Danny.
Bye.
All right. So yeah, let's put this in there again. Be sure to hit that link and check out Daniel's offer there.
Perfect.
All right. So yeah, we're getting close to the end of the day. We have 3 more live presentations to go. Rich Friesen is up next. Rich, are you there?
I'm here.
Okay, great. Sorry about the incorrect backup link, but glad I saw your message in time. And
you did.
Yeah, happy you're here. So go ahead. You can go ahead and share your screen and get set up. And I'm just going to tell everyone in the room, we've had a change. We had a cancellation for the next spot, the 5 p.m. Eastern spot. That is going to be Jim, the option professor, is going to be here to do a market outlook presentation and update for us. And then Jeff Tompkins will be on at 6 p.m. Eastern time.
Okay, so let's see. I'm going to, so from this.
Do you see the share button?
It's probably right here, and I don't.
It's a green button. You might have to hit more.
Okay, encryption is on.
What was that?
No, it's encryption. Tube. Speaker. I do not see the share. Well, maybe it's below the screen. Ah,
Yeah.
there we go.
Oh yeah,
Share.
sometimes the the Zoom window hides for me.
Okay, share.
Okay,
Okay,
it's loading.
great. Now let me go here and start from the beginning. No, that didn't work. Start slideshow. There, that works. Now, can you see my screen?
Oh, okay, yeah.
Well,
Looks good.
excellent. The technology may have actually worked. Well, first of all, I'd like to thank you, David, for bringing so many talented people together, so many different options. And what a gift to your clients and to traders everywhere. So, first, thank you very much.
Yeah, thanks. Thank you for being here.
Okay, well, hello, everyone. Today, we're going to talk about the one thing that quietly destroys more trading accounts than bad strategies ever do. And that is your reactive, impulsive trading. Most of you have been there. I sure have. And in the next few minutes, you're going to see exactly why this happens and any real-time fix that my clients are using right now. So stick around to the end, and I'll show how a few of you can get early access to something pretty special. How many of you have sworn after a bad day that it'll never happen again? And then the next week or even the next day, it happens again. You know the setup, you know the rules, but emotion took the wheel. Now that is your zombie trader. And today you're going to see why it happens and what we can do to stop it. For those of you who don't know me, I'm Richard Friesen. I traded on the floors of the San Francisco and both Chicago exchanges. I founded Trade Management LLC, a floor trading firm. I wrote a book, A Private Conversation with Money, and I've traded professional floor traders, hedge fund managers, and professional money managers, and coached hundreds of active day traders just like you. And everything I'm sharing today comes from my own painful lessons in the market and from sitting shoulder to shoulder with traders just like you who are working through the same struggles. Let me tell you about Barry. Barry was a San Francisco Bay Area trader where I live, and his office was close enough that I could visit him in person. On a simulator, he was pure Zen, relaxed, breathing easy, sticking to his plan perfectly. The moment we switched to live money, everything changed. Shoulders up, jaw tight, shallow breathing. He started skipping good setups and forcing bad ones. He was in his full zombie mode. So I asked, Barry, did you notice the difference in your body? He thought for a second and said, well, sim doesn't really count. Live trading is where I have to prove myself. I asked quietly, prove yourself to who? After a long silence, he whispered, my dad. That one moment changed everything for him. We now knew the deeper drivers of his zombie behavior. Some of you traders may have seen the movie World War Z with Brad Pitt. Well, in this movie, zombies are chasing him and his family up the stairs of a tall building. Protecting his family, he gets zombie blood on him and doesn't know if he's been infected, and this will kill his family, and then will go on to kill his family. So when he gets to the top of the building, he stands on the edge of the building, leaning forward as he possibly can without falling, waiting to see if the zombie is taking over. He's hoping that in that tiny split second of awareness, he still has enough agency to jump before fully becoming a zombie and then going on to kill his family. That exact moment, that split second of awareness is where we as traders win or lose thousands of dollars in the marketplace. So let's make this real for you right now. Which of these zombie behaviors is costing you the most lately? You can go ahead, and I think you can type into a chat. Do we have a chat window here, I assume? Let me open it up. Yeah, there's a chat window. Okay.
Yeah, you should see the test that I just put in there.
Yeah. So if you have any of these behaviors, any of these fears or beliefs, you can go ahead and type them into the chat, and I'll give you a moment. And it doesn't. See, my screen isn't full. There we go. So here's what a typical day trader curve looks like. Nice steady gains, then a few zombie trains hit, a big tilt, and a long, painful recovery. Takes 10 seconds for yourself to think about your own last zombie trade. What was the trigger right before it? Everyone has a different trigger. A couple of losses, an argument with a spouse, not getting enough sleep, knowing you have to pay the rent, whatever it is, spot that trigger. And once we have that trigger, that's where the magic starts. Now, what if? Now, just imagine what if you could simply stop all of your zombie trades. Well, here's a trader. Now, look at his trades. $11,873 were made on his Zen trades. We used to call these lucrative trades. $12,371 were lost on his zombie or lousy trades. If he had only taken the Zen trades, he would be nicely in the green instead of flatter down. This is exactly the edge we're going for. When I work with my private clients, we work together to determine the level of conflict that sabotages their trading success. At the top of the success pyramid is knowledge and information about the markets. And most of you know about the basics of the markets and rules unless you're fairly new. Next, you spent months or maybe even years increasing your skills, strategies, and ability to see patterns with edge. Now, the critical action is to take what you know and execute that edge consistently. But what prevents that execution? Sometimes we need to go deeper into our beliefs and thoughts. Sometimes unfounded beliefs sabotage our results. And for some traders, even on the deepest level of sabotage, is our purpose and meaning in life. If this is out of alignment, the foundation of our master trader's mindset is shaky. Here is my experience over a large sample size of traders in terms of leaking and losing their profits. For years, I've worked with traders at every level of their psychology, going deep as they need. But as you can see, the more we focus our behaviors and reactions and focus on those behaviors and reactions, that trade execution in the moment, that is where the gold is. That is where we gain. The key to creating profitable trading behaviors are the Mind Muscles 3's golden keys. The keys that turn zombie traders into master traders, and they're very powerful. The first is awareness, then acceptance, and then agency. And when you use these three in the heat of the moment, everything changes. First, awareness. In fact, we can do this in real time right now. Well, let's do this. Take a moment and close your eyes. Lean back and take a deep breath. And I'll do this with you. Let go of all the external input. And right now, just take a moment to focus on yourself. Okay, first increase your awareness of your physiology. I invite you to take a trip from your nose to your toes. Muscle tension, what do you notice? Tight shoulders, shallow breathing, jaw clenched, legs tapping up and down. What is going on in your body? And I'll give you a moment. Next, notice your emotions without jumping to fix them. Are you bored? Are you curious? Are you amused, irritated, angry, disappointed? Notice how you feel right now being here in this webinar, and I'll give you a moment again. And finally, notice the quality of your thoughts. Now, this takes a bit more practice to watch your thoughts as they come and go, but just notice the quality of the thoughts. Are they helpful, positive, negative, judgmental, soothing? This single pause is the beginning of real change. Your good intentions cannot change anything without awareness. The second golden key is acceptance. Now, instead of judging yourself for what you just noticed, well, just be curious. Stay open. No resistance. If you judge yourself for what you become aware of, then awareness is just another tool for beating yourself up, and that doesn't work. So this is where the transformation begins. The final golden key is agency. And just like Brad Pitt standing on the edge of that building, can you feel when the zombie is about to take control? Can you consciously choose a behavior that actually serves your long-term success? This is where you take back control without willpower or discipline, because the power of agency feels better in the moment than falling into the zombie pit. So how do we actually reset our trading behavior in real time? Over the last decade, I have provided two paths to stepping into a master trader's mindset. First path is the self-paced Compass online course. The Compass course holds 20 years of everything I've learned as a market maker on the floors in Chicago, San Francisco, training traders for my own company, and as a coach with my psychology and NLP training. The amount of information in these online courses is just staggering, and it's been helpful to a generation of traders. The second path is my private coaching. This is the fastest and most comprehensive and customized process to clean out the issues that drain traders' account. Very quickly, we can uncover the issues that are most expensive. These issues can range from market knowledge down to the deeper life's meaning. However, do you remember this slide? This is where the gold is. Yes, those courses are valuable and quite a bargain. Yes, my private coaching is customized. But here is where the gold is. In that moment of decision, zombie or Zen. This is where trading meets the master trader's mindset. Imagine this. While you're in a live trade, you hear my voice gently ask, "Hey, what's happening in your body right now?" My breathing's a little tight, my legs bouncing up and down. "Oh, what else?" "I have a tight jaw." What is your tight jaw trying to tell you? Once we get this, we can get a voice from the jaw, from the muscle tension that has some anxiety attached to it. I can ask, how are you experiencing this open trade? I'm kind of afraid I'll lose my profits. Well, how do you feel about letting it go to a stop or target? What are the quality of your thoughts? I'm beating myself up. I'm thinking I'm an idiot. Well, this brings us to the golden keys of acceptance. So let's let that thought come and let that thought go. So what I just demonstrated here is real-time behavioral coaching exactly when you need it. Not more charts, not more strategies, but the same psychological reset my high-end clients get. A decade ago, I researched the cost of creating an automated coach on demand service, and the development cost was over $200,000. But today, with AI and your partnership, we can change the course of trading psychology. For those who can't afford private coaching and realize that going zombie is the heart of the profit drain, there is now an option that can't be missed. I am designing a new application that targets that exact moment of truth, executing a trading system or going on tilt. And today I am introducing for the first time that anybody else has heard about it outside of my company, our Coach on Demand Alpha Group. My mission is to leverage my years of behavioral coaching and massive content with over 200 articles, exercises, and reframes. With AI together, we can create a real-time coach at a cost so low that it is no longer even an issue for traders. And AI makes this possible. As your personal coach, AI learns more about your reactive behaviors, your real-time reporting, and it will suggest a reframe for your thinking, a physical exercise for your physiology, and an invitation to allow your emotions to tell the story and then flow by. How many of your trades are Zen quality and zombie reactions? The AI coach will check with you for each trade. This will bring trading psychology theory to that critical moment where you take agency and make a trading decision that serves you better. You will see the results immediately, not only in your P&L, but the drivers of those results in our mind metrics application. This is an invitation to not only step into your master trader's mindset, but to help other traders by developing a coach that works for you every time, whenever you want to trade. So before I go on, I don't have access to the chat box immediately. Is there any questions or comments that have come up so far? Okay, if not, we'll continue right here. So the question then you're probably asking is, what is Coach on Demand? Well, the answer to that question is partly in your own head because you're going to help shape the answer to this question. And here are just some possibilities that we can do together. Concept development. We are in the concept stage of this program. And the reason why I'm excited about it is because rather than a year of programming, with AI, we can take a concept and move it to reality much quicker and much cheaper. If you want to join us in helping set this up, you'll join over 1,000 traders who've taken our psychological assessment. That in-depth awareness will be brought to our development of the trading coach. We also can consider doing some group work, hot seat work, and this is in the plan. And the purpose of this is that we can see as a group what the issues are and how to work through them and translate then that to our coach on demand and our automation AI. So as you improve your Zen trading, you will see the results immediately, not only in your behaviors, but in your P&L with our Mind Metrics application. So here, as the technology develops, your contributions will help change the process, because there's no sense in Rich Friesen here. I've done this before. The biggest mistakes in my life have been when I said, oh, this is what the market needs. And then I go out on a limb. But to correct that error that I've made in the past, we are going to shape this with the users being part of the development. And once the program is ready for release, you will be part of the test program, the beta program, to ensure that it is usable for traders. And that will be part of the coach on demand. So I don't have a lot more to say unless there are questions or comments. I'll see if I can get the comment page. But if you're interested in helping develop the coach on demand with us, you can send me an email and I'll give you then a link to a form to fill in, and then also a link to set up a time to have a personal one-on-one chat with me. Or you can just email rich@mindmuscles.com and I'll send you the information. So if you're interested, contact me. We'll set up a conversation, because I want a few dedicated traders who are not only committed to their own progress, but are committed to creating a better psychological mindset for traders as they come on board. As you well know, most traders fail after a year or two. And the reason is not their intelligence, not their strategies, not their ability to look at the market patterns, but it is their mindset. And this is, as a lot of very talented and experienced traders have said, that in their own progress, it's the mindset that is the critical factor. So being part of this program means that you're also going to be developing your own mindset in parallel with developing the product. Now, I want to emphasize this product is in its conceptual stage, but I have multiple patents. I've got about 10 patents on trading screen design. I have built a electronic trading firm. I've built an on-floor trading firm. So I know what it's like to go from concept to actual product. And the places and times I've been most successful is when I've had a team of people with me who can, who, as my wife would say, can keep me closer to reality. So if you're interested in being part of this team, send me an email, and rich@mindmuscles.com. We'll have a conversation and we can go from there. So I'm going to see if I can bring up the chat if there's anything here. And there's the rich@mindmuscles.com. It's in the chat. I see it. And let me see if I can put the form in there. Or you can directly go to the form that's a Google form. It's in the chat. So any questions or comments? Happy to. I love the comments and questions more than I do a one-way presentation. So David, if you're there, do you have any questions or comments?
I'm not seeing any yet.
Okay. Excellent. Well, that means one of two things. We either bored him to death or we covered everything. But I'll tell you, you are not going to be bored with this program and being part of it.
Yeah, that sounds great.
We're gonna keep pushing you to. Let me restate that. We're going to invite you to your edges, and that's where the change really takes place. Okay, if there's no questions or comments, we'll let everybody go. I know that this has been a very intense conference. My God, I've listened to some of it, and what comes at you is just so much great information, great ideas, and great people. So I'll give you a break for the rest of the time so you can be fresh and ready to go for the next one.
Okay. Thank you, Rich.
Okay. Well, thank you, David, for putting this on. I really appreciate the opportunity to expose this first with you and your conference. So I'm now going to go to my list and do that also, but I love doing it here first.
All right. Yeah, sounds good. Thank you, Rich. Thank you for being here.
Take care.
All right. All right, so we have a little time here until the next presentation. So I have an interesting, so you have a few minutes to hit Rich's link there and check out his offer. Also, just a few other things I can share with you here while we have some time. Jeff Tompkins has a new PDF that I think you'll find interesting. I just posted that link in there, hit that, and he's going to be here in about an hour and a half to talk more about what he has going on, but he has a special presentation that he's going to do on his site tomorrow evening after this event is over. So you can get his PDF and learn more about that. Also, NetPicks has a new report about iron Condor options, and then if you have not seen this yet, there's just a few other ways that you can get updates on timing research events. You can get it on your Google Calendar, by Telegram, or by Substack now. And then, of course, also the full 12-year history of timing research is always on YouTube as well. So let's see. Well, we said Jim, the option professor, will be here to do a big market outlook session for you in about half an hour. But I also have this other presentation about gold and silver investing that I think you'll find interesting, and it's right at half an hour. And then, like I said, then Jim will be on at 5 p.m. and Jeff Tompkins will close out the day for us at 6 p.m. Eastern.
Hi, everyone. I'm Maggie Legg, and this is Samantha Molinari, Director of Customer Success at goldsilver.com. And we are going to tell you a little bit about the goldsilver.com platform and what sets it apart from everything else in the precious metal space. Make sure you stick around until the end for a special offer as well. Hey, Samantha.
Hi, Maggie. Thanks so much for inviting me.
Oh my gosh, it's so great to catch up with you. And it's a big deal because I know you have been on the phone nonstop, which is understandable given the record rally in metals this year. Gold, last year rather, gold up 60%, silver up 140%. And it's the sort of massive run. It has a lot of investors in the process of trying to figure out what their allocation to metals should be. Should they own more? Should they sell what they have? So I think it might be good to kick off with the end user. So talk to me a little bit about what type of customer does goldsilver.com cater to?
Everyone, honestly, from the little guys to the big fish. Like, anyone who has metals in their home, who has even a small amount that they even want to get started with. We have developed the platform for you to very easily and safely purchase precious metals. We can solution what you're looking for. If you want to hold it in your IRA, put it in the name of a trust, ship it to your door. We send everything signature required, fully insured. But our storage facility is probably most popular. And that way you can purchase and sell very quickly. And these are all hard assets, all held and ready to be used.
Yeah. So maybe we can put up the site. And I think what's really interesting is we're at a point in time where there are people who have been involved, and this has been a part of, how they think about investing. But I think we've got an awful lot of people who are newer to the asset class, who are maybe thinking about it but haven't pulled the trigger yet, or who need to be more active. They're just having a sort of, they're rebalancing more. They're thinking about doing more. Maybe they want physical delivery in a way that they didn't before. I mean, these are the kinds of conversations and frankly, the questions that I'm getting as I sort of move through the macroeconomic landscape. Curious to hear what you're hearing from people as well. But talk to me a little bit about how this works. Like, what do I do if I go to the platform?
Coming to the platform, it's completely free to open up an account. We're very big on education. So you're going to see a lot of different avenues to take depending on the type of investor that you are. Just coming here, you're able to sign in or just create a brand new account. We ask for information such as your email address, your first and last name, and here you're able just to start that account with us. Depending on what you would like to accomplish is the type of account that you'd create. So we have just a basic account. You can come and just purchase and ship right to your door. We have a few easy ways of doing it. You can fund your account where you can send in a wire, or you can do an ACH transfer. Or send in a check. It takes a little bit longer, but once we receive that check and process it for a couple of days, then you have a cash balance on your account that you can then use for a purchase.
Fantastic. So in terms of how this typically works, like what are the problems that the platform solves for? What makes this different?
What makes it different? Well, there's not a lot of other platforms that will allow you to purchase in your IRA. We can solve for that. We've partnered with a specific IRA custodian. It's kind of that one-stop shop for you to open up an account, see what type of account that you'd like to purchase using, educate yourself as to the different precious metals, and hold them in either your name or the name of a trust. It's an easy way for you to buy, sell, dollar cost average if you want to. We have a few different products that I can probably take us through. I have an account that I can show you, one that's already established. So it's all unlocked as to what we can do. Let's take a look.
Let's do it.
All right. So on our buy side, a lot of these investors, they already know that they want to purchase precious metals. It's just a matter of what kind of metals that they want to purchase. Do they want to have them shipped to their door, or do they want to hold them in storage? So we have the American Gold Eagles, Canadian Maples, and we have detailed pricing. And ours usually is pretty low, but we do have a price match guarantee with specific competitors. So if you do find that their price is lower, give us a call. We're happy to price match that because we don't want you to sacrifice the good customer service that we're offering just for price. So let's see. American Eagles, for example, or actually, Maggie, what do you want to buy? I've got a little cash in this account.
Well, good question. And I'm going to be honest. This is new for me. I've covered markets for many years and thought about it, but I think some of the barriers that I thought were there kind of have held me back. So I've never actually done purchasing, but I think I'm going to go with gold.
All right.
It's not financial advice, people, but I think I'm going to go with gold.
Perfect. for these products that we have available, we give a little, education into them. And of course, our customer service team, we're happy to provide you with any question or answers to your questions about, let's say, coins versus bars. We do have certain discounts depending on the quantity. And you'll kind of see that the coins will be a little bit higher in the price just because of the high demand for those products in the market. The bars, usually you tend to see a little bit lesser of a price. And depending on how you want to purchase, like the payment method, that'll also affect it as well. Convenience is credit or debit card, but there is a bit of a processing fee. So the best price is pre-funding your account and then purchasing right from there. So I've pre-funded a little money onto our account today. And let's say that we want to purchase gold. We have a few different vaults to choose from within the United States as well as outside the United States. But for this one, our most popular is the Salt Lake City, Utah location. And let's say that I want to do a cash order where I've got, I don't know, $10,000 in my account that I want to use for a purchase. And it'll kind of do the math for me, which is really nice because I'm a little lazy. It gives me a little discount and it says, all right, use from my cash balance the $20,000. And as I click on next, because I can purchase two, and it'll confirm. It's as easy as that, honestly. And so if we go over to like our account balances, it's going to show that it's pulled from my $20,000 and put it into the secure vault storage where it's going to be pending that execution. This is a live market that we're locking in right now. So these metals will be confirmed within just a few moments, and I'm guaranteed to get that price.
That's a really big deal because we have seen, I talked about the rally last year, but we've seen some volatility in the early days of this year, which is natural. So that is a real-time price that you're getting?
It is. It's a real-time price. And I was able to lock that in right now. I'll get a confirmation email momentarily. And you also have that for your records. So on a monthly basis, we send just via email, and it's located on your account, the statements that'll show you've got this amount of metal in storage. So we've got American Gold Eagles that I've already purchased, and I put it into segregated storage. We have segregated storage, which is a little bit more of a white glove service where the vaulting service knows my name and my account number, and it's stored separately. Whereas you also have just the general holdings, which is allocated storage. The storage costs are going to be based upon the value of the holdings. So when these metals are in storage, it's a prorated daily accruance for holding the metals in storage. Very easy to navigate, easy to see, and also really easy to sell. So let's say that we want to capitalize on today's market with the silver pricing. If I want to have these delivered to my door, I can do that. If I want to have these sold, and let's say that we want to sell 100 of the American Silver Eagles, just as easy as clicking a button, I'm now able to sell 100 of those American Eagles that I already had in storage, and the confirmation will be coming momentarily. Once that's confirmed, we've got the cash on the account that I can use for another purchase. Look, it's already up that 18,000 from the 10,000 that I had. And I can use that for another purchase, or I just wait until this is officially executed, which just takes 2 business days for the funds to settle on the account. Then I can take the withdrawal to my bank. And we have, an option for you to manage your bank accounts here, where you can add a bank for wire withdrawal, and you can add a bank for ACH deposit. We have a place for you to add a credit or debit card to take care of storage fees. If you're looking to use that credit or debit card as your payment method, you can also do that as well. But yeah, very easy to sell, to buy, just with a click of a button or a call to one of our friendly representatives.
So it's so interesting, and you have to wait 2 business days for the withdrawal, but you could keep it within the system and sell it as well, which again in fast moving markets is interesting. What I think for some people, again, maybe who are going down this road in a more determined way than they would have before. So not a casual buyer anymore. This is something that, okay, I'm going to be dollar cost averaging in here. I have to have a higher allocation now than what I was used to in the past. We hear people going to sort of machines in stores and getting gold, or you popping up all over the place as you drive down highways now. It's like, come in and into a storefront and sell your gold. Aside from ease of use, does goldsilver.com differ in terms of pricing?
Yeah, we're very competitive. We bid out, those purchases. We have a series of connections to showcase the best possible price. Pretty competitive in it. And like I said, like price match guarantee, not many people take advantage of it, but I think that they should, is looking at a few different competitors. I do see that our prices are in line. They're updated minute by minute according to the wholesale market. And the pricing for like storage, it's pretty low costing as well. Like for example, if you've got $10,000 worth of metals in the account, you'd be charged $6 that month for holdings. And this is fully insured for its replacement value. It's held at the Brinks facility. We have Salt Lake City, Utah, Hong Kong, Singapore, Toronto. Yeah, I think that our pricing is pretty comparable, especially with the education and technology that we provide. It's well worth it.
Yeah. So the other thing that makes people, certainly has made me hesitant in the past, is that the idea of physical delivery sounds daunting and maybe with some risk. I mean, the idea that I'm burying this in my backyard or I'm holding it in my house. But you don't have to do that. You can if you want, but there's a bunch of other options, it sounds like, if you are somebody who now believes that you want the physical gold, but you don't want the hassle of having it delivered.
Yes, based upon your comfortability, really. If you want to have it shipped to your door, it's definitely something that we can accomplish for you. We send everything signature required, fully insured, usually through FedEx. The time frame is, the time frame is what I do want to talk about, especially, you heard me, I was on the phones all day, and with the high demand, it is causing a little bit of a delay in our normally fast shipping. But the main point is that you're able to lock in the price. And when we send these signature required, fully insured, they don't come on the box that says something like gold, silver, right? It's going to say something completely different. We do send you the tracking numbers just as soon as our vaulting service has everything packaged up securely. I think they put a box inside of a box and wrap it up so tight, so it takes a little while to get into as well. And FedEx, we instruct them during that shipment that they should attempt to deliver at least 3 business days in a row, looking for anybody over the age of 18 to sign for the package. But that tracking number, you just want to keep a watchful eye out for it so that you can see the exact date of arrival and you can take appropriate action, just signing for the package that's coming to your door.
So Sam, that's it, sort of what you walked us through what you have to do or what you can do if you want to buy something, which is incredibly easy. What if you want to sell? What if you're somebody who's been wise enough to be gathering this all these years, and now with all the price action, you want to execute a sale?
Yeah, executing a sale when the metals are in our chain of custody, like in the vaulting service, is so easy, as you may have just seen. But for those who have shipped them to their door, we are getting a wave of people wanting to sell their precious metals or just get them back into storage so that they have that opportunity. And so we've started this program called our little mail-in storage program that you can input what you'd like to sell or what you'd like to put back into storage. So let's say you've got Maggie, she's got about 4 or 5 American gold equal coins. She's got 5, right? And this request is then, yeah, I wish. This request is then sent to the team in order to create a packing slip for you. And we've set up a specific vault that will get these metals back into our chain of custody, which is located in Texas. You would be responsible for the shipping and handling because you've got these metals in your home. We are responsible for the reassay process, right? So imagine that once these metals are received, we have a team who's unpackaging and sending it through a giant machine, basically to test its purity. And it's going to be held under your name and your account number with that vault. And once it is checked in, it'll then show up under your portfolio where you can just click a button and sell. But it does take a little time, you know, for these metals to get checked in, of course, because we do want our team to be very careful and not make any mistakes. It's all under surveillance. You know, these are class 3 vaults, of course, and then you can just sell and, oh, that's delivery. Then you can just sell and be issued payment. So a lot of people are actually taking that opportunity now to mail their metals in order to be prepared for when they do want to sell.
Interesting, because again, it's a market that they're interacting with more. I see that there's a portfolio button. Is that what is that a sort of fall in the education, or is that just so you can see everything that's happening, where all of your metals are at any given time?
Great question. Yes, both actually. So there's portfolio where it's showing your metals held in storage. As you can see, you know, the metals that we had, it rose quite a bit just in the last couple of months. Any cash that you put on there, you'll see that as well. The education portion comes with when you click on gold or silver, where you're going to see the spot price itself. So if we're looking at, you know, you can kind of toggle between the year or 6 months, and you can see, oh my goodness, the highest that we had, January 27th, looks like, just reached over 5,500 for gold. And for silver, you can kind of see, let's see, the last 6 months. Oh my goodness. That also, we saw those 121% in the last 6 months for silver.
Yeah, it's been an incredible run. What are the what are some of the concerns? What are you getting in terms of incoming? Like, what are you hearing from customers right now?
Buying and selling, just how to do it. I think that a lot of these clients have already kind of made up their mind as to purchasing. They're asking questions such as, you know, on the purchasing side, do I buy coins or bars? Do I purchase gold versus silver? We're seeing it on both ends, especially on the sell side as well, where people are selling some of these and how our platform works. But in the market itself, yeah, it's 50-50. We're having people both buying and selling. And that was always a question for the last 10 years. Hey, are you still going to be buying and selling when the markets go crazy? And here we are. You know, this is the reason why we built this platform, is so that you have that safe environment for you to purchase, sell, kind of taking your own financial freedom into your hands and being able to do it yourself. It's self-directed.
Yeah. And that's a really big deal, because I think that we are, you know, we're used to sort of operating like this, but in these markets, I mean, I had someone tell me a story where they literally went to a safe deposit box, loaded up these bars and coins in a briefcase, walked them across town. I mean, it's like, you know, the idea of that is just terrifying.
Wow.
To be walking around. But I think that is a picture a lot of us still have in our mind. Like, am I going to have to go through all that and stuck in, you know, in some attic somewhere, as opposed to something that looks much more like what we're used to interfacing with in other parts of our financial life. I'm very interested that you said, again, this is sort of new to me, that you said that you can move within your retirement, from your retirement, you can purchase or allocate. Can you talk to me a little bit more about that? Because I think people think of them as sort of separate universes. And in some IRAs you are, or in some 401s, you are only, I guess we're talking about IRAs here, but you know, maybe you can get the ETF, but that's it. You know, you don't always have optionality when it comes to buying commodities traditionally. depending on, what you're using. So how does this work?
Yeah. So we're not an IRA custodian, but we do have a connection with one. And throughout the years, we didn't have this connection back in the day. And we really listened to the feedback from many of our clients just stating so hard to navigate through the IRA world. So we set out to create kind of that one-stop shop, if you call it, where when you create an account with us, you're automatically creating an IRA account with our chosen custodian, which automatically shows what metals are IRA approved and which locations for storage that you can choose from. So we've cut out all of the research that you kind of need to do prior to what it was, right?
Yeah.
And so by having all of that completed, that 401k, you're able to roll over into this IRA and use it primarily for precious metals. If you have an IRA with another custodian and you want to transfer, it'll be an IRA to IRA transfer. And once the funds are received, then it's going to show up just like you saw on my portal and my account, is that's the cash balance. And I can use that cash balance for a purchase into my IRA. It's the same thing, pretty easy to use. The IRA custodian always requires a fee that's directly towards them. But when you reach that particular age that you can start to take, let's say, your required minimum distribution, you don't need to take it in the cash form. You do have that opportunity to take it in the physical form. So you can have these metals shipped to your door in order to satisfy that RMD. We always recommend speaking with a tax advisor, of course. So this isn't any sort of tax advice, but we just want to give all of those options available for you to take if you wish.
Yeah, I think that security, by the way, if you would like some information, since we're talking about portfolios, if you would like some more information about the role of gold in your portfolio, you can scan the QR code and receive a free ebook on it. And I know, Samantha, you mentioned that education is a really big part of this, which I think is so important, as a lot of people either are much more active if they've been in it, but for people who are newer to it and sort of newer to these options that keep rolling out, I think it's really important as we see this market sort of moving in the way it has been. But can you talk to me a little bit about security? Because I think this is, and trust. Because I think when you're dealing with something like this, when you're dealing with your money anyway, trust really matters. But especially when you're dealing with buying precious metals, selling precious metals, making sure you feel confident about the price, making sure that you trust the storage options that you have. I mean, trust must be a huge factor here.
It is. Yeah, 100% agree. And for our company, as well as how we're powered, this is the same technology and the same standards that certain banks, Merrill Lynch will use, UBS. So we work with a lot of different companies to kind of show them how easy that it is to do, but also the trust component is definitely pretty big. And so that's what we're here for. Our service team, our sales team, we're here to build that relationship with you, make you feel comfortable. We're an open book, to be honest. We're all about transparency. We're showing you the buy price. We're showing you the sell price at 100, like all the time, so that you can make that decision yourself.
So can anyone use the platform? Are there any restrictions? What does one need to do?
Anyone over the age of 18 can use the platform. Anyone under, that's usually a different type of account where a parent can open up a UTMA account for their kids. But yeah, anybody over the age of 18, we would ask for certain information to verify who you are. Such as the last 4 digits of your social, your birth date, and your physical address. We may require more detailed information if something doesn't match up, because we want to make sure that we're doing business with the right people. In today's world, you can't be too cautious. So we may ask for an ID, but not all the time, of course.
But no minimums? You can
minimums. There's no minimums for purchasing for storage, but if you want free shipping to your door, it is a minimum of $500.
Fantastic. So we promised a free offer, rather a special offer at the end of the show. And so first of all, tell me, is there a referral program? Tell me about that. And then I'll give tell all the attendees what the offer is.
Oh, we love word of mouth, honestly. And yes, we do have a referral program. Thank you so much for bringing that up. All you need to do is, in your account, you add one of your friends' email addresses. It will send you a link so that you can share it with them. If they end up opening up an account and trading with us, you get a nice little bonus based upon how much that they trade with us. And we also have, a lot of promotions that are going around. So I always recommend going to our newsletter and signing up. But yeah, we do have a promotion that will be showing for, I believe, a few months of free storage for you.
Fantastic. Yeah. And for everyone listening to this webinar, all the Tech Wizard webinar attendees, there will be an offer of free storage for 6 months. So you're going to want to take advantage of that, and you can hit the link and it'll take you directly to that. But appreciate, Samantha, you walking us.
All right, that was almost done, so I'm going to stop it there. If you're interested in that ebook, the link is in the chat. And Jim, the option professor, is with us now to do a market outlook for us. Also, he will be looking at your symbols. So if you have anything that you want him to look at, get ready to type those, or you can go ahead and type those into the chat. Jim, are you there?
I'm here. Can you hear me?
Yeah, sounds good.
Okay, and let's see if I can share my screen real quick and make sure the spacing on the machine is fine. How's everything looking?
Yeah, looks good.
You see pretty much everything there?
Yeah. Yeah, looks good.
Okay.
Sorry.
All right. So should I start up or?
Yeah, I'm just double checking everything here.
Sure.
And I'm gonna start my recording again, and then you can start your analysis. So I am recording again now.
Okay. Hi, everybody. I'm Jim, the option professor. If you don't know who I am, I've been doing the options for decades, over 30 years of giving seminars and trading the options. And I was trained at the Options Institute in Chicago for advanced option trading. So I have done a lot of business. I've done a lot of seminars teaching, and I've been well trained. So I am qualified to explain the uses and risks of options to you, and I'm going to do it today. If you have any questions or stuff you want to throw in the chat box, do so, but I'm going to get started and tell you what I see going on right now. This is something that after we had that drop towards 6,400 back in March, I kind of was focusing on, which is the fact that CapEx, it was supposed to be 30% bigger, then it became 60, and now it's up to 70, and the numbers have grown towards $800 billion. That is a lot of money. And again, with that type of an investment going on, it's going to be very difficult to keep the major indexes down for very long. And that's basically what we have now is a stampede with the understanding that the markets obviously are underappreciating earnings, underappreciating revenue growth, and underappreciating the bombardment of capital expenditure. So basically, that's the long and short of it. I like to keep things pretty simple, and that's pretty simple. The money had to come from somewhere, and it came from those hyperscalers who have all that free cash flow. And not only they have free cash flow, but they're borrowing money. So there's lots of money coming into this thing, and that's what's got it going crazy right now. Now, again, we've had a big run. This is a huge run. My accounts are jumping. I'm sure yours are as well. So does this thing have an end to it? Well, there's no end showing right now. Like I said at my Monday and Tuesday seminars, I think this thing is getting near a high point at some point here, but there's no evidence of it. So I don't go off what I think. I go off what I see. So let me show you what I see. Obviously, this is the 1-year graph on SPX, right? And you can see it's very extended from the moving averages. Okay. If you look at the 5-year graph, you can see it's also making way new highs And the RSI, let's see how the RSI is doing. The RSI was up here at around 62 and that kind of number, 64, whatever. And now we're at 68. So the RSI's made another new high, and that's a good thing if you want to be bullish, because that means that there's no divergence up here showing you that anything is running out of steam. You can see here that the break above 6,800 was the all go sign, right? Here they dropped the market in March to make everybody think we're going to go in the tank because of the war or whatever. And then basically, once we got back above this, you got all the moving averages turning up. You know, that's a green light all the way. Now, let's take a look at the other situation here, which would be the VIX. See, this is why I'm thinking, I don't know if it's 73.50, I don't know if it's 75.50 or 7,500, but somewhere in this neighborhood, we're going to hit a speed bump. When we do, and we get evidence, I'll definitely be changing my tune. So here you go on the VIX. That's not what I'm looking for. Let me show you the VIX, because the VIX has been very good to me as far as, you know, figuring out if the market's going to go up or not. As you can see here, the VIX is at 1739 today, right? And let's just take a look at what the low was. The low today was at 1618. So the VIX made a new low, but look at that snapback up in the VIX. That's quite a big snapback. So the bottom line is, as you can see, the VIX, and if I look at my long-term charts, which is what you want to look at now, it's right into support. What does support mean? That means it might not go much lower. If it doesn't go much lower and it goes the other way, that's going to be problematic. If it stays in this 15 to 20 range, it's not going to be a big issue. It could have some temporary pullbacks, but it's not going to screw up the whole thing. So again, 15 to 20 is a great area to be, but I'm telling you, when you went down to that neighborhood where these moving averages are, 1663, and you can see we went down to 1618, but now we're back above it, right? So that's a little bit of a little red flag, nothing to write home about, but it's certainly something. Listen, the VIX is going to probably bottom when the stock market tops, okay? So if we're at 73, 7,400 on the S&P and the VIX is starting to bounce off of 16, 17, you got to keep an eye on it, because there's a ton of people who are running in here and they're not exactly early. So let's take a look at the short-term VIX. That'll give us an idea if it starts getting above a certain number, that's a warning flag. So let's take a look here. Certainly getting back above 1850 here and 19 would certainly be a problem as far as short-term volatility. So again, and here we have a RSI of 35, and over here we've got an RSI of 46. That's a divergence. That means that it's running out of steam. That means it could be making a turn down here. So these are little warning signals I look for, so that if I have money on the table, maybe I'll start taking a look at taking it off a little bit, or all, if I think the thing is really at the top and these things are going to go back up. So that's a warning down here on the divergence. And again, getting above this line here, which comes in at 1830, and all those 17 numbers, you see all those 17 numbers? We're already above two of them. So again, I'm not one to cry wolf, but I'm not also going to act like happy days are here again and there's never going to be a dip. So anyway, we knew there's going to be a good run. We got a good run. Guys like Tom Lee said 7,300, you've blown through 7,300. If he thought 7,300 was going to be a high point and it goes higher than that, what does that make it? Less risky when it goes higher than that? So the bottom line is you got to have your head on straight. You got to keep your risk management in tow. You got to enjoy the ride, but you got to be very careful that when you get signs that the ride might be over, you try to do some risk management so you don't give it all back if there's going to be a correction. Okay, so that's door number 2. That's called the volatility index. Next one up is going to be called the percentage of stocks that are above the 200-day moving average. And that number's at 57. I'll show you the good news, bad news here. The good news is on a 20-year basis, it came down underneath, right, when the markets were tanking in March, and then basically it's gotten back above. But it's certainly not above where it was here, but it is turning up a bit. So right now, and this is telling you the breadth of the market is not that great. Do you ever hear about the 10% of the stocks are giving you 80% of the earnings? Okay, well, that's what they're talking about. Okay, but it is improving. Now that's on the 20-year basis. On the 5-year basis, you can see They got it underneath, but they came back above the gold line. That was your first sign that it's getting above sea level. And now it's above most of the lines here, as long as it stays above 55. My feeling is if it breaks above 60 and then makes a run at 65, you could be at 74 or 7,600 on the S&P, because that would be broadening out the trade. So again, that's what, again, and I'll show you on the 1-year graph why I was very, very constructive with the action today from this standpoint. You see, that's a breakout to the upside, unless it's going to be one of those island deals and it goes right back under 55. So if we go right back under 56, 54, again, I like the blue line turning up. That means the kind of trend is turning up on the 1 year. But again, that's why I say if we can get above 60 here, we could make a run for that gap. If we're going to take out 60 and make a run for that gap, we're going higher, in my opinion, on the stock market. So again, I'm not a bear of anything up here, but I'm also been around the block decades and decades and decades. And I know that, it's lovely to get involved in a big run, but every run has some type of a end point. And again, so let's take a look at on a short-term basis here. If there's anything else. Yeah, the numbers are all the same. You get underneath 56, 54, you're going to have trouble. You're going to probably have a correction in stocks. If the S&P gets, if the VIX gets above 18, 19, 20, and you break down here, you're going to have a substantial drop in stocks. This is my opinion. By the way, everything today is my opinion. I'm not giving advice out, so please just bear with me as I share with you my thoughts. Okay, so that's the tail of the tape. I call that the market pulse, because I want to know if the broad-based market is moving. I'd like to know if the volatility is ascending or declining or stable. And like I say, let's also look at levels on the S&P. I'm going to use SPX. You guys trade SPY, you trade ES, whatever you want to trade. But this is the cash market, okay? This is what I call reality. The other markets have got contango and all kinds of stuff going on, right? So the bottom line is this is the cash index. That's what I like to look at. All right, so as you see here, we already went over the 1 year and all that. So now we need to know in the short run where there could be trouble. All right, so here you got a high point, and what's the RSI? 76. Now you got another high point here, and the RSI is 80. No divergence, not a problem. All the moving averages are underneath, so as long as you're staying above 7,200, 7,250, and 7,284, everything looks pretty clean on the 1 month graph, right? And the possibility of going higher is certainly there. Now we go to the 5-day, which is your 30-minute graph for you guys who have Trading View and all the rest of them. That's the 30-minute graph. And what do we got here? We've got a gap. You got another gap. That's the problem if it rolls over. Now here you go. 82. Now you got what? 80. Not a big divergence. So again, the propensity of the action is still to the upside. It does not look like it. I have no evidence of it running out of gas or to have any of my lines pointing down. So that makes it a go, right? As far as the technicals are showing me right this second. But again, at some point they will roll over, and I'll know that the destination of the rollover could very easily be to the 7280 area, and the other destination could be 7200, which would be from here an 85-point drop or a 160-point drop. Okay, so that's why I know that there could be risk to that area if we started to roll over. Okay. All right, so that's basically on the S&P, and again, we had some earnings coming out. ARM came out, and this is why I think there's really still a risk to the upside here, because this company came out, and from what I read, it seemed like their revenues were kind of in line to estimates, and the stock had already gone up quite a bit. Let's go take a look at it again. You see, it was already up, right? So now it's come back up and made another high here, and in the aftermarket now, it hit 240. So let's just see if there's any divergence here. 87 was the first high, and the next high here is 63. That's a big divergence, and if I own this stock, I'd be starting to really pull out my risk management booklet. And in risk management, again, there's many things you can do. Some of your choices are what? You could sell out a part of your shares, keep the rest. You could do replacement trades where you sell out shares and replace them with vertical call spreads, which would have limited risk. You could sell out of the money calls and start bringing in premium. Or you could take that premium you receive on the out of the money call and buy put options underneath, and then you'd have a collar where you have parameters, upside potential and a downside floor. Or you could just take some money and buy insurance by doing a married put. Obviously, each choice has their own difference and their own use and risk. So you have to figure out what you like. Now, one of the things that I do at Option Professor is we have coaching. And when people have questions on this kind of thing, these are some of the things we can talk about in the coaching session so that you understand the uses and risks of options, and you can use options as a what? As a risk reducer or a hedge or a portfolio insurance tool rather than just abject speculation. So people have to understand options can be used for a variety of purposes if you know how they work. Okay, so I just wanted to show you what happened there. Tomorrow, we have got 593 companies announcing earnings. Yikes, that's a lot. So let's take a look at some of them and see if there's any setups that might be interesting. And I thought they were, that's why I wrote them down. So let's take a look. HWM, that thing broke out today, and I don't know what their earnings are going to be tomorrow night, but if they're below out, obviously it's already pointing up in a direction, and the RSI is certainly looking pretty good. So keep an eye on that baby. And then you've got Cloudflare. And Cloudflare was starting to move today, moving out, right? But again, it's got a gap underneath. So if it's going to be buy the rumor, sell the fact, sometimes these companies come out with earnings and boom, they go right back down. And you go, why'd they go out? They just had good earnings. Well, the darn thing just went from $170 to $250. And so that used a little bit of gasoline. And if they announce gasoline is not so much, then of course that's how you get the buy the rumor, sell the fact deal. All right. Anything else that looked like it might be emerging? Well, CRVW, CoreWeave, this is coming out tomorrow. CRVW. There, that's a CRWV. I'm sorry. It's late in the day, right? There you go. And here you go with CoreWeave. Now, CoreWeave hasn't been around that long, but it looks like it's taking off there. So you look at a shorter term graph like the 1 month, and you can see it's well on its way. And they're right in the thick of all this stuff. So again, when they go on sale and they're in the thick of a $800 billion capex, this is why when they turn up, you take a shot. So obviously 115, 120 was a place to get on board. We'll have to see if their earnings propel it or not. Again, some of these things have had pretty good runs. So it might be a little difficult to go much further, even with good news. Rocket Lab. This one looked kind of interesting, I think. Yeah, it was up $5, but you can see it's really just coming out of the chute. And this is gaining momentum. So if you're a momentum player, this might be something to take a look at, because obviously you've had your down to the averages. It's turning up. It got above here. Now it's down in the aftermarket. So maybe this is just a peek through the red line, which comes in at $82, but it's still above to $82. This also could be a pullback to the red line and then take off again. But certainly interesting. And so again, keep an eye on Rocket Lab, because again, the formation there, I don't think it's going to stay the same. So there could be a play of doing calls and puts at the same time, which is called a long strangle. You got to price it out and see if you like it. But the bottom line is, I don't think it's going to stay the same. I think there'll be some volatility coming out of that stuff. And then there's one that I have a interest in that has really been cooking a little bit here. So we'll have to see how it does. It's down a little bit in the aftermarket, but you can see this thing came down here where I thought it was a good place, and you can see the momentum has picked up pretty good. There is a ton of options in on this thing. Just to give you an idea, these are options that expire on Friday, and that's a lot of volume there. And there's also options that expire a week from Friday. And there's a heck of a lot of options on that as well. So basically, looks like people are thinking something might happen with this one from the standpoint of the volume and the stock and also options and also the actual stock. So I brought this to the attention of people who asked, and I think it looks like it could be very interesting because it used to be 80 bucks. And another one that took off a little bit here was Akamai. And that, again, came down to the lines. That's where you like to take your shot. And then this is a reversion right back to the highs. Okay, so there you go with some ones that are coming out tomorrow on the options. Now what I'd like to do is go over a few stocks that I've been pretty happy with myself. And then I'd like to go over and about where the rotation might go. Remember I just showed you that the percentage of stocks above the 200-day average has now gotten above 55 to 57. If it were to go to 60 and 65, where it came down from before the drop of March, and it's going to go up there and make new highs or whatever, then you would imagine there'll be much more stocks making a move. And let's take a look at what those stocks could be. So first, let's talk about some things that seem to be working pretty good that I have a focus on. Disney had some good earnings today. I went to Disney World with family, and I can tell you the place was packed. Packed to the point where I couldn't even believe they let that many people in because the lines were just like hours and hours to go see, It's a Small World, a little bit of a joke. But anyway, it pulled back to the line and now it's starting to try to take off. But there's some problems right here that it might have to get through. If I go look at the 5-year graph, you can see there's some trouble here. So it's got to get going through here. And if it ever did, can you see all of this neighborhood up here? So if they can get through this 110 to 120 area, the potential for Disney could be quite good. Another one that's kind of consumer discretionary is Starbucks. And again, this one to me, I thought looked pretty good as well. If you look at the long-term graph, you can see it's held all the support here and is starting to build. Again, these aren't as exciting as tech stocks, so I'll get into some other ones in a second, but it's showing you there could be some potential in the consumer discretionary type stuff. And you can see here that it's, after they had their earnings, it's been popping pretty good. The more exciting ones like IREN, another one is Applied Digital, APLD. And this is another one that's cooking pretty good here. Again, this is accelerating to the upside, which if you're an option player or short-term momentum player or, that type of guy, you want to definitely find these kind of things. And we're fortunate enough to find this one. And then what else do we have there that have been interesting here? Well, of course, we've been focused on Google. And Google's been up and away. And of course, they've got everything going for them. They got the Gemini, they've got the search, and they've got the cloud. So, that's called the trifecta. And that's why this is probably one of the strongest stocks in the country. As far as, fundamentals and big and all that kind of stuff. Amazon announced something that they're going to be going after the FedEx business and the UPS business. Obviously, that's been a big catalyst. And of course, this thing gave you the buy signal down here at 210 bucks. And obviously, it's been go, go, go ever since. And then here's one that I think has a big future, possibly. This is Apple. And again, it came down here and it's starting to go. They've got a developers conference coming up on June 8th. And, they're going to do something with that 1.5 billion or whatever it is active users of the iPhone. And if they can, they're in bed with Gemini. And so if they can come up with something to mobilize that type of power base, the upgrade cycle could really be very, very exciting. So these are the ones, of course, that everyone knows, but that one obviously lately has been a lot cheaper than the others to try to get involved. And then here's the one that's coming up on May 20th. And I was, I just had the meetings this week and I said, listen, guys, you're either looking at a gift or you're looking at something's wrong with the market. Now, I said I thought it was a gift. as far as NVIDIA dropping, because can you see it dropped down right to my line, which is where you'd want it to stop. And then can you see that also coincided with all these highs? So this was the neighborhood you take your shot in the 195 area, and you're already 12 bucks to the good. And if they announce good stuff, you would imagine that it could take out the high and really get going. And with the amount of CapEx spending, I can only imagine what their earnings could be. And the P ratio I was told is like 24 or 28. It sounds awfully cheap. But maybe there's a reason for that because of competition from AMD, Broadcom, AVGO, Taiwan Semi, and all these other guys. So maybe, there's a situation where there's competition in other semis that is causing, and obviously Intel. So again, maybe that's holding it back. I don't know. But this thing, if it is going to take off, 195 area is going to be where it's going to start from, I think. And we're now going to be at the 7th of the month. So we're inside 2 weeks from when these guys are going to tell you how much money they made in the first quarter. So again, I thought there were some options I was looking at on Monday and Tuesday in the $200 range, not only for June 18, but also for some strike prices in May 29, because obviously if they come out with earnings on the 20th, that would give you 9 full days to get action on the money. And obviously you can see when these companies announce and they surprise, it doesn't take too many days to get the thing going. So the bottom line is NVIDIA's looking kind of exciting, and today they start to make the turn up 11 bucks. Have to see if it'll follow through or not. So that was another one that I'm kind of keen on. And then let me talk about some of these international guys. Alibaba. I've had very good luck with Alibaba when you buy it on a dip, like down here, nice run. Down here, nice run. And I'm thinking there could be a nice run out of this neighborhood. It's got that resistance right here. That's a problem. But again, this company does have a lot of potential if it starts to turn. Again, getting above 155, 152 is the key to open up the door to all these numbers. So keep an eye on it. It's certainly not out of the woods yet by any means. But if you start hearing it trading above these numbers, I'll give you, for instance, sometimes when things are down and I have a belief in them, I'll stick with them, even though they're frustrating. Qualcomm is one of them. You see, Qualcomm looked terrible, and then all of a sudden it got above one line, and then one line, and then boom. Same thing with Arista Networks. Sometimes these things are very frustrating, and then they get the pop. Now this thing's come right back down again, but this pop here certainly was worth a ride. And Marvell was another one that came to mind. Now, obviously, when it's hitting the line down here on ANET, it'd be a time to put it on your radar and see if you think there's any value here. And here's Marvell again, frustrating, and then bam. So that's why I'm saying some of these things that don't look like they can move, when they do start getting out of the chute, they can go pretty good. Another one in that Chinese vein is Baidu, and you can see again why I think some of these things are cheap. Baidu's obviously breaking out pretty good. The other guy hasn't done it. We'll have to see. So those are two Chinese stocks that I always keep an eye on, because when you get on a ride with those, they sometimes take you to pretty good places. Tesla is another one you guys trade out there a lot, and I want to give you an opinion on it, because my opinion on that one is that I think it's going to go fill this gap at some point this year, and the gap is up in the 470 neighborhood. So I think it might be able to do that, but it's going to have a hard time getting through, or I know it's going to have a hard time, but it needs to get through the 413 neighborhood. So once it gets above 413, and it comes on some kind of news, I'm thinking it could pop back up and fill that gap this year. So keep an eye on that, and let's see if it can happen. Clearly, if it gets back under $300, $360, that might negate, any of the bullishness. So that's something to keep an eye on right there. Okay, so what else could be moving next if the thing's going to broaden out? Well, again, I talked to you a little bit about international. I'll give you a few more that seem to be on the road. This is South Korea, and there you go to new highs. And then you got Japan. And then you've got, you know, a breakout from there, not new highs, but certainly a breakout. So Asia's looking better, right? And then, of course, Europe, these European banks had a good bid here today. These are all European banks, and they were starting to take off here after their correction. I don't know if they're going to follow through or not, but if you're into the international picture, some of these things don't look terrible. Australia is definitely breaking out, and Canada. And we got some trade agreements with these guys to figure out something's going on maybe there. So keep an eye on the international picture because, you know, if we keep going and if they ever drop interest rates, that would be pretty helpful for them. But again, let's talk about what might be happening next as far as what you might look at. How about the rare earth stuff? Okay, well, I've been looking at those as well, and it seems like they might be turning for something decent there. Look at that one. And then let me just give you a few. That's USAR. That's US rare. Another one, critical critical metals. That's CR critical. That's it. Critical metals. CRML. Again, another one that doesn't have a whole lot of resistance above, correct? And then as far as the charts are concerned, and then CMC. Okay, so that's an area that, you know, it's not in the news, right? But it certainly looks like it could be going someplace. So you put it on your radar, you price out the stuff and figure out if it's a play or not. With regards to nuclear energy, Cameco's back on the bicycle. And I don't know if it's going to be able to kick out of there, but it's trying to. And in the same vein, OKLO, how's that doing? It looks like it's breaking out a little bit. So that's why I'm trying to point you in that direction, guys, because these are the things that could be the next games in town. Because you need that energy, right? And there goes UEC. So that's a group that I'm definitely putting on my radar. So feel free to put it on your own. Another thing that's been going on a little bit is in this genomic medical area and pharma and some biotech. So let's take a look there as well. That's another sector. What you want to try to find is sectors that are on the move. This one's called Twist, and Twist has had a good run. Now it's steady. Have to see if it's going to be able to keep going. This is that is not it. Hold on, TGX. TXG. Yeah. This is 10 times genomic, and this one looks like it might be able to take off. So take off there. I'm trying to look at things that are going to be the next games in town because, you know, again, the ones that are going now are not, you know, maybe never ending. TGTX Therapeutics. Obviously, you already had a good run, but it gives us an idea that there's some money coming into the biotech area. And so if you can kind of keep an eye on some of the biotech areas, there could be something of value there. RVMD. That one's at 151. Again, it's either going to start taking out that high or it's going to be capped at a double high. So keep an eye on it and see if there's something that could work for you here. IONQ. This is another one taking off here in the in that area. And then CVS, everyone's heard of them. And they took off as well. So there's some action on that stuff. And so that's why I'm keeping an eye on it. Now, everyone's talking about computing, and speed. Okay, so how are you going to get involved with something with speed? Let me show you. These guys are all about speed. And that is called D-Wave. And was it a good deal last year? Absolutely. Was it a terrible time for a while now? Yes. Is it turning? Looks like it. So anyway, I don't know if it's going to continue or not. It may or may not, but it's something that if that kind of thing is going to turn, that would be something that might benefit. Let me see. I had that. Well, of course, this one here has already gone up quite a bit, but it was on the alerts a while back, and this is a form factor. And again, it's had its correction, so I don't know if it's going to start blowing out the highs or not. But again, it looks like it's trying to get back on the bicycle. The other ones are called Rigetti, RGTI. So what I'm basically saying is quantum could be coming back into play. That's what I'm trying to say. And again, this one doesn't look quite as good as D-Wave, but none of them are going to be good if they can't get a little bit further down the road. They're just starting out of the gate. Another thing that could start turning, because they're going to try to do something with real estate before the election, probably, right? Something. And so things that are way down might be valuable, like Home Depot. I mean, do we have a divergence here? I don't know. You got an RSI of 34, and now the RSI is up at 43. A little bit of a divergence. If you look at the long-term graph, it's certainly way down, So again, not a good trend, but it might be a sector to keep a little bit of an eye on because of the fact that, if we were to get a change in the real estate picture, then obviously some of these companies, like KB Homes, might get a turn out of it. So they're very cheap. All I'm saying is if there's any hope in real estate, KB Homes, DH Horton, Home Depot, Floor & Decor, these are companies that are way on sale. And if they could get a turn, and even some of the buyouts people, the mergers and acquisition people that have a real estate data center type of background, and this is one of them called Blackstone. This is on sale, and I don't know. Steve Schwartzman's runs this company, and I've thought it was a pretty good deal down here because it used to be $200 and it went down to $100, and half price sounds cheap to me. And then this looks like it is trying to turn. So if these guys can turn their business around a little bit, there could be some potential in this thing. So I'm just trying to look at some things that are out of favor because sometimes out of favor turns into favor. Also in the industrials, there's two of them here that I think you might want to keep an eye on. This is called Borg Warner. That thing looks like it wants to go someplace. I really loved it down here in the 50-something area. So it could pop pretty good here if it wanted to. And then Boeing's back in the news for me because, again, they have a backlog of a ridiculous amount of planes. And so if they can clear here in this 240 area, I don't know, where could they go? I mean, if you look at a 20-year graph, I mean, there's nothing but real estate up here. And there's only a two-man race here, and the other guy in the race, Airbus, doesn't look like they're doing that great. Not only that, they're over in Europe, and Europe has got a lot of problems with their aviation because they got no jet fuel. So anyway, I just thought that this thing looks like it's bubbling, and sometimes after bubbling, it can take off. So those are two industrial stocks that I thought might be worth your while to keep a little bit of an eye on. If you guys have any stocks you want me to take a look at or any questions you have for me on anything you currently have, you want to talk about how a replacement trade would work, or you want to know how some covered calls might work or anything like that, I certainly would be able to voice my opinion on that. As we move along, though, I would want to also remind you that the financials, still have some pretty good value to them looking forward. And some of these guys that have a lot of credit cards that got sold off, one of them is called Capital One. This thing may have an ability to start filling some gaps. You see, I thought it was a good value down here. So check out COF. They didn't get it to go into the gap, so that's something there, and the blue line is turning up. So again, if you go look at the shorter term graphs in the last month, I think there's some gaps you can see. Now you see them better on the 1 year, but there were some gaps again above. So it'll be interesting to see. Affirm has earnings coming out tomorrow. So are people defaulting, or are they paying their Affirm bills? Again, this is another one that I thought was very cheap, had a nice big bounce here, and now it's kind of stalled out. So if the credit situation doesn't look so good, these things are going to come right back down again. If it looks like they could be decent, there's upside, I think, to Capital One and maybe even Affirm. And on the bank side, of course, Citigroup is always viewed as the best value out there for people. But again, it's stalled out. It's had a nice big run after earnings or before earnings. And then basically it's been kind of stalled out ever since earnings came out. So if it gets back on the bicycle and starts trading above 135, that might be something to take a look at because it's got pretty good valuations, against book value and things like that. And of course, the other standards are JP Morgan. And on JP Morgan, let's see here. Yeah. So JP Morgan trying to pick up some steam. It was up, well, today it did anyway, up $5. Yeah. And I don't know, like I say, it looks like me, if it gets above 320, it can go on a run. So yeah, I'm keeping a little bit of eye on those financials. And oh, again, one last area before I hit some of your questions. Don't forget about the metals, because this one here told me, well, I'll tell you a couple of them that told me. This is mining and metals, a lot of industrial metals. And you can see this guy here is trying to take off. So things like Freeport-McMoRan FCX and things like Nucor and UE and maybe Alcoa Aluminum AA and maybe some gold and other metals might be able to start going. So basically, if you look at the top 10, 15, 20 holdings in this thing, you probably find something that might look like it might be breaking out as well, because that looks like it's trying to break out right now. And that's your industrial metals. I looked at GDX, and it had a good day today. And again, but it has room to go. It has, shall we say, wood to chop. But if you started getting this thing back above 95, I would say that would be a good sign. And some of the metals actually, like AG on the silver Majestic, it's, looks like it could be breaking out, and the options are pretty cheap, so it might be an idea there. So that's something I'm keeping an eye on. And then on the gold, you got a couple of them here that are pretty popular, Kinross. But again, they still got wood to chop here, so it's not out of the woods by any means. AEM is a popular one. And again, you got a double low there that could be helpful. And so keep an eye on that. Okay, let me go over to some of you. Well, we got some questions. Let's go get them. Let's go get them. HL, yep. I have a personal interest in Hecla mining, and it's starting to turn a little bit. But again, I need to get more juice out of it. Once it gets above 20, I think we're going to have some action. But above 22, then I think it could make a run. It's all going to be, if these metals are going to, make a turn down here. But again, they have come on a big correction. That's where they were supposed to stop. That's why, this is where you take a shot. So this is where they're supposed to stop if they're going to stop. Obviously, if they don't stop here, they can go into the soup in a big way. So that's what you have to be aware of there. So that's the story on Hecla. That's a silver mining company. Okay. I like the idea of a 45 days till expiration, put trade on ASM. Similar trade on MES. All right, well, that's what you like, Tom. Let's take a quick look and see what that looks like. All right, so this is on IWM. Now, again, he's trying to look at puts, and it's at its all-time high. So again, yeah, you could fault it because he obviously is stepping in front of a freight train, but he's also stepping in front of what could be the Empire State Building. You know what I mean? So the bottom line is let's get an idea here of 45 days out. What would we be looking at there? We'll be looking at, well, how about June 18th? Let's take a look at June 18th. That's pretty close. So anyway, here's what the thing would be. Where could it pull back to? Well, if it's going to come back to some of these moving averages, let's see where they could be. You've got some support there at around 275, right? Where all this done, 270. So that's one neighborhood, 270 or 275. If it's going to have a more severe correction, you can go back down here anywhere between 260 to 265. What does it look like on the 5-year? Yeah, if it wanted to have a full, yeah, let's just say it could go down towards 260 if you really got a correction, right? And let's see what the options look like. So we'll go over to June, check them out. June 18, bam. Okay, so our target's 260. So what do the options go for, and are they worthwhile? Well, somebody's buying the calls. So there you go. A lot of people want exposure to the small cap, so rather than buying the whole thing, they're saying I'll put up $700 and I'm long at 290 until June 18. Obviously, that's a pretty big trade there. Anybody on the put side? Yeah, you got this guy up here. But again, I'm going to have to go to all strikes because we have a target quite a bit away from where it is. So let's just say here you went down to the puts. And if your target is 260, let's just see how you could do that. Well, the 260 puts are going for $1.79, and obviously somebody must be suggesting them because you got 3,000 contracts at 179. Now, let's go up to 270s. Would you put up $1.50 to pick up $10? Why am I talking like that? Because your strike price here is 260 for $180, right? And if I go up to 270, my premium is 322. This is just working off last trades. So the difference between 180 and 322 is what? It's $1.40. And so would you put up $140 to pick up $10, which is $1,000 of intrinsic? I would say yes, and that's why 40,000 individuals are trading that thing probably. So you put up $3 here, and if it went down to 260, you get $10 out. That would be a play. You want to put up some more money? You go up here to 275. Now you're putting up $1.30 to pick up only $5. Not quite the deal. And so, like I say, that would be another alternative if you wanted to spend a little bit more money, pick up a little bit more intrinsic. The other thing you could do is a vertical put spread. And what's a vertical put spread? Well, where are we trading? We're trading at 286, right? So you go out to June and you buy a what? Say you buy the 285 puts for $762. And you go down and you sell your 260 puts. And you're going to get a little less than a couple bucks. So let's figure out what the spread differential would be just as a example. 762 minus 2 would be 562, add 20 cents, that's 582. So say you could get it done between 575 and $6. And if it ever got down to 260 on expiration day, if it was at 260, because there's no time premium left in it at that point, the intrinsic value is $20, and your maximum risk would have been about $6 if you got it done at $6. And if it goes to 260 or less on expiration day, June 18th, because there's a time value on these things, so you're not going to get the full intrinsic until all the time value is out of the options, which is going to happen if A, we're way under 260, or B, it's under 260 and it's very close or at expiration. That's the times you'll have most likely to get your full premium. All right, so that's that answer there, and again, MES would be the S&P. So you do the same kind of drill on it, and that's kind of what you do. Let's see what else we got. BTC for Rolando. All right, Rolando, let's take a look. BTC. Okay, BT. Well, let's get the chart up. What are we doing here? Let's get that chart up. Okay, BTC, and of course that's Bitcoin, and again that's something also I'm constructive on as long as it stays above 70,000. And again, this guy here, well, let's take a look at the 5-year graph is still in a downtrend. The 1-year graph has made a turn. like I say, I've been very constructive on it in the last few weeks because of the following. You hit a low point here at that level of 18, and then the next lows over here had a 40. That's a huge divergence and probably as good an indicator as any that the selling has dried up. And then once these things turn up at 30 bucks, it's a buy. Now you're a little later in the game because it's up at 36. It still could jump up here to 42. But again, the better time to get in would have been right here when it made the turn after you saw the divergence there. Let's just see what it looks like on a 1 month basis. On a 1 month, everything's still pointing up. So it's still an uptrend, but you got a gap there and you got a gap there, and those are going to be attractors. You've got an RSI here of 69. You jump up to new highs at 73. You're over here close to the high and it's at 69. That's not much of a divergence. So it still looks like a decent deal. And then here you got something's going to break here pretty soon because that thing is called, I call this a traffic jam. When all my averages go in here, they don't last forever. So something's going to be breaking here fairly soon, which means if you started seeing 36.50 or better, that would be a good sign. If you started seeing 35.50 or less, that would be a bad sign. So that might be a deal where you try to play the way it goes. But that's the only thing telling you that this rally might be over a little bit is that, again, where's the RSI here? 74. Where's the RSI over here? 60. That's a divergence. So on the 30-minute graph, don't forget, this is only a 30-minute graph, 30 minutes. It is showing a little bit of signs of weakness, but it wouldn't really give you a decent turn unless it can break these lines here and get the red line pointing down. It's not pointing down, so that's why it's a rough racket to really be negative on it here, because you want that red line pointing down if there's a turn or up if there's a turn, and we don't have that yet. Utilities. Well, you know, here's the one I always get. I don't know if it's any good anymore, but this was the one I liked. And let's go take a look at why. You see, this thing had a very nice double low here, and it gave me a nice rally. That's why I liked it. Now it's pulled back. Should it stop? It should stop right here, or no lower than here. So you got about 63 to 66 as your support. That's the neighborhood that it's got to stay positive if it's going to keep going. So that's Edison International. I thought Dominion looked like it might look like it's going somewhere. You see how it's in a fairly big window there? So if you're into utilities and this baby can start trading above 65, there's a lot of real estate up here to fill in. I'd keep an eye on that one. And the Southern Company. And again, chop, 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 chop. I think Dominion looked the best out of all of them, but you know, that's I'm not an expert, you know, at the utility area, but I just gave you a couple of things. Okay, NVIDIA, like I say, I had already gone over that, but I'll go over it one more time. If it is going to do something like get tremendous earnings, see right now you got a double high point here. RSI 73, RSI here is 62. That's a divergence, and that's on the 5-year graph. That's a problem, okay? But that problem can be totally resolved if it blows up to 230, because then your RSI will jump right back up there again, and you'll be all set. So again, if this thing, you know, like this Tom Lee was talking about 7,300, and then we're going to roll over, you know, if this thing is anywhere near the topping formation, it leads me to believe that maybe something that we'll hear out of NVIDIA is going to sober everybody up, and that's on May 20th. So sometime between here at 7,350 and whatever the heck we get to by 520, it could be the zone. And of course, I told you the RSI, the VIX is down there at what? In that, you know, 17, 16 neighborhood, which seems to be the lows. So again, you know, a limited risk option for a couple $100, that's all you could lose. That's one thing. But something where, you know, you're expecting it to take off and it goes the other way could be another. But again, you would imagine these people are announcing all these earnings, AMD. Now, maybe AMD is taking the business away from these people and Intel. And maybe that's what we're going to find out in this earnings report. And maybe that's why it went down $20. And maybe that's why it hasn't made a new high. Okay. So, you know, We'll all find out in time. But this thing, if it did, if it did get the kind of news that you would expect because of that AI spend, and again, the AI pie is so big. These guys can lose some business and still have a tremendous amount of business because the pie is so huge. But if you had to ask me, Jim, can you explain why that thing's not moving? I'd say, yeah. Can you spell Intel, INTC, and can you spell ADM? And can you spell these other people who are coming up with their own chips like Google? Because these guys have very expensive chips, but they also have the best chips. And so the guys who want the best, the fastest, and all that stuff, they're still going to go with the Vera Rubin, which is coming down the pike. The ones that are saying, listen, I don't need to get the Cadillac. I have a nice little Ford here and it's running fine. That's where you're going to get the Intels, and that's where you're going to get the other guys who can do this stuff cheaper. But again, a lot of people self-sourcing these things. These are all, negatives to these guys. But again, I am, for one, taking a speculative position that it is going to go up. So that's the way I think it would go. But another couple of days like this, I'll probably throw a protective put underneath just in case it ends up going to 150 and shocks the world. So again, I think the path of least resistance is up. But again, there is a reason why it's stalled out. Let's see. IWM we talked about. Michael Clark we talked. Okay, and Tom has SPHR. Let's talk about that. Oh, Sphere. Yeah, I was just listening. They've got other stuff coming out. Yeah, they've got funding for one in Dubai. So they're planning on opening a number of these things. I am in Las Vegas, and not today, but and so I've seen their facility there, and it's very popular and it's very exciting. So yeah, these guys have a product. Costs a lot of money to put it together. The construction costs have just gotten well, they were going out of control. Maybe now with the slowdown in real estate, maybe they can get it done cheaper. At any rate, you can see it's had a nice little ride to it. And again, the trend is your friend, right? The thing turned up right here at about $40, and then if you just use the red line until it turns down, you're still in there. And then if you look at the 1-year graph, again, pull back, go, pull back, go, pull back, go, pull back, and now it's trying to go. Divergences. Your RSI was at 71, then you made another high here at 56, you got your pullback. Then you got the RSI here at 64, and then you got the RSI here at 61, pullback. Now you got the RSI up here at 70, and over here at 64. So again, you'd like to see this thing take out that 150 and get that RSI going again. It's had a very long run. You're certainly not going to be early to it, but it definitely has a trend and it definitely has a story. What I'd like to do now, because it's getting to be about 10 minutes before the end, I'd like to show you a couple of things that, because we've got a service, option alert service. And we're also working on a shorter term service as well, where the options have very nearby option, like 7 or 14-day expirations, very aggressive. But people trade aggressively. And so obviously to give them something to chew on, I'm working on something there. But I would like to show you now some of the stuff that we've had on the alerts. And this doesn't count anything from the May 15th expirations, which there's plenty of ideas there, which have obviously gone up. And also plenty of ideas for June 18th, which also has benefited from this area. But I did want to show you here basically some of the ideas, and again, past performance not indicative of future results, and there's obviously risk and options not right for everyone. Consult your brokerage firm and determine your suitability and risk tolerance. And this is not advice, but these are ideas. That's why they're called ideas. So again, you can see I'm specializing in options that cost a couple of $100 or so. You understand? That's what I'm trying to do. Why? Because obviously if you buy options, the risk is limited to the premium, as long as you don't get exercise and things like that. But anyway, here on the alert, every Sunday night, we send out an alert. And on the alert, the idea on 329 was to go with Amazon 215 calls, 175 puts for $293. And as you can see, and Amazon had a very big move at one point to 293. Excuse me, to 252, and clearly it's beyond that now. So 215 minus 252 is $37 times 100 is $3,700. So that's option going for 293 maximum risk, jumping up intrinsically before it expired on April 17th to 3,700. Same thing here again on Amazon. Amazon had a very nice move to 252. So anything that we had the week prior, we had on March 22nd, the same kind of an idea, only this was 220, 180. And obviously this went intrinsically up to 3,200. So as you can see, we have the Googles, we have Abercrombie and Fitch, Alibaba, Cameco. Again, I do all the scanning, I do all the figuring, and then I share with you ideas that we've got. And then obviously people do with them whatever they do. But again, these are the ideas throughout the first 4 months of the year. So we haven't even counted the May month. So this is for the first 4 months. And you can see, 276 on Chevron jumped up intrinsically to 2,800. You've got Freeport, 287 and 254, 2,300 and 1,500. And, you had the Dollar General was a very big mover. That expired in January. And that went from 213 up to 3,500. So you can see when the market makes moves, some of these options that are cheap could have a very good expansion, and they're all not going to work this way. That's why you have to use your risk management, and you have to obviously think about diversifying or find a sector. Like in January, Chevron, it was an oil stock. That's a sector that was on the move. You see what I mean? Or metals. Metals like the industrial metals, Freeport McMoran had a very nice move to 70. And so did Alcoa Aluminum. And so if you can find a sector that's going on the move, these are $200 and change, and they had nice jumps, as you can see. That's why I'm trying to look for the next ones in town, so you could possibly take advantage of that. And again, some of the ones that we mentioned earlier today have already made a move. So again, in the first 4 months, not counting this month at all, we had about 55 of them that jumped pretty good. And you can see I'm not prejudiced. Walmart, Antero, Dow Corp. You got a lot of metals there. There's a bank. You got a drug company, another biotech. So, I look for wherever the setup looks great, where I think we can take a small amount and possibly catch a run. That's what we're trying to do. So here's what you get. You sign up for the options alert, and you got 2 ways to go. And there's the link right there. So you can get a 90-day deal, and it's normally $395, but it goes for $297 now. So you get 3 months that way, but I suggest you go for the annual. Why? Because you get a whole year, and it normally costs $997, and you get it for $897. So that's a whole year of every Sunday getting something in your mailbox that reviews all the markets and gives you some ideas. But here's the kicker. You get an options class, which has a $395 value because it's a 6-hour options class. So you get that right out of the bat. As soon as you click the link and you put in your credit card and get the thing signed up, you'll get 2 things in your inbox. One is a receipt, and the other one is what? The course. Then Sunday night, like clockwork, you'll get another email with the alert in there. And here's the big kicker. You get coaching. I work with you one-on-one. You'll get my cell phone where you text me and you go, Jim, I'd like to have a session this day or that day or the other day. And then we have our coaching sessions. Now that's 8 hours you're getting with the annual $897, and I charge $200 an hour. So that's $1,600 of free coaching throughout the whole year. And also the $395. So you got about, $2,000 worth of free stuff right out front, and you're putting up $897. And like I say, I've been doing the options for a very long time. I've done seminars for them on a long time. So I do suggest you give us a shot, either the 90-day deal for $297, which is a no-brainer, and also the best value $8.97 for the whole year, and really make a commitment to know more about options and get better at it. Okay, I'm Jim, the option professor. It's the top of the hour, and David is going to want to shut this down, so I'm going to help him do that. And if you have any other questions, optionprofessor@gmail.com. But if you get set up here tonight, I'll get my cell phone over to you tomorrow, and we can start going after this thing together. Okay, thanks a lot, you guys. I hope you learned a lot today, and I hope you sign up for my thing because I think I could be a lot of help to you. Have a good night, and thanks for being here, and good luck and good trading.
All right. Thanks, Jim. All right. And yeah, originally someone else was scheduled for the spot, but Jim they had to cancel, and Jim stepped in to cover the spot last minute. So thank you to him for being flexible on the schedule. And all right, so next up to close out the day for us is Jeff Tompkins. Jeff, are you there?
I'm here, David. Great to be here.
All right. Sounds good. Okay, I see your presentation now.
Okay, great. I'll go ahead and kick it off. Thanks for having me. Great to be here. Welcome, everybody. On our session today, I'm going to reveal my slingshot strategy and how to forecast market direction up to 3 days in advance. So we're going to be looking at some forward-looking tactics, and we're going to throw all the lagging stuff out the window. So before we dive in, I'll just cover a quick risk disclosure and disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We'll be going over some various results in our session today, and I'm going to share real money results in every circumstance that I can, but just know that anything that I do share due to the time critical nature of trading, brokerage fees, activity of other traders, so on and so forth, don't guarantee that anyone will mirror that performance. All right, so with that out of the way, we're going to start out by talking about some of the difficulties that we encounter in trading. I think it's important to lay those out there and understand what they are so that we can overcome them and actually focus on some strategy that can be consistent and reliable. So this is an interesting psychological curve as it relates to the financial markets, and I'll kind of walk you through it and then talk to you about how the slingshot strategy will overcome a lot of these drawbacks. So anytime we place a trade or get into an investment, of course, we're doing so with some degree of optimism, enthusiasm, even exuberance and euphoria, right? Otherwise, we wouldn't get into the trade. But interestingly, we often do this when there's a high level of financial risk in the market. So that might be, for instance, when markets are around all-time highs and they may be more vulnerable to a pullback. And so if you've been in the market for any significant period of time, you've, I'm sure, encountered a trade that was working out for a while and then it moved against you, right? The market conditions might have changed or something changed and the trade moved against you. And so this is where that exuberance and euphoria can quickly transition to anxiety, denial, fear, even despair. And so this is what we get when we see panic selling in the market. So you get panic, capitulation, discouragement, and that can then transition back to renewed hope, relief, optimism, and this cycle will repeat itself over and over again. But the key here is that when you get panic selling in the market, it can often create a lot of opportunity. It can be the best time to trade or invest. And so I want you to keep this psychological curve in mind because it's going to apply to the slingshot strategy that we're going to cover here momentarily. But the reality is that much of the difficulty in trading can be boiled down to psychology. We're all vulnerable to it anytime we interact with the markets and place trades. So anytime we enter a directional trade, our goal is, of course, to buy low and sell high. But that actually goes against our human instinct. So instead, when a security has already gone down, we tend to sell it. And then when it's already gone up, we tend to buy it. We'll then panic when the price is falling because we're afraid of losing money. So we'll buy when it's rising because we're afraid of missing out. So it's the FOMO mentality. And then to compound that problem, we're wired to repeatedly make this same mistake. So we'll buy high and sell low because that's what our emotions tell us to do. And without a solid trading plan, we're vulnerable to our emotions. In addition to that, if you lack a strategy that can identify momentum shifts, which means you don't know when to get in or buy low and get out and sell high, this can pose a major problem for inexperienced traders and investors. All right, and we're going to overcome all this on the session today. So instead of being greedy, and I don't particularly like to use the word greedy, but when we're looking for opportunities for good trades, right? So we might have some optimism and enthusiasm getting into this trade, rather than do it when there's a high level of risk in the market, right? Or when other people are panic selling and losing money, when it might actually create opportunity for us, right? Rather than be involved in that panic selling, we're going to turn the tables here. So the slingshot, and this is really embedded into the mechanics of the slingshot strategy, will allow us to reliably identify when markets are vulnerable to a sell-off so that we're not getting into a trade at the wrong time and then panic selling when the market conditions change, right? And when there is opportunity after a market sell-off, this is going to help us identify opportunities to get in near market bottoms and take advantage of a lot of the trend reversal. So it's that old Warren Buffett adage, be fearful when others are greedy, right? And that's largely how iconic traders like Warren Buffett, George Soros, Carl Icahn, so on and so forth, have made billions of dollars over the years, is they use a contrarian approach. So this whole thing is really designed to be contrarian. And again, the slingshot will help us overcome a lot of these difficulties that we all face as traders and investors. All right, so I want you to keep that psychological curve in mind as we start to dive a little bit deeper here, because what I'm going to give you today on our session to make this a whole lot easier is, number one, you'll discover the slingshot setup that's worked 100% of the time. So if you apply this to the major indices, the NASDAQ, the S&Ps, you go all the way back to the dawn of the stock market. Okay, this works out, as I'll demonstrate on the session, 100% of the time. It hasn't failed even once. Okay, and we've actually just recently had a completed slingshot setup, which I'll show you. All right, I'm going to show you how to identify the setup, how to trade the setup, how to profit from the setup, how to get in near the bottom and out near the top. Now, we can't pick an exact bottom or top, but we can get remarkably close using this slingshot strategy. I'll show you how to apply this setup to any market in any time frame. So this is completely fractal in nature. You can apply it to any asset class, any time frame on your chart that you prefer to use. I'm also going to give you a really powerful trick to help reduce and eliminate a lot of your losing trades. Okay, we're always going to have losing trades, but when we're placing directional trades, there's a very simple tactic that can keep us out of a lot of bad trades, and I'm going to share that with you as well. We'll look at some trade examples to reinforce everything that we cover, and then stick with me to the end. I'll show you how I can copy my success and get the trade signals that I use to make a living in the markets. So I do trade for a living, and I trade both on the retail and the institutional sides. I'll give you a little background on myself here momentarily. But first, let's imagine if we could buy low and sell high without using any guesswork. So all too often we use some degree of intuition or guesswork in our trading decisions, and we want to try to reduce or eliminate that as much as possible. Well, there's a volatility study that I'll share with you that has made this possible going back to the beginning of the markets. And it's a unique setup that I call the slingshot. Okay, and again, when you apply this to the major index products like the S&P, the NASDAQ, you go all the way back to the dawn of the stock market. Okay, this is worked out 100% of the time. There aren't a lot of things out there that can make that claim, right? And so anytime you're searching for a strategy to incorporate into your trader's toolbox, you want something obviously that is proven and that has mechanics that are built in to match the way the market behaves. And not just in a brief period of time, but over years, or if not decades, or if possible, going back to the dawn of the market. And this meets that criteria. Now, where it gets really exciting is that it's going to help us identify when markets are, after a sell-off, overextended and might be likely to snap back. But it also warns us of potential market sell-offs. So as we get into the mechanics of the slingshot strategy, I'll show you how you can reliably know when a stock, an ETF, a Forex pair, a futures contract, doesn't matter what it is likely to sell off. Now, once the bands, and we're going to be using volatility bands, can't be stretched any further, they have to bounce back. So most of us understand that markets don't move in straight lines, right? There's volatility and buyers and sellers on both sides of the market. And so we get, trends that look like what you see there on the chart, right? We don't move in a straight line. So we'll talk about that. But once with this rubber band effect, it can actually make it possible to accurately identify tops and bottoms in the market. And again, we're not going to get exact to the penny, but we can get remarkably close. So let's start to look at some charts and visualize this. And I'm going to be picking out some charts from some very difficult times in the market. So these are going to be market crashes, bear markets, periods in the market where people were likely taking heavy losses. So this is the first one. This is back from early 2020 during the COVID crash. And this is the daily chart of the S&P 500 index. So I'm just going to kind of walk you through some things right now and want you to visualize this on the chart. And as I'm doing so, keep that psychological curve in mind that we covered at the start of the session. All right. So on the left edge of the chart, okay, we want to put everything in context here. So at this point in time, we're at kind of the tail end of a decade-long secular bull market. We would, of course, go on a couple years later to go into a full-on cyclical bear market in 2022. But at this point in time, S&Ps are hitting new all-time highs. So what do we have? We have probably a lot of FOMO mentality, fear of missing out. There might be people that didn't take part in this incredible run-up in the market and are now uncertain. Is it too late to get in? How much higher can it go? Am I at risk of getting in at the wrong time and the market selling off? All these things start to come into mind. And there might also be, and certainly there are people that took part in this incredible decade-long secular bull market and might be wondering, should I get out now with profits? How do I protect my profits? Is the market vulnerable to a sell-off? Well, here's where we want to start to so that's the camp we want to be in, right? We want to be either protecting profits, booking profits, or looking for opportunity for speculative bearish positions. So when other traders, so the bulk of the retail trading crowd, right, who might have missed out on this rally, are starting to buy in, we want to look at selling, okay, when most other traders are buying. So again, this is that contrarian approach. Now, of course, in hindsight, we know what happened here. There was a major market crash over the course of about a month. The S&Ps lost over 30% of their value, right, in a very short period of time. So there was a lot of panic selling going on here. And again, I'll give you a little background on myself momentarily, but I do manage money on the institutional side, and I had just recently launched a hedge fund at this point in time and traded through all this, and I'll share some of the results with you also on the session. But I do know that there was an unprecedented number of hedge funds going under during this market crash. A lot of them were over leveraged, so there was a lot of margin calls and crazy things going on. Okay, but there was opportunity here. All right, so after the sell-off happens, so roughly around the third week of March when S&P's put in a low, right? This is where we want to look at coming in and buying, when most other traders are panic selling. Okay, so again, think contrarian here. Now, what's interesting is at this point in time, latter part of March, when you consider the catalyst that caused the sell-off, there was no resolution to it. It was still in its infancy. We didn't have any vaccines or viable treatment options at this point in time. Global economies were shutting down. There was quarantining. People are losing their jobs. All these terrible things are happening. And unfortunately, it would go on to get much worse. However, right, the markets are to a large degree forward-looking. So the market put that behind itself very quickly and rebounded. And by early mid-June was already back up to that price level where the sell-off initially ensued. Okay, so this is where we want to look at taking profits, right? After we've bought in and I hate to say it, but taking advantage of all the panic selling that happened in February and March. Okay, so take a mental snapshot of this chart because this is the slingshot. And the slingshot is going to help us identify when that sell-off is likely, when the market's vulnerable to a sell-off. So that was back in February, right? When it's likely to rebound and where we should get out with our profits. Okay, so we're going to come back to this chart and we'll apply all the rules of the slingshot to this chart. Okay, so before we go any further, I'll just give you a really brief background on myself. Again, I'm Jeff Tompkins, and pleasure to have everybody here today on the session. Promise to make it worth your while. You're going to learn a lot of really good stuff today. I've been trading for over 2 decades and really love teaching. So I started trading on the retail side, then started getting into education, And I've coached around 30,000 students on a platform called udemy.com, have over 7,400 reviews, and ended up launching Altos Trading a little over a decade ago, where I serve as the chief investment strategist. So we have rapidly grown over the 10 years. We're over 60,000 members in over 100 countries across the globe. And as I mentioned, I also trade on the institutional side. So I also manage a hedge fund. And we traded through the COVID crash, the bear market of 2022, black swan events, bull market runs, pretty much every market environment you can imagine, but some very difficult ones. And we've never had a negative year in the hedge fund. We've always had positive years. We've had periods where we've beat the S&P 500. So I really credit a lot of that with this contrarian approach and a lot of the methodologies and strategy that we'll cover on today's session. But I got my first kind of glimpse into the institutional side back in the early 2000s as an intern at the trade desk at Morgan Stanley. And that's where I really noticed the big gap between retail and institutional trading. Because prior to that, I was trading my own account and went through all the trials and tribulations, blew up accounts and all that fun stuff, right? So that's what ultimately led me to become an educator. I found it back then, it was very, very difficult to find good education, and it still is today, unfortunately. There's a lot of stuff out there that just doesn't work, and it's very difficult to kind of parse through all that and figure out, what's actually going to work and what's going to not just work right now, but keep working a month from now, a year from now, 10 years from now, 20 years from now. Well, that's what I'm here to do, is to help you find those things. So I'm a keynote speaker and educator. I love getting out and educating. So enough about me. Let's get to this, back to the slingshot. And by the end of our session, number one, you're going to discover a trade setup that hasn't failed going back to the beginning of the market. So again, if you apply this slingshot strategy to the major index products like the S&P, the NASDAQ, okay, it hasn't failed. We just recently completed another slingshot on the S&Ps and the NASDAQ. And again, we'll look at some charts. I wouldn't have been able to make that claim if, we did this about a month ago, because that one was still in the works, but it's now completed. All right. So 100% of the time, that includes the tariff crash we had last year. It includes the bear market of 2022. So it really happens with not just repeatedly, but with astounding predictability. So whether you're a seasoned veteran, you've been trading for years, or maybe you're just starting out, this is really must-have information for today's markets. They've become a lot more, compared to when I started back in the 90s, a lot more erratic, more volatile, less predictable. So you need to have these tools at your disposal. So you're going to discover why volatility is one of the only leading indicators of market direction, how to identify when markets may be vulnerable to a sell-off. And I say this can completely turn your trading around because it really helps reduce, if not eliminate, that fear component, right, that we looked at in the psychological curve. So if at any point you're in a trade and you're fearful of what might happen, then you're probably not going to manage that trade well. You're not going to make a good decision on how to manage it or when to get out, right? And so we're going to eliminate that with the slingshot. How to identify when the market is likely to go up. So after there has been a sell-off, right, we need some reliable way to identify when the supply-demand curve is going to shift, when buyers are going to come in and drive the market back up. And we'll look at some really effective tools to do that. How to determine exactly how far the market is likely to go up. So this is what I refer to as the trader's dilemma, right? You get into a trade, maybe it's working out in your favor, but there's always the question mark in the back of your mind is, should I get out now? Am I going to get out prematurely and miss out on, additional potential profits? Do I hang on too long and the trade reverses on me and my open profit turns into a loss? All these things. The slingshot's going to help solve that problem. How to get your hands on a tool that will change your trading forever. Now, this is a bold claim, but one that I make because it's one that has completely transformed my trading. It took me from a struggling trader to a consistent, confident trader, and I'm going to share that with you today. So let's get into the slingshot, all right? Why do I call it the slingshot strategy? Well, as you pull a slingshot back, all right, muscle energy is transferred to elastic energy in the bands of the slingshot. Now, after the slingshot's released, the elastic energy is transferred to the stone as energy of motion. So referred to in physics as kinetic energy, right? An object in motion stays in motion until something stops it. Well, markets kind of work in the same way in the form of supply and demand. So when you get demand, right, there's buying pressure. So if there's demand for something like any other market out there, buyers come in. Well, the same goes for a stock or an ETF or a futures contract. So once the band becomes overstretched, it's going to give us a buy signal, and we can enter the market with high confidence that price will go back up to the initial resting point of the band. And we're going to start to visualize this, but I want to factor in another thing here, and that's volatility. So markets can't move without volatility, of course. And there are really two main types of volatility. There's historical volatility, right? What has happened in the past, and implied volatility. What is the market forecasting to happen in the future? How much is it forecasting the market to move? So we're going to gauge volatility using a common indicator called the Bollinger Bands. Now, these volatility bands are going to tell us when prices move too far from the mean or the average and is likely to reverse direction. So it's readily available on any retail, charting or broker platform. Like any other indicator, there's dozens, if not hundreds of ways to use it. A lot of them probably aren't effective, but we're going to use it in a very unique way that can help us pinpoint turning points in a security with astounding accuracy. So again, just take kind of a mental snapshot here. This is for visualization purposes to help kind of solidify what we've covered up to this point. And we'll look at this chart here. So the Bollinger Bands are plotted. And by the way, if you're not familiar with the Bollinger Bands, I'll give you just a high-level overview of them momentarily. But again, just visualize for now what's happening here. Well, we see price rotating lower, okay, and it's breaching so there's three lines there, right? It's breaching the lower line. And then it continues to go lower, okay? Then it doesn't do it in a straight line. It kind of goes up a little bit, then back down, right? But eventually there's an obvious turning point, and it doesn't matter what the stock is. This could be any stock. Okay, but there's an obvious turning point there. This is the supply-demand curve shift, where there was previous excess supply, sellers were driving price lower, but that shifted and created enough demand to attract buyers who then drove price right back up to that initial sell-off level. Okay, so it kind of looks like a triangle, right? And this is what the slingshot looks like. Okay, so now we just need to understand the exact rules behind it. And we're going to get into that. But before we do, I'll just give you a high-level overview of the Bollinger Bands if you're not familiar with them. Again, they consist of three lines. Okay, so we take a simple moving average of the securities price. And of course, you don't have to do any of this because the indicator does it all for you. But I always think that people should have an understanding of what they're using and why they're using it. All right, so that's the center line that you see, the red line there. Okay, we then take a standard deviation to the securities price. Now, standard deviation is just a mathematical measurement of average variance. Okay, just good for understanding, right? But the element to really grasp here is that it measures how spread out numbers are from an average value. And because it's a measure of volatility, when the market becomes more volatile, the bands are going to widen. And when the market is less volatile, the bands contract. So that's what you'll essentially want to understand for purposes of the slingshot. Now, as far as settings, like most indicators, there are settings that you can often change. And that's the case with the Bollinger Bands. Most platforms default to a 20-period SMA or simple moving average for the center band, and then a 2 standard deviation setting for the outer bands. And those are the settings that I use universally across any asset, any time frame. So I don't change them, but you can check those on your own platform. Most likely they're going to default to that. All right, so let's start to put this into practice. There, as I mentioned, are a lot of different ways you can use any indicator, including the Bollinger Bands. We'll look at some common ones, and then I'll show you how we're going to use it for the slingshot. Now, one is to buy at the bottom band and sell at the top band. And this can work in range-bound markets, right, for briefer periods of time. But the problem is that price can then break out, right? It can hug the upper or lower band for extended periods of time. So this approach might, result in a few small consecutive winners, and then you're those are wiped out by one bad trade when the market makes a directional move. Okay, so we're not going to use that approach. Another common one is band contraction and expansion. Now, we are going to incorporate this into the slingshot, so I want you to pay a little extra attention to this one because it could be a good indicator of an impending big move in a security, but the problem is we don't know in which direction the move will occur. So it doesn't necessarily give us directional information, but it helps us navigate whether markets are vol contracting or vol expanding and when they might be likely to make a big directional move. So we're not going to use it as a standalone approach, but we'll incorporate it into the slingshot, as you'll see. So another is to buy or sell at the middle band. So we call this a mean reversion strategy. And this can work in strong trending markets, but it fails in sideways ranging markets. So kind of the opposite of the first approach we looked at. All right. So we're not going to use that as a standalone approach. What we are going to use with the slingshot is where we wait for the lower band to break. And I'll explain what this terminology means, but essentially price will hug the lower band and then ultimately rebound to where the breach initially occurred. Okay, so we're going to apply this now to the slingshot, and we'll look at some charts here in just a second to solidify all this. So our goal here is to use the Bollinger Bands to buy low and sell high, right? And never get trapped in the mindset that we're going to pick an exact bottom or top. That's not possible to do, right? You might get lucky here and there, but we want to get close, right? We want to capture as most of that trend as possible. So the Bollinger Bands will help us do that. I won't, for the sake of time, I won't go into all the background of the Bollinger Bands. They've been around for decades, developed by John Bollinger, who actually originally kind of designed them to be an overbought, oversold indicator. But again, we're going to use them in sort of a unique way. So with the slingshot, we're going to look for price to exceed or hug a band and envelope for prolonged periods during strong trends. We're going to wait for the lower band to break and then wait for a buy signal. And then we're going to exit when price returns to the breaking point. And again, I'll explain all this terminology and it will become very clear as we visualize it on a chart. But what you should know, and where this gets really exciting, is that the slingshot occurs with astounding predictability and reliability. In fact, the major market indices have returned to the initial volatility breakout with 100% accuracy. It hasn't failed once. Okay, that includes the 2026 correction that we just experienced, the tariff crash of 2025, the bear market of 2022, the flash crash of 2015, the flash crash of 2010, the crash following the 08 mortgage crisis. Markets lost over half their value in the second half of the year. Going back over 2 decades, the 2000.com bubble, the COVID crash, every black swan event, market correction, major crash, bear market, you name it. Okay, this plays out. And we're going to look at some chart examples of these exact scenarios. So let's start to do that so we can actually understand how this slingshot strategy works. Okay, so I now have the Bollinger Bands plotted on the chart. And I told you we come back to this chart of the S&P 500 index from back in early 2020. All right. So as I'm walking through this, keep the psychological curve that we looked at the beginning of the session in mind. Okay, what's happening here? S&Ps are putting in new all-time highs. Okay, the retail trading crowd has FOMO mentality. They're afraid of missing out or afraid of their profits that they may have accumulated over the bull market run evaporating. All these things start to come into question. Now, around the third week of February, okay, we start to see the S&Ps dip a little bit. And notice how they rotate down into that lower Bollinger Band. And in fact, on that first day where it touched that lower band, notice how that kind of served as dynamic support. So price touched the band and pulled back up a little bit. Okay. And then on the very next day, we get range expansion. The high-low range of the candle widens and it breaches that lower band. This is where the slingshot starts to get pulled back. Okay. Now there's one other important thing that happens simultaneously. So that this has to occur for it to qualify as a valid slingshot. Okay. When you get a breach of that lower band, number one, there has to have been prior narrow bands or band convergence. So notice how earlier in February, and I'll refer to them as the upper or lower outer Bollinger Bands, okay, were relatively narrow, close together, parallel and horizontal. So we're in low vol or low volatility market conditions. Okay, but when we get the breach of that lower band, notice how they widen. So they rapidly diverge. Okay, so when these two things happen simultaneously, there's a high probability of a sell-off in the asset. In this case, of course, the S&P 500. Okay, there it is. S&Ps are down over 30% in just a few weeks, but that creates buying opportunity. Buyers come in and they drive price right back up to that initial volatility expansion level. And I'll point something important out here. So notice how in early June, okay, where the slingshot gets released and prices return right back up to roughly that 32 handle, where that sell-off really started to gain steam back in February. See how price pulls back there? It actually gaps lower and mean reverts to the center Bollinger Band, and then kind of goes into some sideways consolidation for a month or so. This is no accident. So what you're seeing here is profit taking from the quote unquote smart money who took advantage of the panic selling and bought back in mid to later March. Okay. They're taking profits. Now, this is where the retail trading crowd might start to catch on that, hey, maybe I should start to get long the market again. Okay. But we, using the slingshot, could have already been in the rebound. We also could have taken advantage of the sell-off and placed some bearish bets. Okay, so we'll look at how to do all that. But let's look at some more chart examples. So can you apply this methodology to individual stocks? Absolutely. Okay. Now, if it's an individual stock, right, you're probably not going to reach that 100% threshold. It's not going to play out 100% of the time, but a very high percentage of the time, this will play out. Compared to the indices, for instance. So, of course, the stock market has a long, very, very long-term upward trending bias, right? Stocks are going to behave a little bit differently depending on the stock, the beta of the stock, all these variables. But it still occurs with very astounding reliability. And so let's look at this chart of Apple, okay? On the left half of the chart, the stock's in a strong uptrend. And this is the daily chart, by the way. Okay, it's in a strong uptrend. It's trailing the upper Bollinger Band. Now, right around the middle of the chart, okay, the stock rotates lower. Okay, this, by all measures, without having the benefit of hindsight and seeing what happened on the right half of the chart, right, looks like just a normal downside retracement. And in fact, anyone who's a candlestick analysis trader would recognize these as two bullish reversal candlesticks, right? And so I would venture to guess that probably a lot of people got trapped here. They saw that first candle test the lower Bollinger Band. There was a bullish reversal candlestick pattern. People probably started to get long here thinking that the uptrend was going to resume. But as a slingshot trader, you would have known better, because on that next candle, it breaches the lower band. Now, what happens simultaneously? The outer bands diverge. So we're going from vol contraction to vol expansion. This indicates that there's a high likelihood of a sell-off in the asset. In this case, of course, Apple. There it is. So it sells off from roughly like the 196 handle down to roughly the 168 handle. Okay, forms a double bottom, rotates down into support, creates buying opportunity. Buyers come in and drive price right back up to that initial volatility expansion level. Once again, notice how price kind of stalls out there and consolidates for about a week. Okay, no accident. You'll see this happen all the time. Okay, this is likely profit taking. And then, of course, it then went on to make a more extended upside move, which is actually an extension of the slingshot. There's a multitude of ways to trade around all of this, but in the interest of time, we won't get into that. I just want to lay down the basics for now. Okay, and let's move on to another chart. So this is back from 2018 on the Qs. Okay, what do we see on the left half of the chart? We're in low vol conditions. The bands are parallel, horizontal, relatively narrow. Markets are kind of range bound. They start to rotate lower, and then they breach that lower band. Notice how simultaneously the outer bands, the upper and lower band, diverge rapidly, and there's the sell-off. Okay, and there were actually like 3 or 4 embedded slingshots into this that could have been traded as well. But if we're just trading the overall big slingshot here, we see that around roughly the third week of December, right, buyers start to come in. There's the buying opportunity, and they drive price right back up to that initial volatility expansion level. So from roughly like the 143.50 handle all the way up to the 180 handle. And once again, notice how price kind of stalls out and starts to pull back there. Okay, does this apply to intraday timeframes? Yes, the same psychology, the same methodology all applies, right? So this is a intraday 5-minute chart of AMD Advanced Micro Devices. Okay, notice on the left third or so of the chart, the stock's range bound. Remember, we talked about that approach: buy at the bottom band, sell at the top band. Well, that might have worked out a few times here. Okay, price was consolidating, it was range bound, and it was bouncing between the upper and lower band until it doesn't. We get a breach of the lower band, we get divergence of the outer bands, and there's a sell-off. But there obviously was buying opportunity here. Buyers came in and drove price right back up to that initial volatility expansion level. All right. So arguably the most straightforward part of the slingshot is identifying when a market may be vulnerable to a sell-off. Okay, so right, you have prior narrow bands or band convergence. You get a breach of the lower band, simultaneous divergence of the outer bands. Okay, that's your indicator markets are vulnerable to a sell-off. Okay, the most challenging part of the slingshot is to identify when the band is overextended and ready to snap back. So I've been trading this methodology for decades. And I used to do a lot of this with some guesswork, some intuition. I would use candlestick analysis. I would use support levels. But I found that I was missing a lot of the trend. I was missing a lot of the move or getting in too late. So I spent well over a decade and thousands of hours trying to determine when momentum is shifting and a new trend is starting. And once I got this formula dialed in, I then had to configure it to work on all time frames and duplicate the success across all markets, because I don't just trade, one stock or one asset class. I trade equities, ETFs, futures, options, Forex, even crypto. So that was the real challenge. But I ultimately got this all dialed in, and the result is a tool that provides accurate buy and sell signals near the outer channels of the Bollinger Bands, and it does so up to 3 candles in advance of the move. So it's designed to give us foresight, to give us advanced notice of a forecasted trend using a buy or a sell signal. And I found that when you formulate the right combination of momentum studies, volatility studies, and price action, you can accurately identify buy and sell signals near the outer bands. And so this is what I've developed into our trade trend indicator. So we're going to apply this now to the slingshot strategy. This can also be used as a standalone. It's extremely powerful on its own. But obviously the purpose of our session today is to apply it to the slingshot methodology. But you can also apply this to a lot of other strategies. So you might already be using a strategy that's working or other indicators as well. But as a standalone, okay, even used by itself, it's going to give us accurate buy and sell signals up to 3 candles in advance of a trend. So that means if you're using this on a daily time frame, you're going to have up to 3 days of advance notice with the exact price you should get in, the forecasted direction, whether that's a buy or a sell signal, and then it's going to read the market in real time. So it uses an advanced algorithm. But once you get into a trade, so if you take a trade off of one of these buy or sell signals, it includes a trailing stop algorithm as well. So it's going to read the market in real time. And when you get into successful trades, it's going to help you lock in those profits. Okay, so that's important, obviously. We need to make sure that we're capturing as much of that trend as we can before it inevitably reverses. But it's all designed to help forecast short-term and long-term trends with astounding accuracy. It can be used with any asset class, so equities, futures, Forex, you name it, okay? Anything that produces a chart on any time frame. I love using this indicator for my directional options trades. So directional options trading, of course, is very time critical. You have to be spot on your timing and your forecast of the directional move. So I use it for virtually all of my directional options trades. It doesn't repaint. So what that means is, unfortunately, a lot of indicators out there will repaint or change after the fact. And so when you look at them in hindsight on a chart, they look great. You go to use them in the live market and they fail miserably. This is often due to repainting. Okay. Trade trend does not repaint. Once you get a confirmed signal set in stone, it's there. You can reliably look at it in hindsight on a chart and know that you could have actually placed a trade based on that signal. Okay, this has built-in protection to avoid whipsaws, so it helps keep us out of the market when conditions aren't favorable. It's designed to help us capture as much of the trend as possible before it reverses. It's designed to limit losses and let profits run. There will still be losing trades, right? But like any other business, the trading business, right, is no different. We want to minimize our overhead, our losing trades, and maximize our revenue. Okay, so it's designed to help us do that. And I'm going to show you some real money proof here in just a second. But as I mentioned, it can be used with any other indicator or system. Maybe you want added confirmation. Maybe you want something that's not so lagging, right? Maybe you're getting your signals too late. You're missing a lot of the trend. You want something that's going to give you, forward-looking directional forecasts, right? And help remove the guesswork from your trading. Okay, so I mentioned I'd give you a really powerful trick to help reduce losing trades. So we can't get rid of all of them, but this is actually built into the trade trend indicator. And so when you get a buy or sell signal and it gives you the exact entry price to get in if you want to take a trade off that signal, okay, it's also going to tell you the order type. So there is an order type called a buy stop or a sell stop. Now, I've actually looked at all the retail broker data and order types out there for some of the major brokers like Schwab and IBKR and others. And the bulk of them are going to be market and limit orders. And that might be appropriate. I'm not saying there's anything wrong with it, but when you're taking a directional trade, wouldn't it make more sense to use a buy stop or sell stop? So a buy stop is simply, if you're taking a long trade, you tell your broker, I want to get in at a slightly higher price than the current market price. That way, there has to be follow through, right, to get into the trade. If the market sells off, right, and you use a market or limit order, you're in a losing trade off the bat. With a buy stop order, you're going to find that you're in winning trades a lot more often right off the bat because you're getting in with the momentum. And conversely with a sell stop, right, if you're going to short the market, rather than jumping in with a market or limit order and maybe you're wrong and the market rallies right after you get into the trade, you're in a losing trade off the bat. By using a sell stop, we need to have some added confirmation and follow through to the downside to get filled on a trade. Okay, so again, this is built into the trade trend indicator. Now, anything that I ever teach to our members at Altos, to anyone, I strongly believe in backing up with real world, real money proof, right? So I don't just throw this out there and, it's like, it's just theory. I hope it works for you. I actually use this stuff, right? I use it in my own personal trading account. So these are screenshots from my TD Ameritrade, which of course is now Schwab, account from back in 2020 during the COVID crash. So at that point in time, I was using the slingshot and the trade trend indicator to navigate all of this, right? So when there's all this panic selling and heavy losses occurring in the market, I was trading this on the way down. So this is just the last week of my positions from February of 2020. So it's just a week's worth of positions. And I was being very conservative. I think I was in like 80 or 90% cash at the time. So I was just using a very small amount of my account and just trading a few contracts. Okay. But I was trading this on the way down. And by February 28th, the end of the month, I booked over 13,300. When March rolls around, I get the buy signal from Trade Trend. Again, I'm just using the slingshot with the Bollinger Bands and then waiting for that buy signal. That came in around the third week of March. Okay, I was still being conservative, mostly in cash, still just doing 1, 2, 3 contracts, as you can see there. But I was putting on more positions. So I started to get more aggressive with my allocation. And by the end of March, booked over 27,000. So I traded the slingshot in both directions, on the sell-off and then on the rebound. And in a very difficult period in the market, when there was heavy retail losses, heavy losses on the retail side, right? Hedge funds folding. I booked over $40,500 just using those two things, the slingshot and the trade trend indicator. So of course, I can't guarantee anyone will replicate these results, but imagine if you could confidently and reliably know when the market's vulnerable to a sell-off and when it's likely to rebound. Even a fraction of this could make a huge difference. So this can be applied to any market, any time frame. You can do this with any size account. You, of course, determine your position sizing, your risk tolerance, all of that stuff. You're in full control, but Trade Trend's going to give you forecasted buy and sell signals, and it's designed to do that before the trend develops, up to 3 candles in advance. So again, if you're trading off a daily chart, you'll have up to 3 days of advance notice when you get a buy or sell signal. You'll have the exact entry price. Okay. If you're trading off a 5-minute chart, you've got up to 15 minutes of advance notice. And what's really exciting, and I'm going to let you know how you can get this indicator on your own charts momentarily. Apply it to a chart of the S&P 500 or the NASDAQ. Go back as far as you can on your chart. Look at every bear market, market crash, black swan event, anytime there was a major crash in the market, you're going to see a trade trend sell signal. I'll show you some examples. So this is the flash crash of August 2015. Okay. This is a daily chart of the S&P 500. And I'm going to keep the Bollinger Bands on here so you can also spot the slingshots here as well. But I'm mainly focusing on the trade trend sell signals. So August 19th rolls around. It doesn't look like the S&Ps are doing a whole lot. They're just range bound. They've been range bound for months. Okay. But on August 19th, trade trend flashed a sell signal. Okay. By all measures, it looks like we're just testing the lower bound of that range and we're likely to rotate back to the upside. But it gave us 1 day of advanced warning before the S&Ps crashed. It also gave us a buy signal in early October as markets formed a double bottom and rebounded. And you guys can spot the slingshot there now too, right? Let's go back to the '08 mortgage crisis. So again, daily chart of the S&P 500. Okay, markets are trading around all-time highs. We're in this in the infancy of this mortgage crisis. The markets are starting to take notice. May 21st, trade trend flashed a sell signal. Okay, literally a couple days after another high in the month of May. Okay, but it gave us about a week's worth of notice before the markets, the S&P 500, went on to lose more than half their value in the second half of the year. It also flashed a buy signal towards the end of November when markets bottomed and before they rebounded. Let's go back over 2 decades to the 2000.com bubble. Okay, same thing, chart of the S&P 500 index. Okay, what's happening? S&Ps are putting in new all-time highs. See how the outer bands are converging? We're in vol contraction. But then they rotate lower, breach the lower band, simultaneous divergence of the outer bands. Trade trend flashes a sell warning, and there's the dot-com bubble bursting. Okay, late September, early October, it flashes a buy signal as markets bottomed and then ultimately rebounded. This is the 2022 bear market. So very similar circumstance, right? End of 2021, S&Ps put in a new all-time high. Literally, I think on the last trading day of the year. Okay, we got a sell signal from trade trend. And there's the bear market. Okay, this is last year's tariff crash. Again, chart of the S&P 500. Okay, you guys can see the slingshots there. There were some nice opportunities. We got a sell signal, another one, and a third one on the way down. These are all triggered sell signals. And then we got a buy signal on April 9th, the day we got that huge relief rally, and markets ultimately went on to recover. So I traded that. I traded the tariff crash across a lot of different assets. This is just the one of those. I was trading the MES, the micro E-mini S&Ps. So I was trading the slingshot and using the trade trend buy and sell signals on the MES, the micros, over 40,500. All right, this is the recent correction. So we just recently had a slingshot, right? And now you guys can spot it. We breached the lower band, right? You see in April, there's the rebound. We were right back up. Notice how the S&P's gapped pretty much right into that volatility expansion level, right around 6,750, 6,800. Okay, we also got sell warnings from trade trend. These are all triggered sell signals. And notice how it gave us these before the market really sold off. It also flashed a buy signal at the end of March. Pretty darn close to that bottom. Okay, literally 1 day after the market low. And there's the slingshot and the rebound. All right, guys. So virtually every system will produce winning trades if you can stick with it long enough. But the problem is they don't keep you out of the market when conditions are not favorable. And you can end up giving back your profits on the losing trades. Okay, that's ultimately what we as traders need to overcome, right? We, like, again, any other business, we need to minimize our overhead, which mostly is our losing trades, right? And maximize our revenue or our winning trades. And so I want to give you an opportunity to have access to some of the tools that I'm using here. And again, I use this all in my own personal trading account, and I trade a lot of different asset classes. I've done a lot of futures trading over the years. These are real money screenshots from my Toss My Thinkorswim account, just trading futures, just using the trade trend indicator. Okay, and I'm not doing anything crazy here. These are all one contract, one lots. They're one lot trades. Obviously, I'm trading a lot of different futures markets here, but these are results from the trade trend indicator. I obviously have losing trades in here. All right, so I'm not cherry picking anything. I'm showing you my losers as well. But what what I'm really proud of with this is that the indicator helped me keep those losses contained and help maximize my winning trades. This is, again, real world, real money from one of the bad sell-offs we had in recent years. And I was using the slingshot and the trade trend indicator here. And I was trading a few different futures markets. P&L on the day was over 26,600 and open P&L was over 115,000. I believe I was doing 4 contracts here. Okay. So you can see when you get into these really major market moves, right? Big market events, big catalysts, there can be a lot of potential around these. But I want to make a promise to you guys. Again, I can't guarantee you're going to replicate any of this. But what I can guarantee is that I'll give you the exact knowledge, education, and tools that I use to accomplish the results that I've shared with you guys today. So I don't hold anything back. I don't give you a redacted version of anything. I don't give you a basic version of the indicator. I give you exactly what I'm using, okay, with nothing held back. So let's walk through what you can get. We put together a special package that includes the trade trend indicator for the event today. You're going to get exact entry and exit signals, okay, and you're also going to get weekly live interactive sessions with me. We meet with our members at Altos every Tuesday at 7 p.m. Eastern. We record all of those sessions, so you get access to years and years of all of our prior events. But they're similar to our session today. We do a general market overview, map out key levels, and then we focus on a new strategy each week, like we did today with the slingshot. So I'm there every week hosting those. I'm there to help coach you, support you. Only limitation is I can't give you individual, investment or trade advice. I'm going to give you some additional education on trade management. I'll let you know how you can get that as well. And then also, I'll let you know how you can get my top 2 picks sent to your inbox every week. Okay, but this is all designed to help you cut the learning curve, trade with more confidence and more consistency. All right, so I'm going to walk through everything that we're offering here, and then I'm going to let you know how you can get this. So first thing is you get a 1-year access to our trade trend indicator. Okay, you get weekly live strategy sessions. You get coaching from me on those sessions. You get access to our private invitational Facebook group of over 900 members. You're going to get on-demand online training for adjusting options trades. So I'm a big advocate of trade management and not just taking a losing trade, but actually doing something about it. And I walk through different tactics to adjust trades and mitigate losses. And in some cases, we can take these trades and transform them into net profitable outcomes. I walk you through all of my most effective tips and tricks and techniques on the on-demand training. You're going to get that as well. And there are 2 bonuses. So you get my top 2 weekly trade trend picks. So as you're getting up and running with the indicator, I'm going to be sending you my top 2 buy or sell signals for the week every Monday for that week, right to your inbox. Okay. You're going to get my latest ebook. And this is really a powerful money management ebook that walks through tactics to mitigate risk and in some cases eliminate it from your trades. Okay. So the total retail value on this package is over $5,000. We're not charging anywhere near that. This is if you were to go get these things from us all individually. You don't need to do that. We are knocking 90% off exclusively for the webinar today. So you can literally get all this for $497. We do limit the 90% discount to 25 people. And once those are scooped up, we'll raise it back up to the retail price. So you can still get any of these things that will go back up to retail. So if you want the 90% discount, you just need to go to altostrading.com/slingshot. That will lock in your 90% discount. And then once you lock that in, you're going to select which platform you want the indicator on, the trade trend indicator. So we offer it on Thinkorswim, WellCharts, TradingView, Metastock, and NinjaTrader, as well as TradeStation. So you'll select which platform you want it on, and we'll get you all hooked up. Okay, we should have everybody up and running by tomorrow. All right, and then you get the 2 powerful bonuses, my top 2 weekly trade trend picks. This is what one looks like. This is an actual one we sent out to our Altos members in a past year on CRISPR Therapeutics. You get the exact instructions, the entry price, the stop levels, the profit target levels. And we also, if it's an optionable stock, provide a supplemental option alert if you prefer to buy a call or a put. We provide the strike prices, expirations, and everything. This service alone has done remarkably well over the years. This is just a snapshot of our past track record, but it's done very, very well. And then you get my latest ebook as well as part of the package. We do have a guarantee with this, so we want you to be successful. We know that different people have different learning curves or different lifestyles and different things going on in their lives. And so we want to give you as much time as you need. And we want you to be successful. So if after the first 90 days of using the indicator, you haven't been profitable, right? You don't need to send us a screenshot of your broker statement. We'll take your word for it. Just write into us and let us know. We'll give you an extra year of trade trend on the house. So we're going to comp you an extra year of the indicator. Okay. So I'm going to go ahead and open it up to questions. And I also have another thing I want to let you guys know about. So before you run, make sure to stick around. I'll let you know here in just a second. But if you have any questions, you can throw those in the chat, and I'd be happy to take those. Again, that link is altostrading.com/slingshot. As the questions are coming in, I'll let you know that I'm hosting a very special webinar tomorrow as well as on Saturday. So you have 2 options. Where I'm going to be teaching a really, really cool 0 DTE option strategy, and would love to have you join. And so David is going to put the link to register for that. It's free to attend. There's no cost to attend it. And yeah, thanks, David. David got it in there for you. And it's called the Golden One Day Options Trade. So I'll be revealing all the details behind that tomorrow at 7 p.m. Eastern. And if you're not able to make that, I'll be hosting an encore of that webinar on Saturday, this Saturday, May 9th at 1 p.m. Eastern. So you have 2 options there to attend. And it will be recorded. So even if you're not able to make it, I would encourage you to register because that way you'll get the recording. So David got the link in there for you. And again, it's free to attend. All right. So if you guys, again, if you have any questions about the slingshot strategy, the trade trend indicator, anything in the package here, I'd be happy to answer that. But I really appreciate everybody being here today. It's a pleasure. I hope you find the slingshot a valuable addition to your trading toolbox. Let's see. Question about whether you're grandfathered into the 90% discount. Yeah. So number one, you're not locked into any contracts. You have an entire year as part of your package for that 90% discount. You have an entire year. You get to decide if you want to continue using the indicator after the first year. Most of our members do. They love it. They use it for many, many years, but that's up to you. If you do decide to do so, you are locked into that 90% discount. So you're grandfathered in. We never raise the price on you. You get to keep that 90% discount for as long as you're a member. You get to continue receiving the top 2 weekly trade trend picks and retain everything that is in the package. Let's see. What happens after I join? I'm on board. Welcome, welcome. Great to have you. Yeah, so after you join, we're going to get you set up with your members portal login. So you're going to receive, you'll get a welcome email. You're going to receive a username and password. Okay, that's where you're going to find your bonuses, your additional education, on-demand training. You can see our past alerts. That'll all be in your members portal. And then again, once you lock in that discount, you're going to select your platform of choice for the indicator. So once you've done that, we'll get that hooked up for you as well. And that will be platform dependent. So like if you select Thinkorswim, we'll send you the indicator files that you'll need just to import, and we provide instructions. It's very simple. If you're using select TradingView, for instance, we'll get your username activated. So we'll do all of that for you. Let's see. Another question came in. Do the bonus alerts include both an option and a stock alert? Yeah. So most of the, that's referring to the 2 Monday trade trend picks. most of those picks are optionable stocks or ETFs. So if they are, and they're liquid options, right? We're going to make sure that they're viable to trade. So if there's enough open interest and volume behind them, we will issue a supplemental option alert if you prefer to trade the option in lieu of the stock or the ETF. Yep, so good question. Let's see. Slingshot strategy, has it really worked 100% of the time? Yeah, so on the major indices, on the S&P 500 and the NASDAQ, and again, we just actually completed one, right, just in April, going all the way back to the dawn of the stock market. So anytime the S&Ps or NASDAQ have breached that lower band and you've gotten simultaneous divergence to the outer bands, right, and then you've gotten a market sell-off, they've recovered and rebounded up at a minimum, of course, up to that initial sell-off level. Yep, pretty incredible. Let's see, another question. How in-depth are the course materials available? Yeah, so again, you'll get access to additional training in your members portal. It's very, very in-depth. So I cover, for instance, trade adjustments. So if you have, and I do that for more of the popular option strategies, for instance, like credit spreads, short puts. If you have a losing trade, I walk through different tactics to make adjustments to that trade that can actually give the position a net profit potential. It's very in-depth, and I cover our most effective strategies. It's hours and hours of on-demand content. Yeah. All right. Well, I want to welcome everybody who's claimed that 90% discount. Looking forward to working with you. Looking forward to receiving your success stories. Of course, if you have questions, don't hesitate to reach out to us. I'll throw up our contact info here real quick once again. You can email us anytime, support@altostrading.com, or call us during business hours at 800-895-9348. Thanks to everybody for joining. I greatly appreciate you taking time out of your day. Everyone's time is valuable to further your trading education. I hope it's worth your while. And big thanks to David and the Timing Research crew for having me. Really appreciate it. It's always a pleasure. David, I'll pass it back to you.
All right. Thanks, Jeff.
Thanks so much.
I'll post your other contact info in there. Yeah, so be sure to hit that Slingshot link and check that offer out, and also get the PDF and access to the session tomorrow and Saturday. So yeah, as soon as so this was day 2 of the event. As soon as day 3 tomorrow is over, then you can switch over to Jeff's presentation tomorrow night. So we'll be ending tomorrow before Jeff's session, so you can attend that. All right, so that is day 2 complete. Thank you again to Jeff for closing out the day for us, and be sure to join us again tomorrow. We have another at least 7 live presentations planned for tomorrow. We might have one other added in there as well, but let's see. So this link right here is the YouTube link for the full unedited today's session. And then I'm working on processing the individual recordings, and those will be available on YouTube as well as soon as I can get them processed. Here's just some other links for you in case you haven't seen these yet. You can add Timing Research events to your Google Calendar so you don't miss out on anything in the future. Also, get updates on Telegram, on Substack, and of course YouTube. And let's see. Oh, one other important report you might be interested in. The NetPicks has released a report about the top 10 best iron condor options stocks. So you might find that interesting. So, all right, so that's it for day 2. If you have any questions or comments or feedback, anything like that, you can reply to any Timing Research email that comes to me directly. Or there is a contact page on Timing Research. And let's see. Oh, yeah, so tomorrow's join us again tomorrow at 10 a.m. Eastern time on TimingResearch.com. Peter Schultz will be here to start the day for us, and then also Russell Berber, Simon Klein, Agnieszka Wood, Jim Fink, Sonny Harris, and AJ Brown. So it'll be a good third day. And then, like I said, after our sessions are over, then you can switch over to Jeff Tompkins' session tomorrow night. And I think that's it. Any other questions before we close out? All right. Thanks, everyone.